will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
One of our golden rules is not to fight the Fed. And right now, the markets are doing just that. And I think it's a mistake.
I think there's a, look, I'm realistic here. I mean, I'm not going to tell you there's no risk of a recession. I think there's a 40% risk of a hard landing and a 60% likelihood of a soft landing.
Consider that equities are super cheap. And yes, earnings can fall a little bit more, but you're never going to time the bottom.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today: the worst year for global stocks and bonds in more than a decade is finally coming to an end. Equities have lost around a fifth of their value as inflation has forced yields sharply higher. Commodities, though, have outperformed, with energy prices soaring. Traders are now watching China's reopening to see if demand will pick up further in 2023. And this year's crypto collapse is not over yet, as revelations emerged that Sam Bankman-Fried met with top White House aides just before his empire fell apart. Welcome to Bloomberg Surveillance, the early edition. I'm Guy Johnson in London with Kriti Gupta and Kaylee Lines in New York. Anna Edwards is off today. Matt Miller co-hosting Surveillance in the next hour with Kaylee and Lisa. Kaylee, let's talk a little bit about the Asian session today and the bigger picture for Asian markets. Have they outperformed or underperformed this year?
Interestingly, they did outperform global stocks this year, but that still means a 19% decline and the worst year since 2008. So outperformance definitely a relative term as we consider the year that was. I think I speak for a lot of us when I say I am so glad we only have one more day to get through, just one more trading day of 2020, at least for the West. We already are through with the year in Asia overnight. That said, it was a positive last day of the year. The MSCI Asia Pacific Index as a whole up by about 0.4%. And Chinese stocks as well, which actually only had their worst year since 2018. The CSI 300 up about 0.4%. The market really trying to weigh optimism about the reopening and growth story on the one hand, with pessimism about the surge in COVID cases that could get worse over the Lunar New Year holiday. Now, in addition to COVID zero and other factors in Asia specifically, globally, markets have had to consider the tightening of central bank policy this year. But of course, the one central bank that really sat that out was the Bank of Japan. They're still dovish, and yes, they did tweak yield curve control, and they are fighting very, very hard to defend that curve control because the bond market continues to test them. And as a result, unprecedented move for the third day in a row, the Bank of Japan conducting unscheduled bond purchases. They actually purchased the most bonds on record in the month of December. So we saw that 10-year JGB yield moving down by about 4 basis points to 42 basis points, so below that half percentage point cap. And then interestingly, as you have the Bank of Japan continually coming in and buying bonds, the Japanese yen is the outperformer on the day against the US dollar, stronger by about 0.8% to 132, but still the yen by far the weakest G10 currency on the year, Kriti.
Yeah, Kaylee, that green on screen that you're seeing, at least in the equity space in the Asia market, has not translated to futures action here in the States. In fact, you are seeing futures take a little bit of a step lower, down about 0.4%. And it's not just the stock market here, it's the bond market as well that you are starting to see a little bit of sell-off. Yields up only about 3 basis points. Remember, in the context of this kind of extremely volatile year, 3 basis points is almost nothing, but still significant given that we haven't really seen a 3 basis point move all week long. So 384 on the 10-year yield. And once again, it sticks to commodities. It almost feels like the commodity market or the bond market is kind of taking its cue from each other. So NYMEX crude trading at a 77 handle, down about 0.7%. That's going to be a crucial story going into 2023. Whether or not the tail wagging the dog isn't the bond market anymore, maybe it's the commodity market that then affects the rest of the cross-asset story. And of course, Bitcoin probably following in to that theme where Bitcoin is actually down about 0.5%. It's interesting, Guy, that I don't feel like there's any real move outside of saying it's the last trading day. Maybe people are cashing out, maybe some rebalancing on the books today.
Yeah, I think a lot of people may be staying at home today, waiting for the long weekend. Critty, let's talk about what is going on today in Europe. Now, as you can see, we are red. As Critty says, though, I'm not sure there's much of a signal from this. I think this will be more useful as a weather map. It is unbelievably warm here in Europe right now. I'm going to talk about the gas price in just a moment. It is going to be T-shirt weather in Berlin this New Year's Eve. And that is great news for Europe. And as Javier Blas points out in his column today, bad news for Vladimir Putin. The story this year in Europe has been about the war. It's been about inflation. It's been about the energy crisis. The stock 600 down by 0.4% today. It's down around 12% year to date. Now, you do need to currency adjust that. Energy's been the bigger outperformer this year, plus 25%. Real estate has had the worst performance in terms of the sector story. The outperformance in terms of single stocks, Rheinmetall, which builds tanks out of Germany. Obviously, that's related to the war. The standout story for me on the downside, though, this year has been Credit Suisse, which is down nearly 70% year to date, 60-something odd percent. It's had a terrible, terrible year. In terms of nat gas, let's talk about that. Today, down another 5%. As I say, it's incredibly warm. This month alone, we have seen the biggest drop ever for European natural gas. That's the Dutch contract. We're down by nearly 45% as it's got warmer and warmer. The gas price has absolutely tumbled. And then we come back to the inflation narrative, which is so related to what has been happening with the energy story. Spanish inflation today coming through year on year at 5.6%. That's the December number, 5.8, below estimates. How quickly inflation falls in 2023 is absolutely the key question that we need to be asking, Kaylee.
Yeah, it's about the downward slope in the new year, but it was all about the upward slope of inflation in 2022, which, as we've said, marks the worst year in more than a decade for global equities and bonds, with stocks facing a 20% fall year to date. Ed Yardeni, president of Yardeni Research, says the stock market bulls may face another challenging year ahead if the economy stays strong.
The key is that kind of narrow path where inflation comes down a bit more than is widely expected. That's the camp I'm in.
Joining us now for a look back on the year is Bloomberg Markets reporter Justina Lee. Everyone coming out of this year battered and bruised, Justina.
Right, exactly. I mean, hindsight really is 2020. I think investors, when they look back on this year, will think that the big mistake they made at the start of it was underestimating how sticky inflation was going to be and how determined the Fed was going to be in fighting that. And I think as we head into the new year, they're also wondering if they're going to make the same mistake again, with talks of peak inflation again. But it could also be an opposite scenario where the monetary tightening starts to show up in the economic data and growth does start to slow. I mean, either scenario is not great for stocks, but I guess in the latter scenario, if we do get something that looks like a recession, it could at least mean, some reprieve for bonds.
Justina, a trade that has worked for, I want to say, at least 9 out of 12 months of the year has been a bid into the strong dollar. But I have to ask, going into 2023, given that terminal rate expectations are stalling out for the Federal Reserve, what is the bull case for the dollar?
Yeah, it does go back to what the Fed is going to do next. But of course, currencies are relative. And so we also have to look at what other central banks do. We've already seen the dollar take a bit of a hit finally recently because of the BOJ turning just a little bit less dovish. And now there are speculations that maybe they're heading further in that direction. But at the same time, we have to look at what the ECB is up to. And they've always seemed a little bit more careful about raising rates. And with inflation coming down, out of the Eurozone, I mean, there are questions over whether they will catch up with the Fed at all.
Justina, thank you very much indeed. It's been a brutal year, as Kaylee says. Let's see what 2023 brings. Have a very happy new year. Justina Lee. Let's turn to tech. Tech has been battered this year, with the NASDAQ 100 basically falling circa 35%, and a big underperformance coming through as well. Ed Ludlow joins us now for a deeper dive. Ed, give us the kind of more nuanced picture here. Tech has had a tough year, but it's not been all tech being treated equally.
Yeah, that's a fair read. I would say that, you know, big tech's collapse is kind of the abiding market theme because it came as a consequence of everything we saw from central banks and the global economy. Yes, you look at the NASDAQ 100 down 35 or 32-ish% year to date. Even worse, underperformance in that basket of mega cap tech stocks. There's some distortion on the NYSE FANG Plus index because it includes the US listed shares of Chinese tech companies which have their own story. Semiconductors also moving so quickly from supply constraints to a supply glut, something that we didn't think would happen, this return to a boom and bust cycle for the chip sector. This was the worst year for the NASDAQ 100 going back to 2008, but it's interesting that it was also the worst year for the NASDAQ 100 relative to the S&P 500 going back to 2002, 20 years. Energy is a big part of that story, right, Guy? You look at the big performers on the S&P 500, they are energy companies. The market just was wrong, basically, about inflation and the Fed, just like Justina was talking about, right? We hit a new low on the NASDAQ 100 just 2 days ago when the Fed had its latest decision and projected rates at 5.1% by the end of next year and potentially cutting down to 4.6% in 2024. The market realized there's further to go with this, and it's not now just that rates discount the present value of future profits for tech, these higher multiple stocks, but now we're worried about an earnings and an economic recession. You know, we've kind of given up on the idea that some of those names on your screen, despite strong balance sheets, will weather the storm. Tesla, a big part of the story, of course, specific to Musk's purchase of Twitter, the kind of brand reputation hit that stock's had because of Musk's behavior on the platform, but it too is a higher multiple stock. And when you look at multiples now, you know, forward 12-month price to earnings relative to where they were after the dot-com bubble, there's not a huge amount of optimism going into 2023. Also some pandemic darlings there. Zoom, you know, they were some of the big stories, the collapse of those pandemic darlings this year.
Well, and Ed, we know that historically there is a very close correlation between the performance of tech stocks and the performance of cryptocurrencies, which haven't just fallen victim to the multiple compression and the idea of tighter policy, but also the implosion of so many players in the industry, including FTX. And on that note, in the Bahamas, authorities now say they seized $3.5 billion worth of digital assets at FTX shortly after the crypto exchange filed for bankruptcy protection. The Bahamas Securities Commission cited a risk of, quote, imminent dissipation of the assets. That was based on information provided by founder Sam Bankman-Fried. So, Ed, just walk us through this in particular, but also just the chaos we have seen in crypto this year.
Well, you got it exactly right. This year, we've been so focused since November on FTX and Sam Bankman-Fried. You have to extrapolate the year as a whole. We started 2022 with the total market value of global digital assets at 2.5 trillion. They dipped below 1 trillion by June, and you have to remember what happened in May, the collapse of Terra USD, some of the regulatory actions and investigations that took place earlier this year. That's a fantastic chart of Bitcoin, right? You go back to the beginning of 2022, the trough that we hit very recently was driven by FTX. But Bitcoin itself was also not immune to the actions taken by global central banks and higher rates as well. You know, we're down 60% year to date on Bitcoin. It is the biggest single digital asset by market value. The other area I'd look at as well is crypto-related stocks, Coinbase being a great example. You know, we talk about the declines on Tesla, but look at Coinbase. Part of that is the contagion. It's crypto winter and contagion with the two buzzwords. But frankly, we saw investors pulling out of digital assets when things got a bit hairy. You also look at those others that basically have a direct interest in Bitcoin through ownership, like MicroStrategy or Riot Blockchain, which is a bet on the underlying technology. And they too, those are severe underperformances. Underperformance is a bit kind, probably. I mean, that's a disastrous year for crypto-related stocks.
Yeah, I think that probably is a fair way of putting it. Ed, very nice. Thank you very much indeed. Bloomberg's Ed Ludlow. Turning now to China. The COVID surge there threatening the economic recovery. Bloomberg's Tom McKenzie joining us now with some startling estimates of just how bad this COVID outbreak could be. Tom, let's talk a little bit about the projections that we're seeing right now. Affinity's out with some fairly bleak ones. I'm struggling to get my arms around the data. Just sort of update us on where we are.
Well, it's interesting. There's always been skepticism about the data coming out of China when it comes to COVID. Some of that skepticism unjustified up until now. Now they are not doing the testing. They're not publishing the results in terms of infections or death rates. So that skepticism is very on point at this point. What we're seeing in terms of research and the data that's coming out, one firm, Airfinity, based in the UK, pulling the data sources that they have together to project that over the long term, over the next at least few weeks into the middle of January, I should say, you're going to be seeing as many as 1.7 million people who are dying as a result of this. 3.7 million daily infections. Currently, they say about 9,000 people are dying per day in China, and they see that radically increasing to 25,000 per day by the middle of January. That coinciding with the Lunar New Year holiday, which is typically the biggest mass migration of people on the planet. So the personal toll, the societal cost now of this decision to walk back radically from COVID zero is being felt across China. And then when it comes to the economics, some of the early data suggesting that in cities like Beijing, there has already been a peak and you're seeing mobility pick up. That's the bright side in terms of the economic implications. But the broader picture across the country is that human toll right now.
So let's go from the economics to the financials of it all. How does this really set the stage for a turnaround in Chinese assets?
Well, is China going to be the big macro story of 2023? Some people think it will be. Of course, Wall Street Bank's lined up at the gates at the outset of 2022 to predict some pretty decent upside for Chinese equities. It hasn't worked out like that, of course. The MSCI China index is down about 21% year to date. Yes, in the last 30 days or so, you've seen a 35% rally, but year to date, it's down about 21%. The yuan is down about 9%. In terms of foreign inflows into Chinese equities, at a record low for the year, about $12.5 billion US dollars. Four key things, of course, four key factors that have weighed on Chinese assets over the year. Of course, COVID zero, but also the crackdown on technology, property, and the softness when it comes to exports. Arguably, COVID and the restrictions there, you can put that one to one side by March or April of next year. But exports could still be a lag. What happens when it comes to property? That makes up about 20% of GDP. And when it comes to the technology sector, so important for jobs growth in China. And don't forget, amongst 18 to 25-year-olds, you've got about 20% unemployment. So you're looking at all of that into 2023. Morgan Stanley, though, and Goldman Sachs both see upside for Chinese equities into, by the end of 2023, 14% upside from Morgan Stanley. That is the forecast, 16% from Goldman Sachs. And they think that foreign buying is going to pick up from $12.5 billion this year to about $65 billion by the end of next year.
As you speak, headline crossing the Bloomberg, offshore yuan extending gains versus the dollar to the strongest level since September the 13th. Maybe an indication of some of those flows. Tom, very nice. Thank you very much indeed. Bloomberg's Tom McKenzie. Coming up, Alan Custis, Lazard Asset Management, head of UK equities. We'll get his take on the year ahead. Where do you want to be putting your money to work? And are debt investors actually growing more confident in the Fed's ability to contain inflation, to deliver a soft landing? We're going to speak with Bloomberg's editor-in-chief emeritus, Matt Winkler. Plus, New York's first legal marijuana dispensary is now open for business. Details to follow. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
What's happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So this is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London, Kriti Gupta and Kaylee Lines, both in New York. Let's talk about commodities. Oil set to end the year modestly higher. It has been, though, a volatile year. Investors are looking for an expected rebound in Chinese demand next year, maybe to continue that trade. Joining us now is Eddie van der Walt, Bloomberg Markets, Market Live Deputy Managing Editor. Eddie, a lot of assets have been battered this year. Commodities, though, have been the real star.
Yeah, absolutely. Oil, as you said, doing well, but I think that's partially because oil had OPEC on its side, right? There was a lot of talk about cuts. Now, the cuts that OPEC advertised was not as deep as the ones they actually delivered, but just the fact that somebody is managing supply helped an awful lot. You didn't have that in other assets. The other thing is, of course, you had that disruption in Russia and in Ukraine, and that, of course, just added a wild card. And now, as we get to the end of the year, you're suddenly starting to hope for a Chinese bid coming back into the oil market and movement in China. And I think all of those factors meant that oil has done particularly well, and therefore commodities broadly has been kept supported throughout the year.
Eddie, are commodities still the go-to hedge, or should they be in 2023?
Yeah, it's a bit more nuanced as we go into next year, right? I think other assets start to come back a little bit. I think the oil market, I do think that the OPEC bid in the market will help support prices into next year. But I think you want to look more broadly than purely going into oil. I think copper probably comes back a lot stronger. That copper underperformed this year versus other commodities, and it's down on the year. But I think as we go into next year and you see Chinese demand coming back and Chinese manufacturing picking up, I think we could see copper outperform. But the big one, I think, is gold, particularly for the first few months. As China gets ready to celebrate the Lunar New Year, I think gold could do particularly well.
All right, Eddie van der Walt of Bloomberg Markets Live, thank you so much and Happy New Year to you. And for more market analysis as we close out the year and ahead in 2023, check out MLIV Go on your terminal. This is Bloomberg.
and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Guy Johnson in London. Now keeping you up to date with news from around the world, here's the first word. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg has learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. The Bank of Japan has never done this before. For an unprecedented third day, the central bank has made unscheduled bond purchases. The BOJ is fighting against speculation that it's about to end its super accommodative monetary policy. It's bought a record $128 billion of bonds this month. After a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. And he was called the King and has long been regarded as the best player soccer has ever produced. Brazilian star Pelé died Thursday after a battle with cancer. He led Brazil to 3 World Cup championships, and later in his career, he moved to the U.S. to play for the New York Cosmos, fueling new interest in soccer by Americans. Pelé was 82.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance, the early edition, and here's what you need to know. The worst year for global stocks and bonds in more than a decade is finally coming to an end. Equities have lost around a fifth of their value as inflation has forced yields sharply higher. Commodities, though, have outperformed with energy prices soaring. Traders are now watching China's reopening to see if demand picks up further in 2023. And this year's crypto collapse not over yet, as revelations emerged that Sam Bankman-Fried met with top White House aides just before his empire fell apart. I'm Guy Johnson in London. Kriti Gupta and Kaylee Lyons are both in New York. Anna Edwards is off today. Matt Miller is going to be co-hosting Surveillance in the next hour with Kaylee and Lisa. Kriti, last day of the year. We're nearly done. What does it look like?
Almost there, almost done. Well, not very good when you're talking about risk sentiment. You are seeing a bit of red on the screen when you look at futures trading. You are seeing futures down about 0.3%. I will say perhaps the selling is a little more muted, obviously, on this holiday trading week. And you also, of course, have the 10-year yield, 384. So the bond market is selling off a little bit too, perhaps not by the same margin, but you are seeing yields higher by about 3 basis points. Crude is no exception. We are now at a 78 handle, only down 0.2%. So I think what's interesting in the last 30 minutes since we did our last market check is simply that futures were down a little bit more. They're starting to pair some of those losses, but still, we still have ways to go before potentially turning green on the screen by the opening bell. So right now, risk sentiment down across the board, including with Bitcoin, Kaylee, down about 0.5%.
Well, we know Bitcoin has had an incredibly rough year, down more than 60% over the course of 2022. And you know what else is down more than 60% over the course of 2022? Tesla, worst year on record. It is about to close out, and yet it does look like it's going to end the year at least on a slightly more positive note, recovering some of those losses. It's actually up 12% over the last 2 days, the best two-day streak or two-day performance going back to May. And we are extending gains in pre-market trading up about 0.6%. But I do not doubt that this stock is going to be one we continue to watch throughout the course of the year ahead. And of course, Tesla was a bit more overdramatic, but by and large, it was just a bad year for large cap technology stocks. Apple is down 27% on the year. Both Amazon and Nvidia down by 50% each. And as we look to close out what has been a brutal 2022 for these names, all those stocks are also lower this morning to the tune of about 1/4 to 0.5%, Guy.
Let's talk about what's happening here in Europe. The Stock 600 is down circa 12% for the year. There's big sort of divergences, though, between European bourses. The best performer, Rheinmetall, the armored personnel carrier maker, the tank maker out of Germany. That's the war story that is impacting the market. At the bottom end of the market, it's the rate story. Real estate, the worst performing sector. Credit Suisse down very hard this year as well. That's one notable story out of the banking sector. But European equities today down by around 0.4%. The gas story absolutely front and center. It is quite warm here at the moment. I hear it's going to be T-shirt weather in Berlin this weekend. Over the last month, European nat gas is down by 45%. That's the biggest drop ever that we have seen there. We're almost halfway through the winter. I think January the 15th is the halfway point. And it's looking good. bad for Vladimir Putin, better for European consumers and industry. And the Spanish 10-year up by 300 basis points this year. We've seen the ECB hiking rates, but inflation's starting to roll over, particularly in Spain. The expectation was that the December number would be 5.8. It actually came through at 5.6. We'll take the good news where we can find it, Kaylee.
Yeah, so maybe the good news is what central banks are trying to accomplish is starting to get closer to being accomplished, but if we listen to them, they say they still have a ways to go. So what does that mean for the outlook going forward as we round out this year and look ahead to 2023? Joining us now to discuss that is Alan Custis. He is Lazard Asset Management Head of UK Equities. Alan, great to speak with you. Happy almost end of a brutal 2022. As we look ahead to 2023, how much is going to be dependent, as it was this year, on central banks tightening, and how much is it going to be a return to the fundamentals and the outlook for the real economy?
Yeah, it's a great question. Morning. I think you have to go back to the experience of 2021 when the central banks were a bit in denial, I think it's fair to say, around inflation. Remember, the narrative was, this is transitory, this is transitory. And obviously it didn't turn out to be as transitory as they thought it was going to be. And I think that as we move into 2023, one of the biggest risks I see is that actually the Fed, the ECB, and to a lesser extent the Bank of England actually over-tighten. Because as we've been seeing, you know, the Spanish inflation data came in lower. We're looking at the gas price down materially. You know, there are clear evidence that inflation has peaked. We think it's going to fall, but it's going to fall slowly. And the key will be for the central banks to manage the narrative around that and not over-tighten. And clearly, you know, the experience of the last couple of weeks when the dot plot went to 5.1 has clearly rattled the market again. I think it's very important that we, you know, the central banks recognize that, you know, inflation is falling, and just to keep the, I guess, the cooker on simmer rather than trying to overclub it at the moment. And as an equity investor, for me, that's going to be the key call in the first and second quarter of 2023.
Alan, let's talk about your bailiwick. Commodities have done well this year. The FTSE 100, by extension, currency adjusted, has been a big outperformer. Does it continue to deliver in 2023?
I think it does. I think it's going to be a year of two halves. I think the first quarter is probably going to be the weak point for the domestic market. If we think about the domestic market being the, you know, the mid 250, the small cap end of the market, that's clearly had a very tough year. So I think for investors, the first half of the year will be about, you know, sticking to the large cap names. As we've talked about, you know, China is showing signs clearly of reopening. That supports, you know, some of the commodity prices. That's supportive for large cap over mid cap. The other area which I think will continue to perform very well into 2023 is financials, particularly banks. If we don't think that rates are going to go to sky high levels, then banks are actually in the sweet spot at the moment with, you know, net interest margins being at very manageable levels without the risk on credit. So I think that all that leads to, yes, large cap over mid cap. But I think as we move towards what will inevitably be a pivot that the market identifies mid-year, then you will be looking to switch into some of the more domestic names.
Okay. How big an outperformance do you think you get relative to the 100 from the 250 at that point? At the moment, you've got the biggest outperformance in 2022, FTSE 100 to 250 ever on record, Alan. So once that starts to close, how quickly does it close?
I think it closes quite quickly, and I think that's a trade that will happen in the second half of the year, and therefore, you know, investors should be thinking about it in the second quarter. The risk of going too early is that we get, you know, going through January, February, March, where we've got a further hike in energy prices, or the cap, I should say, and also, you know, people will continue to look at unemployment data, house prices are weak, so the consumer domestic outlook, I think, is quite dull for the first 3 to 4 months. But I think there's certainly the point in March, April, when the market becomes more comfortable that inflation has actually started to fall. And then that's the trade, I think, with share prices in a lot of those sectors, the mid-cap down 30-40%, you could see a very, very swift reversal of that underperformance in the second half. But I think it's definitely FTSE 100 for the first sort of 3 to 4 months of 2023.
Alan, to what extent are geopolitics priced into the market right now? Not just the war in Ukraine, but by extension, Taiwan as well.
I would say it's never priced into the market. And as we've seen in 2022, events can clearly destabilize the market. So I think, yes, geopolitics will continue to play an important part in 2023. And clearly the crisis in Ukraine and what Vladimir Putin does is going to be front and center in terms of how the market's going to think about it. And as you said, also China and Taiwan and the saber rattling we've seen more recently there. But I think, markets always have this level of geopolitical uncertainty, although I accept that it is probably more heightened now than it's probably been in the last 10 years. The market sort of seems to take it in its stride ultimately, doesn't it? And I think we'll see that in 2023.
Well, and Alan, in the UK specifically, it hasn't been just about geopolitics, but frankly, very volatile domestic politics as well. How confident are you about that story and the fiscal story in the year ahead?
I think that you're right. After the September and October wobble, I think that the politicians have got a very clear narrative to stay off the front pages of the papers as much as is possible in 2023. So I do think we get a greater level of stability coming out of the political landscape in 2023 in the UK, and I think the ability of that to destabilize the UK domestic market, hopefully, will be less evident in 23 than it's clearly been in 2022, and it really was the big driver of certainly, obviously the sterling dollar rate hitting 103.8 after the mini budget.
Yeah, I remember that one quite well. Just one of many FX episodes that took us all by surprise, or at least made us catch our breath this year. Alan Custis of Lazard Asset Management, thank you so much for joining us, and Happy New Year to you. Guy.
So, Kaylee, coming up, are debt investors actually growing more confident in the Fed's ability to contain inflation? We're going to discuss that very issue with Bloomberg's editor-in-chief emeritus, Matt Winkler, next. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Caucus.
This This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Anna Edwards is off, and Kaylee Lyons on her way to set, joining Matt Miller and Lisa Abramowitz for Surveillance in the next hour. We're very lucky to have very special guests talking about the debt market. Contrary to popular belief, debt investors are growing more confident in the Fed's ability to contain inflation. Matt Winkler, Bloomberg Editor-in-Chief Emeritus, joins us now to talk a little bit about his latest column. Matt, thank you as always for waking up early for us. We've been talking a lot on the show about the big themes of 2022, and one of them has been that the Fed is behind the curve. In your opinion, have they caught up?
They were never behind the curve, and that is something that the bond market said at this time last year, continued to show it through various kinds of, what we would call trades that are the most evident, if you like, example of what millions of people who are investing every day, the people with the most at stake, and they never believed the Fed was going to lose the battle to contain inflation. And of course, what we've seen over the past year is that the Fed did more in less time to tighten credit. And here we are a year from when everybody said it was behind the curve, and the Fed is actually on the path to containing inflation.
Is it still in some ways leading the pack when it's compared to emerging market central banks or the ECB or the BOJ? One of the concerns this year was that perhaps some of these EM central banks had gotten ahead of the Fed in calling that. Are they still the leader of the pack?
Very much so. I mean, if you look at the bond market's performance, U.S. bonds have outperformed the world this year. So that's one measure of where the Fed is, okay? The U.S. bond market has outperformed not only the world, but it's outperformed all of the markets in the group of 7 countries. The second thing is, if you look at inflation, U.S. inflation is one of the lowest among the OECD economies. So those two things together tell you the Fed was never not in control of what was happening.
Matt, good morning. It's Guy. Let's talk about what happens next. The Fed is telling us that they are going to hike rates, so let's call it circa 5%, and then leave those rates there. The market is saying, not so fast. We expect you to be cutting by the back end of next year. Is the danger now that the Fed, having been potentially behind, is now potentially ahead of where the market expects?
Well, we're going to find out. We don't know. The bond market has put its, if you like, reputation and fortune in the belief that inflation a year from now will be very close to what the Fed considers to be its target. The Fed is saying at the moment, right now, that wage price pressures are too high, so it's going to not only keep rates elevated, it may in fact increase them. The Fed may find out that its credit tightening, which always has a lag effect, will prove to be more effective sooner than later. We don't know. But the bond market and the Fed are not really that far apart. The Fed says we're going to do whatever it takes to contain inflation, and the bond market is saying, we believe you. We just think you may get it done sooner than later.
So is Jay Powell Burns or Volcker, do you think?
Oh, he's very much Jay Powell, actually. He's neither Burns, who lost control completely, and Volcker, was dealing with a very different environment than the one that Powell is. And what I mean by that is, inflation as high as it got this year in June, 9.1% or so. It was never the runaway inflation that Paul Volcker had to deal with. So Powell is really dealing with a totally different environment, and he's his own man.
Well, Matt, let's talk about the Fed cuts that Guy was just referencing, the ones that are priced into the market for the back half of the year. Ira Jersey, our Bloomberg Intelligence chief rate strategist, says it's capping yields at the moment because those cuts are priced in. A lot of the consensus when you talk about with bond strategists say the market is completely wrong. Fed cuts aren't going to be really in the Fed's future because they're trying to tackle inflation. They're not going to use it. But Chair Powell has said that the risk of overdoing it is cushioned by the ability to cut rates when they need to. So why is that call so wrong?
I don't know if it's wrong. I mean, look, here's what we're dealing with. A lot of people in June, a lot of people in July, A lot of people in August were saying inflation is out of control. You've had many guests who have said that over and over again. As it turns out, we have seen inflation since August dramatically decelerate from where it's been. And I wouldn't say that was a consensus expectation or call, except in the bond market.
Right.
That's the only place where you saw it.
Well, Matt Winkler, Bloomberg editor-in-chief emeritus, waking up early to talk of the Federal Reserve. He deserves a special medal for that, in my opinion. We thank you, as always, for your time and your insight. Coming up on the show, New York's first legal marijuana dispensary is open for business. We're going to get the details next. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Anna Edwards is off today. Kaylee Lyons on her way to join Matt Miller and Lisa Abramowitz for surveillance in the next hour. In the meantime, New York's first legal marijuana dispensary opened its doors yesterday. And Matt Miller, he was there. This is his report. Take a listen.
This is exciting. For the first time ever, you can buy weed recreationally, legally in New York State. I'm downtown right now in Greenwich Village, actually on the corner of Astor Place and Broadway, and I'm in a Housing Works. It's the first dispensary to open up with the new New York license system. They're selling 100 products from 6 brands, and all of the proceeds are going to go to charity to help the homeless, to help people with HIV, what you typically know from Housing Works. In total, 8 nonprofits have been given licenses by New York State to sell weed recreationally, and another 28 individuals who are either incarcerated because of the war on drugs or had a family member or from a community that was affected by the war on drugs. Those people are going to be allowed to make money, and it's obviously a very big business. In fact, HousingWorks says they want to make about $1 million in top-line revenue in the first year, but it looks like they're going to do that in a couple of weeks, maybe a month max. In terms of the tax revenue, New York State wants to make $1.25 billion over the next 6 years. There certainly seems to be demand for that. There's a line around the block. Now, there are a few headwinds. Of course, a lot of illegal dispensaries have opened up, you must have noticed, and there are weed trucks everywhere. Those are going to be shut down by the Office of Cannabis Management and the New York Police. The other problem is you have to have cash or a debit card. You can't use a credit card because it's still federally illegal. And on that note, they also can't import any weed from California or Colorado or other states where it's legal because it can't cross state lines. So they have to get it from New York-sourced farms. They've given out a total of 261 licenses to farms, and a lot of those are also minority-owned businesses, female-owned businesses, businesses that are owned by people who are negatively impacted by the war on drugs. And this is how New York is trying to make that better, right that wrong, as well as raise revenue for schools and for nonprofits. I'm Matt Miller. This is Bloomberg.
Well, Matt Miller there with a very excited report on the very first dispensary guy. It's pretty interesting, though. It's coming at such a crucial time because New York is joining about 24 other states to do this, where they're only giving retail licenses, like Matt said, to nonprofits, people with a cause at the moment. And I think that's a really interesting way to tackle this issue at a time when you do have this kind of divergence between the legality of it between the state and the federal level.
Yeah, we need to have a conversation with Matt Miller about his Christmas jumper selection, but we'll talk about that maybe offline. Yeah, if you think about it, this is the thin end of the wedge. This is how it starts, but ultimately this is an industry that will grow and grow and grow. And I think about it in the same way as I think about what is happening with gambling. States need revenue. There are some fairly clear ways that they can do that. Gambling's one, potentially legalizing marijuana is another. And I think this is going to be a theme that is going to continue to sweep across America.
It's going to sweep across America, and I have to say the timing, once again, is pretty interesting because, look, we are heading into 2023. The election is coming in 2024, the U.S. presidential election, which, once again, could change the way that the entire U.S. government is really made up. So if you are starting to see more and more pressure on the federal government to actually legalize marijuana, what happens when you have a brand new administration in the White House? I think that could actually complicate things even more for a lot of these businesses who are looking to kind of navigate.
Yeah, I think it is going to be tough to navigate, and again, I come back to the gambling industry, which is facing similar challenges as well. But demand is going to be huge, and clearly it is going to outstrip supply. So I'm fascinated to see ultimately how this all evolves and what pricing looks like. Maybe we're going to see inflation or deflation. I don't know which.
Yeah, well, either one. And I think following in that suit, when you made that gambling comparison, taxation becomes a big part of that as well. If you are sure about the surge in demand, you're probably going to be sure that you can make a pretty penny off of it as well. So let's see how the states react. It'll be an interesting couple of years.
Absolutely. It's going to be all about fiscal next year. We're going to be watching the monetary policy story. We're going to be watching how these markets. That wraps things up. Thank you for watching this year. We've really appreciated you joining us so early. This was the early edition of Surveillance. Ahead, Lisa, Matt, and Kaylee co-hosting today. Michael Purvis of Talonback Capital is going to be joining them. It's going to be a great conversation, some great guests. Have a happy new year. This is Bloomberg.
Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? And if we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers and may roll through some of the other sectors in the economy.
Even if we see growth hold up okay, we don't fall into a recession.
We've never had a recession without the claims data going up.
We're expecting a mild recession, but we don't think that it's going to last long.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good riddance, leaving behind the worst year in more than a decade. Good morning. This is Bloomberg Surveillance on Bloomberg Television with Kaylee Lines and Matt Miller. John and Tom both off today as we herald the last trading day of a year.
Finally.
To forget, Kaylee.
It has absolutely been a year to forget, and that is true if you were invested across asset classes. Worst year for stocks since 2008. Worst year for 60-40 portfolio since 2008. Even longer, I believe, for global bonds. It has been absolutely brutal in a way that no one saw coming at this point a year ago.
But not no one, right? There were some people who knocked the ball out of the park this year. So if you were short rates, for example, you were on fire. So I think a lot of people had pretty good 2022.
Okay. Blockbuster if you were short.
Yeah.
An absolute travesty if you were long.
Yeah.
Even more of a travesty if you were long tech stocks, right? With 35% average decline on the NASDAQ 100. The key question is, how much do you pivot, sorry to use that word, for next year? Because how much do we see the worst of it versus just the beginning?
Yeah, this is actually what I've been thinking about a lot lately. How important is the change in the number at the back of the 4-digit year? I mean, the calendar change doesn't necessarily mean you have to change your strategy, right? Maybe you wait to pivot until after the first quarter if you get, as one of our guests is going to tell us today, executives throwing the kitchen sink at it in Q1, saying, all right, the consensus is for a recession, so we're going to throw everything in Q1, and then maybe it looks better from there on out.
Oh, this is the consensus, right? And Kaylee, you've been talking about how despite some of the optimism that we saw out of economic data, despite the optimism that we've even seen from a number of companies, we haven't seen that Santa Claus rally. We haven't seen the typical year-end melt up, and you've heard about tax selling, you've heard about a lack of liquidity, but there's something else going on as well.
Yeah, I mean, it would be really tough to convince yourself it's okay to be long after a year like this one. To your point, it's been brutal if you were long. And to Matt's point as well, yes, the calendar changes. All of the problems we've been dealing with this year don't just magically go away come January 1st. You are still going to have a Federal Reserve that is going to continue hiking, at least in the first quarter, an ongoing war in Ukraine, still questions around the COVID trajectory in China, and corporate earnings that have not actually seen those estimates falling in a material way yet. And everybody says those got to catch up at some point.
A lot of negatives. The one positive that perhaps people will point to, and it's a big one, is that perhaps we've seen inflation peak, right? And that has been the big question
2022 was the year of inflation, the fastest pace of inflation going back 4 decades, and we have seen it roll over and continue to do so, Matt. How much is that enough to give people the oomph to keep going and be sort of a bit more constructive?
Well, I guess it depends on a couple of things. A, it depends on how quickly you think inflation is going to come down, right? The Spanish data that we got this morning was surprising in that sense, and we've heard more and more people say they think it could be a rapid decline. You know, Ed Yardeni, for example, yesterday said it's probably likely that we could get a soft landing, or I think he might have said no landing at all, which would also be good, right? And then it depends on, you know, your belief in, your faith in the credibility of the Fed. Do you think that this Fed that Jerome Powell wants to be, you know, another Paul Volcker? Is he willing to do whatever it takes? I guess that's really Mario Draghi. Or, you know, do you think that he's going to fear high unemployment? He's going to fear a real contraction in earnings and then turn tail and cut rates and pivot even in this year?
We're not going to recoup 20% losses today because we're already down in pre-market trading. Just taking a look at where we're going to end the last trading day of 2022. You could see a mild decline in the S&P in particular, with shares down about 1/3% to start the day. You're seeing a bit of dollar weakness. Again, this is sort of interesting in light of the dollar strength. That was also a theme for a lot of this year, 106.77. 10-year yields up just marginally, 3.8482% to go out 4 digits. But just to start the year at 1.5% and to go to this level gives you some sense. If you look at 2-year yields, they started the year, they ended last year at 0.72%. They are now north of 4.2%. Just a massive exponential rise. And crude, fascinating to me to see the round trip in crude, $78.38 at a time when you have the war still raging in Ukraine, and you also have this concern about where Europe is going to get its supplies. But Kaylee, and I do have to ask this, really, how much does the entire inflation debate get colored by what we've seen in oil prices, what we've seen in natural gas, slumping for the most going back several months simply because it has been a warm winter?
Well, that's a very good point. Guy Johnson this morning was talking about how it's going to be T-shirt weather in Berlin on New Year's Eve, and that definitely has helped Europe on the energy side, where so much of the inflation, at least in the earlier part of this year, was coming from. But you have started to see it bleed into other areas of the economy. It's in services. That is what central banks are trying to rein in. So no longer is it just about checking the price of oil and the price at the pump. It has bled everywhere, and that is the concern.
Well, let's get a sense of where to go next year and how to forget the one that we just had. Michael Purvis joining us, CEO of Talbot and Capital Advisors. How bad was this year? In other words, how wrong did people get it, and what are they getting wrong heading into 2023?
Like, you know, from 2022, what I certainly got wrong coming into it, you know, was the persistence of inflation, which I underestimated inflation, which means I underestimated rates, which means I overestimated, you know, the PE that the S&P 500 would maintain. I guess what I've learned from this year, though, is that in looking into next year is that, you know, I think, look, the path to lower inflation in many facets of inflation is pretty obvious. You were talking about, you know, goods inflation contracting and gasoline prices and so forth. But the problem I have with us getting anything back to what we experienced from the few years leading up to last year, in other words, sort of a buy the treasury dip, which could, you know, means a buy the equity dip, is that there's new sort of, I think there's new structural inflationary forces that are going to come in to 2023, just as some of the COVID-specific or COVID-related inflation has really been sort of processed there. And those forces are relocalization of supply chains, and it's this new sort of theme of very structurally tight commodity supply there, and a general sort of sense of capacity discipline from a lot of the corporate world there. And of course, there's this lingering question about the employment structure in our country and all that. And so I think there's
going to be, Michael, I call it, when you talk about employment, we've been talking about NARU a lot the last couple of days. Does the Fed have to raise rates until unemployment is up near 5% before they can really get inflation back to the 2% target? Or is inflation naturally coming down? I mean, you're in Spain right now, and they had some pretty good data today.
Yeah, they did. They did. And gasoline prices here, I filled up the car yesterday. I was pleasantly surprised. there. Look, again, a lot of that is reflecting, the sell-off in many commodities that, we've been seeing here. But look, as it relates, if you look at the employment picture, the layoffs that we've been seeing have been coming from the places that you didn't get unemployment from in the last few years, meaning big tech, for example, right? And many facets of employment are really, really tight. Look at oil and gas hiring. It's actually been lower now than it was 6 months ago. So, that's a very robust sector. I know people in the oil and gas industry, you just can't hire people to get on oil rigs, even if they pay massive premiums to whatever they paid before. There's structural problems in the employment thing besides just the retirement issue there. We're going through a big, I call it revenge of the old economy, which means that a lot of the employment picture is very, very tight here. So,
well, on the point of employment, Michael, I was speaking with Eddie Vanderwalt, one of our Markets Live columnists, earlier this morning, and he says what actually he thinks people got wrong this year is how resilient the labor market really was going to be, that it was going to remain so tight, and that would make the Federal Reserve's job so much harder. If that continues to hold true, if what is objectively should be good news, that it's a resilient American consumer and American labor market, how detrimental could that be for risk assets?
Well, I think it depends on how, look, I think Powell's going to be resolute about the 2% target, and he's going to be hawkish so long as he sees signs of inflation, particularly wage inflation. That gets to Matt's question about the unemployment rate. I think there's a second order question though, which is, does he do it just by sort of violently signaling more and more rate hikes, or does he get to terminal sometime in Q2, 5.25, 5.25, pick your number, and just change past to sort of keeping it at that plateau level a lot longer, even if inflation goes down lower, even if the economy starts contracting, even if unemployment goes up. And I think that may be to me, it's a lot more about how he's going to be a hawk than, if he's going to be a hawk, because I think he's got to be a hawk. And again, I think sometime in the second half of next year, you're going to start seeing the effects of you look at capital utilization, it's at 80%.
Yeah.
That's pretty high by the standards of the last decade. If you get all this sort of capex boom from relocalization pushing up against that, that's going to create a new inflationary force that Powell's going to have to contend with. It's a different type of inflationary force than what he's used to dealing with, but I think it's a new thing. And if China does continue to reboot itself, that's going to put upward pressure on commodities there. So I think it's a very complex and nuanced inflation picture, but a lot of collapsing inflation and a lot of sort of new structural forces keeping the floor higher there, which means getting from, say, 3% to 2% is going to be tough.
Yeah,
and that's where I think he's going to end up, rather than getting to 5.5 and 6 and 6.5. He's going to more just keep it at a high level for a very long period of time, or at least by historic standards.
Michael Purvis, unfortunately, we have to leave it there. Have a wonderful new year. Thank you for all of your contributions to Bloomberg Television. Michael Purvis of Talbot and Capital Advisors. You're talking about all the different potential variables. I have to take a look. We were talking about a weaker dollar, and the weaker dollar, particularly versus the Chinese renminbi, is notable to me, falling to the lowest level that we've seen going back to September, 6.9067, a real dramatic move as you see this reopening and this feeling that perhaps the COVID cases, Kaylee, have peaked in Beijing and other big cities, even as they continue to spread in other areas. The fact that you see that economic activity just surging back, public transportation ridership.
That mobility data is what is so telling. We're approaching the Lunar New Year holiday as well, which traditionally pre-COVID was a big economic period for China. It's a question of A, whether that's going to drive more COVID cases, but B, do we see that revitalization and the spurring of demand in the second largest economy in the world?
Coming up, we'll follow up on that. 7 a.m. Dana Daria, co-CIO at InvestNet, will be joining us. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine.
Meanwhile, China has named its ambassador to the U.S. as the new foreign minister. The appointment of Qin Zhang is viewed as a sign that Beijing is moving back to a lower-key diplomatic strategy. Qin has delivered some of China's most moderate messages on hot topics, such as the war in Ukraine. And the U.S. may give Ukraine's ground-fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25mm gun. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. And in Canada, the merger court has cleared the way for the union of 2 of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. The ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
The problem is you cannot change the goalpost when you haven't won the game. And so changing the inflation target from 2% to 3% when you haven't achieved your objective would be a serious risk to the Fed's credibility.
Choppy road ahead. That was the take that we heard from Dalip Singh, chief global economist at PGIM and former economic advisor to President Biden, talking about what we're going to expect in 2023 with a Fed that seems determined to keep going regardless of what you were talking about, Matt, with a higher unemployment rate. It seems to be consensus that, yes, the Fed is going to do what it takes, maybe, but not too much. That's sort of the way that things are going down.
Right. I mean, every economist we talk to says, yeah, inflation could get up to like 4.7%, even if he or she says that Nehru is higher, right? If the idea is to fight inflation, especially in services prices, I'm no expert, but what I hear is you need to drive unemployment higher, which is pretty scary.
Meanwhile, the other thing that was sort of consensus, Kaylee, earlier in the year was this idea that because of inflation, you wouldn't see any kind of legislative spending. You wouldn't see fiscal stimulus. And President Biden just signed off on a $1.7 trillion funding package that increases the aid to Ukraine. And a lot of people, it has bipartisan support. A lot of people pushing back against this fiscal austerity and saying, no, they're going to keep spending because there is no legislative will to really reduce the deficit, despite some of the inflationary concerns.
When you have so much that needs to be paid for, I do wonder how that becomes more difficult when you do have a Republican House and a divided Congress come a week from now, come January 2023. And it raises the question as well, you know you're not going to have the support on the monetary side if we see a softening of the economy. If you don't have that fiscal impulse as well, what does that mean about support for the American people if we do indeed fall into a recession?
That's honestly what a lot of people are looking for, and yet it might be there anyway, despite the inflationary concerns.
Well, and we know that Congress is no longer just worried about inflation or about spending. They also have been very concerned over the course of the last week about Southwest Airlines, which says it will be resuming a normal schedule today after canceling more than 13,000 flights over the course of the last week. Let's get to Ed Mills, Washington policy analyst at Raymond James, for more on this. Ed, I do understand that if your constituents are frustrated and angry at a company like Southwest, you also have to express frustration and anger. But why has so much attention been paid to this? I have to wonder if it is tied in a material way to the fact that airlines, including Southwest, received so much aid during the early days of the pandemic.
Yeah, Kaylee, absolutely. I think when you look at this issue, you look at how much money went in the CARES Act, other COVID relief to the airline industry. You look at the capital management of the airline industry when it goes to resuming a buyback or a dividend. And then you look at the impact on individual lives. There would be two things I'm looking at from here. Number one, what does the Department of Transportation does? We have Mayor Pete Buttigieg as the Secretary of Transportation. It is very clear that he wants to run for president either this next election cycle or very soon thereafter. He has to show something for his time. He's had an infrastructure bill, but if he doesn't show that he understands and responds to this, that's a political crisis for him. The second thing I'd be looking for is the FAA reauthorization, which expires next year in 2023 on October 1st. And that's a great opportunity for Congress to add consumer protections or consumer rights, especially the requirement to rebook on another airline in an epic meltdown like we saw this last week, or what we saw earlier in the summer. Remember, this is not the first problem of the airline industry this year. So as we go into next year, there's a significant regulatory and legislative risk for the industry because of the performance and because of the bailouts for the industry from COVID.
So, Ed, does Southwest have to pay people before they pay their dividend? You know, they're scheduled to resume dividends, $400 million in payouts next month. At the same time, Kaylee just said 13,000 flights were canceled. That's like over 1 million people, right? So if you want to give them each $400, that's just about what they're paying in their dividend.
Yeah, I think it's, for consumers, for the political press, for the, kind of the financial press, that's going to be the question. Currently, the regulation, it's unclear how much you can really fine the industry. But I do think that this is a kind of a perception problem, kind of in politics when you're explaining you're losing. And so to have to say, why did consumers not work out the way in which they think that they should have? Why were they stranded? And why is the, kind of the shareholder getting compensated? That's going to create this political problem that I was mentioning, both at the Department of Transportation and within the halls of Congress. And we've seen in the past, kind of going against the airlines can be a very bipartisan effort. We'll work out the details, but, it's a big risk.
Well, they could adopt the kind of compensation legislation that Europe already has in place, which is, I guess, about that tune, 400, 500, 600 euros for this kind of issue. Let me ask about the other changes with the Republican Congress. Is President Biden likely to be impeached?
Matt, I think it's unlikely right now. We'll see where kind of the year goes. I do think that, the one thing that we are very likely to see in the House of Representatives is a significant uptick of investigations We'll see where those investigations go. I do think that a number of Republicans in the House will call for impeachment. Whether or not you can get to 218 votes, that magic number of a majority in the House, remains to be seen. I think you need to uncover something that we don't know right now before you get that. And then the question after that is, does that help out Republicans, or is there a further backlash? We've seen kind of political investigations certainly have political backlashes as well.
Everything we've talked about so far, Ed, whether it's the Southwest, whether it's the political intrigue in Washington, D.C., strikes me as window dressing at a time when you have the conflict in Ukraine that is accelerating, and then you have a reopening in China that's raising a lot of concerns about the possibility of a new variant. What's going to be top of the agenda when all of the Congress members get back to Washington, D.C. in January?
Yeah, Lisa, I've always thought that kind of the number one thing that we could expect out of a divided Congress is a tough on China bill. The most bipartisan thing in D.C., kind of putting aside some of these airline issues because we respond to the latest headline, is getting tough on China. The only place of political vulnerability is being seen to be soft on China. What that could look like is further tech restrictions coming out of Congress. Are we going to see any travel restrictions if we see kind of COVID spread further? You see that already reacting from the Biden administration, putting some travel restrictions on kind of inbound flights from China. We'd be looking at certain new kind of investment restrictions. Is there going to be a push for a ban on TikTok? There was a ban on downloading TikTok on government devices. How much does that expand? I think that's a top of the list to do, because a lot of Republicans and Democrats feel as if we still have a lot of concerns about the trajectory of China and kind of the investments that are going from the United States and the technology transfers that are going on from the United States into China. So, Lisa, that's probably the number one legislative accomplishment we could see in 2023.
Just real quick here, to end where we began, there is a question of whether there is this fiscal response to what people expect to be a downturn in 2023. Do you think that there is a political will to put more money into the economy despite concerns about inflation, even as soon as next year?
No, I think that the interesting thing over the last 3 years was arguably since the first time since the financial crisis, there was actually some level of coordination between the fiscal and monetary side. Oftentimes, the monetary response was because the fiscal side was so dysfunctional. I think we returned to some of that fiscal kind of brinkmanship on the debt limit, on entitlement spending. And I think I would add to that is a conversation about how much leeway does the Fed have on monetary policy side, is that you're starting to see a bipartisan group questioning the powers of the Fed. Why do they have this much power? Is the political window for the Fed to raise rates without a significant backlash to their future power closing on the Hill, Lisa? And that's what I'd be focused on as it relates to kind of when does the Fed kind of hit that terminal rate, because they don't want to lose their power after the 2024 election if they get this kind of deflation or disinflation kind of push wrong.
Ed Mills of Raymond James, thank you so much, and a great point to end, especially given that the unemployment rate, Kaylee, hasn't yet increased. So wait for that to happen before you start worrying about the political credibility of the Federal Reserve.
Yeah, and it raises the question, we know the politics of inflation are hard. The politics of a hurting economy and higher unemployment going to be very, very difficult as well as we get closer to 2024.
We're not there yet. We are, though, seeing a bit of softness to end a brutal year for those long equities, down almost 0.4%, 38.58 to wrap up 2022. This is Bloomberg.
I started, I had no idea it was going to turn into this, just a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. Talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
9.5 hours. That's how much is left in the last trading day in the United States for 2022. This is Bloomberg Surveillance alongside Keely Lyons and Matt Miller. I'm Lisa Abramowitz, taking a look at a tepid day. A lot of people probably are on vacation and already celebrating the end to the worst year of losses going back more than a decade. Joining us now to give us an overview and a state of play for where we are right now. Kriti Gupta is taking a look at markets. Kriti.
Yeah, Lisa, I'm sure a lot of traders have signed off and are not looking back after the carnage of this year, and today might not be any exception. You are seeing a little bit of red on the screen when you look at the stock market on both sides of the Atlantic. By the way, futures are down about 0.3%. NASDAQ 100 futures down about 0.4%. Go across the Atlantic, the stock 600, and you're seeing a little bit more pain there, down 0.6%. But what's something that was really striking to me is that overnight, Asia actually performed in the green. They performed positively. So you are seeing that regional divergence, which brings me to a little bit of a zoom out. It is the last trading day of the year, so therefore it is a day of reflection, Lisa. This idea, in the last 5 years, really in the last 2, you've seen this kind of complete move in sync around the world when it comes to equities. 2 years ago, 2018 to 2020, that was not the case. U.S. outperformance was 100% the story. And now, if you actually start to zoom really closely into what the case has been in the last, I want to say 2 or 3 months, U.S. outperformance is once again becoming the story. So I do wonder how much of that really translates into 2023, but it will probably be a function of what the cross-asset markets are doing, which means we should probably get a check on them this morning. The bond market, once again, not doing a whole lot. The 10-year yield at 3.85, yields up only about 3 basis points. Take a look at the dollar, actually weaker a little bit, not following the trend of yields, which I think is an interesting story, down about 0.3%. Most of that action a function of what's going on with the BOJ and the Japanese yen. And of course, we have to look at the Bloomberg Commodity Index. Nothing to write home about, really just unchanged. But once again, in the new year, that could be the game changer for a lot of the equity market.
Kriti Gupta, thank you so much. I'm really glad you talked about the U.S. outperformance, because a lot of people are thinking heading into 2023 that will reverse and that we actually could see, Matt, Europe outperforming. And I say this as someone who has spent a lot of time in Germany, the epicenter of the crisis that maybe wasn't as bad as people had expected.
Right, and Europe never outperforms.
No, exactly. It's the Widowmaker trade.
It's perpetually undervalued. Yeah, I think it's really interesting. Barbara Ann Bernard, founder and CEO of Windcrest Capital, joins us to talk about this. And I have always thought in times of crisis, Barbara, that investors would turn inward, only investing in the U.S. because things that are far away are scary. Did that happen at the end of this year? Do you not expect that at the beginning of next year?
I think that's happened for the last decade, Matt, and I think you're absolutely right. But what's different today is it's at an all-time high. If you take the MSCI All Country World Index, and that's a market cap weighted index, the U.S. comprises 69.7% of it. If you reweight the same index by GDP, the U.S. would be 20.5%. So what that tells me is investors are ignoring all of these wonderful bargains outside of the U.S. And I have this view that things can be very popular or very, but not safe, right? And so the U.S. is popular, but I don't think it's safe because it's expensive. So we find literally half the multiple, twice the growth outside of the US. And so for me, I feel safer investing outside of the US right now, and we're actually net short the US.
All right, net short the U.S., even though we're looking at 7% earnings growth? Or do you think that that's an overestimation by analysts because everyone is saying that there's going to be a recession at the same time?
Exactly. So consensus is at the index level is saying we're going to have an earnings recession next year, yet the analysts are still calling for 7% growth, as you say. So on back of that, you've got the S&P at a 17 times multiple, which is above the historical average of 15 times. And to me, that's completely unjustified. So I think what happens is in Q1 is companies come out and they kitchen sink 2023. And they didn't have to deal with 2023 until now. And this is I think they'll get realistic. So I think you'll have multiple compression and you're having EPS compression. And so that makes me nervous about the US market.
Although some people would argue that the US is in the best position, particularly for the transition of certain businesses in the technology world with the onset of the Inflation Reduction Act come next month. How much does that factor into your view? How do you push away some of the speculation that will actually draw talent and business to the US, away from Europe, away from other potential major economies?
I don't want to detract from that at all. I mean, the US is an engine of innovation, and that served it very well. What I think is a little different now is a higher cost of capital changes the businesses that get underwritten. And so this idea of winner take all, which absolutely worked for the last decade, I don't think works for the next decade. Peter Drucker has this quote, and I love it. He says, the heroes of the boom are the villains of the bust. And if you look at some of the worst performers this year, it's your Amazon, it's your Teslas, it was the darlings of the last decade. And so what I see is this regime shift. And that's where I get excited about the types. We're going to redefine what makes a good business model. And if your business model is contingent upon cheap capital, I don't want to go anywhere near it.
So which regions are you looking at in particular? Or is there a type of business? Is it Europe? Is it China with the reopening there? Or is it Japan, which is just seems to be emerging maybe perhaps from what has been a lost era?
So it's so interesting. If you want to make alpha, right, generate alpha, you have to be contrarian, but you also have to be right. The name of my hedge fund is Contraria, and as one of my investors pointed out, he's like, that's the stupidest name ever. I don't need you to be contrarian. I need you to be right. So what's contrarian and where can we be right? I'm actually not a fan of Japanese equities because I don't think a higher yen is good for the exporters. So I think I'm probably a little contrarian right there. I do like China. I like Indonesia, and I like Africa. India has been very good to us this year, but I think it was a beneficiary of China essentially being uninvestable because of the COVID lockdowns and because of the regime changes that they put in place, over the last 2 years. So I think this year money flows out of India back into China. And the reason I like EM is inflation is lower, growth rates are higher, institutional investors are not there. And as a result, they've lacked research coverage, which creates opportunity for people who really want to sharpen their pencils and do the work. So for active managers.
And I would imagine for emerging markets as well, the fact that the dollar's peak seems to have been firmly in, and we're looking at a dollar now at its weakest level since June, is a big factor in that too.
Absolutely. And that's when emerging markets started to take off, right? Peak dollar. And so that's good for commodities and it's good for emerging markets, and we're long both.
On the point of commodities and you being long them, we were talking earlier about the fact that we were, for a good portion of this year, talking about triple-digit oil prices. And we have essentially made a round trip. You're going to have a very modest gain for oil this year, and you haven't even seen the benefit of the reopening of China reflected in that market. To what extent is that actually going to kick in? Or are we looking at a trade that is now pretty exhausted?
Oil's a tricky one. China reopening, I guess, is stimulative for oil prices, but against a backdrop of a slower global growth. And then you have OPEC kind of controlling, pulling strings in the background. So I'm not an oil expert. The commodities that I prefer to focus on are ones with these huge tailwinds. So the green energy transition metals. And I don't have to go to emerging markets for that exposure. I can find companies like Solaris in Canada that are trading at 10 cents on the dollar per my NAV calculation, or Foran, which is the world's first green copper miner, also in Canada, which is completely de-risked from a funding perspective, but has all of the tailwinds of the energy transition. And the reason I like that is the copper intensity of the energy transition, I think makes up for any doubts I would have about depressed copper demand because of slower global growth. So it's a tricky year in 2023, but I think there are going to be lots of opportunities for active managers.
Barbara, the phrase of the year for me has been tax loss harvesting. I started hearing it at the beginning of the summer, and it's been increasingly used as we get to the end of the year, obviously, for obvious reasons. But if everyone's expecting a recession, right, and investors are managing to harvest some tax losses at the end of 2022, do we get a Q1 where executives say, all right, there's already expectations that are so low, I'm going to throw everything into this quarter. Then you have the bottom there, and investors who sold out for tax loss purposes at the end of 2022 can buy in to stocks they were convicted on in 2023. Does that make sense?
It makes perfect sense to me, Matt. I mean, I'm actually constructive about 2023. I think I can't wait to take the shorts off, but I think Q1 will be lumpy and bumpy, and I think China's reopening is not going to go as smoothly as people think. And so, even though China's had this huge run, I think there will be a pullback, and that'll be another opportunity to get long for the long run. But absolutely, I think Q1 is the kitchen sink, and then we reset expectations, and we can normalize from there.
Just real quick here,
so
Barbara.
A year of two halves.
To finish up on the point that you were making about active management, how this is going to be the year of active management, you say that it's the ultimate anti-bubble because of how much people have withdrawn from that in favor of indexing. Do you find that clients are willing to pay for active management in the same way that they were, say, 2 decades ago?
I think I think 2022 is going to change that conversation. You look at the NASDAQ down 33%. You look at the S&P down 20%. You look at a fund like mine that's flat. For 1%, you could have saved 25% of your entire investment. And so the 2022 is about just conserve capital. Because if you're down 25%, you have to be up 33% just to break even again. So the losers don't compound well. And active management is about active risk management. If you're an active manager, you can short, you can raise cash, which we did. Now you can go into these unloved markets, which is what my mentor, Sir John Templeton, always did. So there's always something to do if you're willing to trade away from the crowd and say, what is the opportunity? What is the opportunity that higher rates give me? Right. What it gave us was the ability to short consumers and stories all over, housing, car retailers, housing stock. So that was a wonderful opportunity. We didn't see it as a negative. And so, but for the last 10 years, you didn't have to. It was just, the big got bigger. And I think free money made that happen, and that game is over. So this is back to the future in terms of analyzing companies on the basis of cash flow, not eyeballs, not market share, and things that are sustainable in terms of self-financing. And this is healthy. This is a good thing.
Barbara Ann Bernard of Windcrest Capital, thank you so much for that. A lot of people have been talking about how it will be the year of active management. We've been hearing that for a while, of course, Kaylee. But this time they say it is different, especially because you did see the index underperform so dramatically some of the particular sectors, and a real divergence there.
Yeah, so maybe this time is different for a multitude of reasons. And we have seen, and we made this point yesterday, bottom up, you got it more right than you did top down. And I think that's an important point for this year.
Coming up, we speak with Justin Hugendorn, head of fixed income strategy at Hilltop Securities, talking about the fixed income picture and how that perhaps plays in to this idea of active management as well. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to obtain accurate data since the COVID-0 policy was lifted. Some tense moments over the South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says the American plane had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. In the Bahamas, authorities say they seized $3.5 billion worth of digital assets at FTX shortly after the crypto exchange filed for bankruptcy protection. The Bahamas Securities Commission cited a risk of, quote, imminent dissipation of the assets. That was based on information provided by founder Sam Bankman-Fried. And he was called the King and has long been regarded as the best soccer player ever produced. Brazilian star Pelé died Thursday after a battle with cancer. Pelé led Brazil to 3 World Cup championships. Later in his career, he moved to the U.S. to play for the New York Cosmos, fueling new interest in soccer by Americans. Pelé was 82. Global news, 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
I agree that there needs to be clear federal oversight here to really protect consumers and at the same time to be able to provide clarity for the industry to operate in the country. I'm going to be here for the long term. I have no plans to leave. That is not something that is on my horizon.
Well, it perhaps wasn't on his horizon, but it happened anyway. That was Sam Bankman-Fried, FTX co-founder and former chief executive officers, speaking to my current co-hosts, Kaylee Lyons and Matt Miller, right now, back on September 27th, before his company went bankrupt and he was arrested in the Bahamas, and now is being tried and potentially could be jailed for more than a century. This story has fascinated me endlessly, from both a psychological perspective as well as a question mark around the whole industry that both of you cover so intimately. Matt, I know you've been a huge Bitcoin enthusiast. You've seen a lot of people stick to their guns when it comes to a lot of the crypto assets that have had staying power, especially through all of this turmoil. Where do you see some signs of doubt creeping in that perhaps this was a byproduct or aspects of this market were a byproduct of the free money era?
I mean, I don't think you can completely disentangle the collapse of FTX from the underlying tokens, from crypto, the industry. However, what's been alleged here, and I don't know exactly what happened, seems like your average run-of-the-mill fraud that could have happened 100 years ago with a completely different asset. So I don't know how connected it is to Bitcoin. The fascinating thing to me is that this guy is clearly so intelligent, right? His parents are clearly incredibly intelligent, Stanford law professors, and yet he managed to lose billions and billions of dollars.
But his intelligence isn't in question here, right? And this isn't a matter
But
of
he should have
intellectual
been pretty
prowess.
good at math, right?
Well,
Right.
So
It was
this
not
is
a financial oopsie.
Right.
I
This
think we
is
can all believe
right.
that.
So this is the reason why people are alleging fraud. But there's, I mean, again, I just keep going back, Kaylee, to the larger question, which is this something endemic in an upstart asset class that doesn't have the same kind of regulation, that hasn't
Right.
been necessarily labeled as security in the same kind of way, and where there are people who are trying to innovate, and innovation can be conflated with out-and-out fraud.
Well, this is the question we have continually raised in the aftermath of this episode. If regulation had been able to keep up with this industry, would it have been preventing something like this from happening?
Regulators say no.
Exactly, because at the end of the day, if this was just about someone moving money around in ways that they should not have, and just poor
That's already
corporate
illegal, right? There are
controls-
regulations against theft.
Right. So it raises a question of how much this is just an industry that is moving too quickly for anyone to catch up to, and how much of this is just a bad actor at a certain level. The other thing I will say is the lack of due diligence on the part of more traditional players in venture, and people who backed him, and us in the media as well. Matt and I conducted that interview with Sam Bankman-Fried, 2 months before all of this came crashing down? So there's a level of just feeling like it's opaque.
It did cross my mind to say,
ways.
why are you in the Bahamas? If you're such a champion of regulation and the law, why are you offshore?
Well, it's a fair point. And Kaylee, the fact that you mentioned venture capitalists, and you mentioned some pretty big investment firms, including massive pensions that had invested in this. Again, and not to be extremist here, but it raises a question about what else was not sufficiently sort of cross-examined before invested in. You know, I mean, again, how much are we seeing the outgrowth, the ramifications of the free money era and venture capitalists who had more greed than they did
If Sequoia
fear?
bought this, like what else have they bought?
Exactly.
You know?
And what about the other companies and the valuations? And I think about Elon Musk and how much he bought Twitter for, and I think about other sort of asset classes.
Remember
Exactly.
those? Yeah, no, and this is a really interesting conversation to have with Ed Ludlow as well, who covers all of these different parts of the technology world. He is in London at the moment. Ed, how much of this is, as Lisa says, a symptom of money no longer being free? And how much of it, at least for crypto, is because of these individual seismic collapses of different projects and exchanges and massive players?
Well, I think to your point that you guys were just discussing, we had loads of venture capitalists on the show, right, just to address that one point really quickly, who did invest in FTX, or even some entities in the world of crypto that received money from FTX. And they all say the same thing, that he was incredibly impressive, his PowerPoints were sort of solid and airtight. Prima facie, he was legit. We will discover in due course if the allegations against him are true, and he just, was simple defrauding. Really important story out of the Bahamas in the last 24 hours that the Bahamian Securities Commission has seized $3.5 billion of assets from FTX Digital Markets, which is interesting because it's the Bahamian registered entity. And the reason that that's so important in this story, guys, is we're still trying to find out where the holes are, where the money's gone, where the assets have gone. And remember that John J. Ray, when he was in front of when he was in front of Congress, said, actually, I'm really worried about this situation because I don't think that international customers will get their money back. The US might, but this $3.5 billion does relate to that international business.
And it's a fascinating story, specific unto itself. But I do have to broaden out, especially with your expertise in the tech industry.
Sure.
Kaylee was just talking about venture capital and the other investments that were made, particularly in the tech space. We've seen a 35% decline in the NASDAQ 100. Do we have a sense of the scope of losses within tech venture capital with some of the new investments in the private companies that perhaps have not been fully marked down yet?
Yeah, it's really interesting. I heard Matt talking about how you can't unentangle the story with crypto this year, whether that be digital assets or crypto-related stocks or VC-backed firms that are operating in the underlying technology. The fact of the matter is that we started this year, January of 2022, with the global market value of all digital assets at $2.5 trillion. And we've been so focused on SBF and FTX in the last 2 months, we lose sight that we'd already dropped from $2.5 trillion in value to $1 trillion by June of this year. Think about all the other things that happened, the collapse of Terra USD, the SEC opening an investigation into Binance, well before FTX filed for bankruptcy, well before Binance came out and said that they had some concerns about FTX. It's been a very volatile year, and a part of the story has been directly linked to the Fed. and the path to higher rates, because no matter what the debate, where there is a debate, about Bitcoin's role as an inflation hedge, the volatility we saw in equity markets and the pullback we saw in capital deployment, the private markets, that was part of the story. It's just that in that very narrow window at the end of the year, we just kept going to this 2-year low on Bitcoin where we've stayed.
Ed, what I find amazing about the FTX story, well, first of all, on Bitcoin, the stability has been unreal, right? Right. It just hasn't moved from where it came down to on November 7th. The whole story, though, the most fascinating issue in terms of the company to me is that there just weren't records kept, or at least John J. Ray III can't find them, right? And we still have yet to get even kind of a back-of-the-napkin accounting on assets and liabilities. You've got $3.5 billion, apparently, the Bahamas. They had an 8% stake, we know, in Robinhood. 370-some million were stolen. But no one has said, like, okay, there's roughly $5 billion in assets and $9 billion in liabilities, even after 8 weeks of the most skilled experts in the world going over these books.
You and I have been discussing this off camera for weeks, but also this morning. Bloomberg's done some great reporting around this, right? Remember, it was Zeke Foe who flew to the Bahamas, spent time with SBF in the living room, the famous living room, and SBF got a spreadsheet out, and they went through it together, the Bloomberg reporter, Zeke Foe, and SBF. And they identified together in that process what we believe to be $8 billion in missing from the balance sheet of FTX, liabilities that FTX is unable to recover. The other piece of data that I shared with you, Matt, is that the CFTC's most recent filing, which stated that by approximately mid-2022, mid this year, FTX's internal ledgers reflected that the balance of Alameda's fiat liability to FTX totaled $8 billion. It's hard to know the relationship between those two $8 billion sums, but a lot of forensic work is going to have to be done as part of this legal proceeding against FTX. Good time to be a forensic accountant, I suppose.
Ludlow, perhaps, although perhaps it's someone's nightmare if they actually believe in accounting and keeping track of things. Ed Ludlow, thank you so much, as always, for joining us and laying that out. And really, it is a fascinating story. It is more than that. It's deeply painful for people who have lost billions of dollars, especially given what this was invested in. I mean, honestly, again, talk about the lack of accounting. Yes, it was invested in tokens, as you were pointing out, Kaylee, with an arbitrary value that potentially would be tanked if they sold it, but also Robinhood. He actually borrowed against this to make a significant stake, Matt, in Robinhood.
Yeah, I think, well, Robinhood is something that has, I think, intrinsic value. It's harder to pin that down when you're talking about cryptocurrencies. On the other hand, who leaves this much money on the exchange? The whole point is trustless, money. You should keep your own private key.
This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top end venture is sort of 3x net of fees. Ideally you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences, and so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers and may roll through some of the other sectors in the economy.
Even if we see growth hold up okay, we don't fall into a recession.
We've never had a recession without the claims data going up.
We're expecting a mild recession, but we don't think that it's going to last long.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's almost over. We can actually say that. The worst year for stocks and bonds in more than a decade. Good morning from New York City, the last trading day of 2022 for our audience worldwide on Bloomberg Television and Bloomberg Radio. This is Bloomberg Surveillance. Take a deep breath. John and Tom are taking a deep breath off today. I am so lucky to have Matt Miller and Kaylee Lyons in the seat today. I'm glad you sigh, because that's what it feels like. Although, what are we heading into? It's not like you can necessarily get a real break in terms of some of the trend lines that caused this carnage.
I'm excited.
The return level.
You know?
Okay.
Fish tonight. And then
that's
the big
still in
games
2022.
Tomorrow.
Matt.
Yeah, no, I'm kidding. I think. Look, it's been a horrible year. Obviously, if you are long or if you were long, but there are so many opportunities that come after big drops. Right? Look what happened in March of 2020. I distinctly remember being on the phone with my mother, who was in tears about her 401k, and yet just a few weeks later, we bounced all the way back.
Okay, but the difference, and this is the main distinction, the Fed was the put, the Fed was the driver. There still was free money. There was still this non-inflationary environment. We have seen regime change in 2022, Kaylee. This has been the year of inflation that we have not seen for 4 decades. This has been the year of generational increases in rates by the Federal Reserve and central banks around the world. Does that shift back to the normal of 2020 when your mother was crying, Matt? Or does this, Kaylee, lead to a new era of higher inflation and lower returns, certainly for stocks?
Yeah. Is this the start of a world in which we never see the zero bound again and money is no longer free? I mean, Matt, you talk about how we saw that massive rebound. To Lisa's point, you had not just the monetary policy backing, you had a fiscal backing as well. And if both of those forces
fiscal
go
backing
away,
of all time.
record-breaking fiscal stimulus, and granted, you could talk about how that contributed to the inflation problem we're now grappling with. But if you don't have either of those backstops, if we do indeed see a global recession in 2023, what force is going to bring us out of that?
About 3 weeks ago, I remember we were talking with different analysts, and they were saying, the biggest variables for next year are the reopening of China and whether or not the Bank of Japan loosens up on their yield curve control. Well, we got ahead of ourselves because we saw China completely release zero COVID, and we actually are starting to see economic activity rebound in some of the major cities. At what point, Matt, can we take a look at that? Can we take a look at the Bank of Japan that's buying a record amount of bonds to try to keep a higher peg in place for maybe a time when they release it? At what point will that create a new scenario that has not fully been priced in yet?
First of all, I've been waiting an hour and 2 minutes for you to bring up the Bank of Japan.
Well, here you go. Happy birthday and happy fish concert.
Well, no, I think one of the most exciting central bank narratives that we've had this year, including the Fed in its 450 basis points of hiking, I think the interesting argument for 2023 is, you mentioned the end of the Fed put, and Kaylee's saying, what's there to backstop us? Well, maybe the Fed put could come back. It's not necessarily dead. We were talking about Sir John Templeton earlier, and he said the four most dangerous words in the English language are, "This time is different." On the other hand, we've heard some pretty big investment celebrities like Howard Marks, for example, in the Financial Times, writing that this is a sea change. Mm-hmm. This is, Howard Marks says, one of 3 times in his life when things completely are different. The first being, the Michael Milken junk bonds era. The second being the low rates, Alan Greenspan era. And now this, back to, higher rates. That's pretty impressive if that's the case.
Right now we're looking at markets that are still reeling, though. And we have not seen any kind of capitulation in terms of seeing a brighter future over the past, certainly, couple of trading sessions. Right now, we're seeing stocks lower about 0.4%. You can see 38.56, despite some of the calls to end above 5,000 by some of the stock bulls. At the end of 2021, you could see a bit of dollar weakness. I do wonder how much this is because of yen strength in Japan, how much this is yuan strength from China. This is Asia kind of recovering and loosening up some policies, perhaps, is driving some of this. 10-year yields ending the year 385. Considering that they started the year at 150 gives you a sense of how far we've come. It's even more dramatic when you look at the 2-year yield. And crude, $78.34, a real sort of shocking departure from what some people were expecting at the middle of this year during the peak of the conflict with Russia invading Ukraine. People calling for $120 crude. Not so much. Heading into a tumultuous year next year, Dana Dioria, co-CIO at Envestnet, joins us right now. We're so pleased to have you. Congratulations, almost making it through. I want to start with one sector that got particularly beaten up, which was technology. And we have seen the NASDAQ 100 lose 35% and some of the components lose even more. This is the one dividing factor. Is this opportunity or is this more risk?
Yeah, it's a great place to start. It's interesting what's happened with tech. You look now and, risk on days, tech seems to do well and risk off days otherwise. But think back just even, to the beginning of this year and tech was sort of defensive. Tech had become, and last year, right, when we were looking at the pandemic, it was like, wow, tech is the place to be. That's the defensive posture. We've come a long way. And as you say, it's interest rates, right? It's what has happened over the course of this year, going from a free money posture to now we're back to return to fundamentals where there is a cost of capital. That's not going away, right? Even if the Fed does ease at some point next year and potentially even pivot, depending on how things go, money will still have cost to it. And I think that is a key point to understand about tech, because tech, of course, and growth in general has a lot of its value in the terminal value, and that gets discounted back by these higher rates now. So there's certainly an argument from my perspective. I wouldn't say don't go there, but there's definitely an argument from my perspective that expecting these highs again that we were seeing where, 22% of the S&P 500 in the top 4 stocks, I don't think we're returning to those days.
So if we're, if this time really is different from what we know of the kind of FANG decade, what else changes? For example, the U.S. domination in stocks. Barbara Ann Bernard earlier was saying she thinks that may be over for now, and at least she thinks there's real opportunity in Europe.
I agree. Look, I mean, markets are cyclical, right? And timing this perfectly, of course, is notoriously difficult. But if you think back the 10 years before this one, it was a lost decade for U.S. stocks, right? We all have recency bias. So a lot of our clients sort of have these portfolios tilted to U.S. and these questions come up after 10 years of, hey, should I even be in international markets? The answer is yes. You should be diversified in international markets. Unless you're somebody who's just so attached to your tracking error to the S&P 500, you can't tolerate that. And the reason, there are a lot of reasons for it. One is valuations, of course, overseas. One is the fact that, again, markets are cyclical. We've just went through a long period of U.S. dominance. But we also have changing economic fundamentals, right? We have deglobalization pressures, energy pressures, and pinpointing exactly who's going to be hurt the most by these things is a difficult thing to do. Your antidote for that sort of risk is to have your money spread across. I'll say one last thing. Dollar strength this year has been driving, a lot of the U.S. outperformance as well. Now, while I don't expect the dollar to collapse, I don't expect it to be as strong next year. I think as the dollar weakens and depreciates a bit in 2023, that also helps international.
What about China within international, especially as you were discussing deglobalization, Dana?
Yeah, China is such a push and pull, right? Obviously, you have, Xi now is potentially for life over there. And so what are the policies going to be? We saw, of course, the crackdown on the property sector. We saw a zero COVID policy. Now we've seen pretty much a reversal of those things, right? So out with the zero COVID to the extent where you now have countries looking at limiting Chinese passengers on flights. And, that reversal suggests that China reopens next year, could be a huge force, definitely a place to be. My caution there would be, yes, you want to be there as you want to be in any economy because predicting where that's going to go is difficult. But I would hedge my bets there. I would have a cap, right? You think about the weight that China was in the emerging index. That's a very high weight for the portfolio. I would think to, maybe cap that.
Just quickly here, since you don't think that big tech is going to return to the same kind of era, what will be the leadership of the equity market when it does resurrect itself?
Yeah, so short term, I mean, the traditional advice is to go for defensive sectors, something like consumer staples. Everybody still has to buy these things, notwithstanding that, the inflation has made that more painful. Those are the types of sectors that you would go in a defensive. I think another interesting one to think about, though, is energy and just where we're going to be in the next 5 to 10 years as we transition our energy profile. It actually, ironically, because you have less fossil fuel, digging new wells, et cetera, the prices there can go up, and that ultimately comes back to higher profits for the time being. So energy, I think, is an interesting place to look as well.
Dana Dioria of InvestNet, thank you so much. Have a wonderful new year. See you on the other side of what has been very difficult. I do think it's an interesting question, though, what will be the leadership, because people talk about energy because of the lack of investment, Kaylee. People say, okay, tech might not lead, but is there enough in the index to bring it up to the same levels that we saw if tech does not participate?
Well, especially when you think about the fact that, yes, tech has lost some weight this year, but it's still 25% of the S&P 500. The energy index is 5%. So that is not enough to carry the broader market higher, even if it does well.
But it's a huge piece of the stock 600, right? That's the idea. Over the last 6 years, every time I would ask somebody, why is Europe underperforming? They would always say, because it's all about tech. Europe doesn't have the Facebooks, the Alphabets, the Microsofts, the Amazons. But Europe does have the Royal Dutch Shells, right? Europe does have the British Petroleums.
Energy is still only 6% of the stock 600.
And you could argue that there also are policies in Europe with respect to windfall taxes, with respect to even nationalizing certain energy companies. If you take a look at Germany and what's happened there, would also create headwinds to the valuations of some of these energy companies. I just wonder how much we're looking at a new regime, because big tech didn't just mean investment in big tech. You saw those investments percolate into other industries as well, and you have to wonder what else retrenches if big tech doesn't recover.
It's a good point. Actually, yesterday we were talking about the job situation with regard to the tech layoffs, and I said, well, where are they going to go? And a viewer wrote in and said, hey, they can go anywhere right now, because you know what? They could work in autos. That's tech now.
Exactly. You could work at a bank. You could work in autos. How much are people going to try to bring up their technology, particularly at Southwest Airlines, which might be looking for some people to recast their entire system? Right now, we're looking at a market down 0.4%, 38.55 to end a tumultuous 2022. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over political and economic impact of Russia's struggling invasion of Ukraine. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was a push to influence crypto policy and build connections before FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. In the UK, a new poll shows the size of the challenge facing Prime Minister Rishi Sunak and his Conservative Party. The survey conducted by People Polling shows that Labour has a 26-point lead over the Conservatives. The next election is expected to be held in 2024. And in Canada, the merger court has cleared the way for the union of 2 of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. Now, the ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think what's really interesting about this market, it is so emotionally based and fueled right now, right? Like, you don't have investors actually looking at fundamentals and bottom-up analysis as much as they used to. So many investors were just wrong about what was going to happen in 2022, and they were overly bullish and things like that. Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
Will it be the year of the bear? This was certainly the year of the bear. Will it continue next year? Some people saying perhaps it'll be the year of the rebound. It's certainly in the second half. That was Sylvia Jablonski, Defiance ETF's Chief Executive Officer and Chief Investment Officer. And despite some of the optimism that we've been hearing from a number of people, right now, I just got a note from Torsten Slok over at Apollo, and he was saying the consensus sees a 90% probability of recession in the UK, 80% in Europe, and 65% in the US. And it has been rising, and this continues to point to lower rates rates on the long end. Kaylee, this to me is the interesting thing. You have a growing number of people saying the data doesn't suggest recession.
Yes.
And yet a growing number of strategists saying it is likely.
Well, it's a question of when the lagged effects actually kick in and how bad ultimately it gets. Because right now, I guess, the data is holding up. But we have seen such a rapid pace of tightening, 425 basis points in the span of 9 months. The economy hasn't fully felt the effects of that. So I guess if you are on team recession, you're saying just wait until it hits, guys.
And that would really bring back the idea of credibility for the Fed, right? That they can essentially shoot down inflation, which brings us to our next guest, an esteemed member of the Bloomberg Executive Team, Editor-in-Chief Emeritus for Bloomberg, Matt Winkler. You wrote a column that is fascinating, where you basically push back against all the people who are saying the Fed is just behind the curve. They're getting it wrong, saying actually it seems like they're bang on target.
Well, thank you. Great to be with you. Happy New Year. A year ago at this time, the prevailing narrative, as you say, was the Fed was behind the curve. Now, let's just go back and remember that 2021, inflation was 7%, and that's what prompted the outcry. And we also need to be reminded of the fact that the U.S. was making the most dramatic recovery from the pandemic recession, which was the worst since the global depression 8 decades ago. And we were getting close to what is now the 3.7% unemployment rate. So the U.S. economy was actually doing very well, better than any major developed economy in the world. And that's when the Fed decided, okay, the data is what drives us. We're data dependent. We're now going to tighten credit. And everybody said they were too late, too little, et cetera. And we know that. What happened, as you said, an unprecedented tightening, but a tightening that came when the U.S. economy was much stronger, resilient, than it otherwise would have been. And I think that's the parenthetical clause that's left out of this, is that the U.S. economy was much stronger when the Fed tightened. And so here we are today. Inflation is way below the 9.1% peak in June, when everybody said the Fed had lost its way. The bond market never gave up on the Fed. The bond market was always confident, somehow, some way, this inflation problem is going to be resolved.
Well, but the bond market got the Fed wrong at the end of 2021, right? Because we looked at a 2-year yield that was 0.7%. We looked at a 10-year yield at 1.5%. We saw a massive rise. People underestimated how much the Fed would have to do in order to combat inflation. Heading into 2023, how much credibility do you give the idea that we're in a new higher inflation regime that will cause a real question mark for the Fed in terms of how far they have to go and how much pain they have to inflict?
I'm not sure the bond market actually ever lost its way here. We're talking about maybe relative values, but the bond market was never convinced that runaway inflation was here, ever. And that appears to be still correct, okay? What the bond market, if you say, got wrong is it didn't expect the Fed to tighten to the extent that it did to contain inflation, but the bond market always anticipated that inflation would be much lower than many of our strategists and pundits have predicted. And so that's where we are today. The Fed is still going to keep interest rates elevated. They've already said that. And so the bond market is anticipating that we're still going to see, 5-6% inflation in 6 months. But a year from now, it's going to be much closer to the 2% target.
We talked to Ed Yardeni yesterday, who was saying that you haven't really seen anything break. You've seen implosions here and there in crypto notably, but there hasn't been any contagion across the entire financial system. And he said, maybe this Fed has gotten it right. They're probably closer to a soft landing, and there's a chance that there's no landing at all. Do you think that we're starting to see a growing view that we could have a very short and shallow recession, or even not have a recession?
Okay, so here are a couple things. A year ago, we were all concerned about supply chain bottlenecks, if you recall. And the ships in the port of Los Angeles, the largest port, were backed up as far as the eye could see. Maybe 65 ships waiting to unload their cargoes. When we caught up with Gene Soroka, who's the executive director of the Port of Los Angeles just a month ago, the whole waterfront was blissfully free of any supply chain bottlenecks. So there's an example where common prevailing assumptions a year ago turned out to be the worst as far as it went.
Right.
And now it's gotten better. So it's very similar with the rest of the U.S. economy, which is everybody you can think of was worried about a recession in July.
And paying double the price for used cars, right? I mean, prices were obviously that's part of inflation, just off the charts. And now we're looking at that in that market, used cars, I've seen it just collapse, right? We got data out of Spain, for example, today that shows inflation is coming down much faster than expected. Do we get closer to 2%? Are the break-evens right, you think, in a year?
Well, look, the bond market is a collection of everybody with the most at stake, if you want to think about it that way. So these are the people who have resources everywhere. They're betting their reputations and their fortunes, and they're all over the world. And treasuries are the most widely held security anywhere in the world and the most liquid. And that collectively is, as far as I'm concerned, the most, if you like, evidentiary way of looking at this equation, which is these people are saying somehow, some way, just as you said, Matt, the inflation that we've been seeing is not going to be runaway. It's going to decelerate in the months ahead. And by the way, the economy still ends 2022 up, not down, up.
Well, obviously, 2022 was a very hard year to predict, and so much has happened, including Elon Musk buying Twitter, which is another curveball that I don't think any of us saw coming. Back in April, another one of your great pieces was entitled "In Defense of Elon Musk's Managerial Excellence." Having seen now, 8 months later, what has happened to Tesla's stock, what has happened inside of Twitter since he took over, how, if at all, does your view change in hindsight?
Well, I never understood the Twitter debacle, if you want to call it that, from the beginning, and said so at the time. I think what's missing in the discussion of Tesla right now, which obviously has been the biggest casualty maybe of the tech industry, is that it's still valued more than Toyota. Okay, if you look at, and nobody mentions that, if you look at the market capitalization of Tesla today, having lost, what, 60, 70% of its value in 2022, it's still, what, $350 billion in market cap? And, you know, that's worth more than Toyota. So it's worth still after all this carnage. Now, why is that? I would say partly because the automobile itself is way ahead of where the rest of the auto industry has been. It is by far in the U.S. the most popular EV still. And, you know, that's the reality at the moment.
Even if you add General Motors' market cap to Ford's market cap to Toyota's market cap, Tesla is still worth substantially more.
Yeah, and so, okay, maybe that's all a mirage, but given all the carnage that we've all been talking about, I just think it's interesting. No one mentions that the market cap of Tesla today, okay, at the end of 22, is still worth more than Toyota.
Matt Winkler, fabulous to have you on with your perspective. Matt Winkler, editor emeritus of Bloomberg, editor-in-chief emeritus, coming to us with some really great perspective. Really interesting to point out, Kaylee, how the valuation of Tesla, yes, it has sunk, but not that far.
I wonder how much of that is a product of it being overly inflated in the era of free money, though.
Well, perhaps, yes, but also the future, and people don't talk about that as much. We will be talking about that coming up. This is Bloomberg.
Times and climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
The last trading day of 2022, and everyone is very excited about it. This is Bloomberg Surveillance live on TV and radio. Matt Miller, Kaylee Lyons, Lisa Abramowitz, Tom and John are both off today. They will be back at the start of 2023. Looking at a year of carnage ending with a whimper. Bloomberg's Kriti Gupta taking a look. Kriti.
Yeah, Lisa, the carnage continues in today's pre-market action. You are seeing some red on the screen. The S&P 500 actually accelerating some of their losses when it comes to E-mini futures, down about 0.5%. It gets worse when you look at the tech sphere. NASDAQ 100 futures down about 0.8%. What's interesting, though, is that across the Atlantic, stock 600 still where we left it about an hour ago, down about 0.6% and change. But I have to talk about the bond market, Lisa, because, of course, to your point, that's going to be a major story going into the next year. But I wanted to take a broader look at the 2s, 10s inversion specifically. We know it's been inverted for all of 2022. The question is by what margin? We're looking at negative 54 basis points this morning. But put this into some context, because if you're worried about 2023 and potentially 2024 being some sort of deja vu of the 80s, it's worth looking at this gauge, because we are at, like I said, negative 54 basis points. Compare this all the way back to the 1970s to 1980s, where you saw inversions of negative 200. Are we actually there yet? And if you are betting on a deeper recessionary story, then this metric actually has some ways to go. And you would perhaps see that same argument in the credit market, where spreads are still not at recessionary levels. So perhaps some ways to go. But let's bring it back to today's trade specifically, because the bond market not doing a whole lot like the stock market is either. The 10-year yield at 383, only higher by about 2 basis points when it comes to the yield. To me, I think the story is really in Asia today. And yes, there is a story, even though it is the last trading day of the year. Copper is actually outperforming the entire commodity index, and that really comes with the Chinese reopening story. More and more people looking to copper as the gauge for the global economy, not oil, which I think is interesting, up about 0.2% today. And of course, the dollar-yen story, as the BOJ ramps up those bond purchases, the Japanese yen strengthens and strengthens. We're looking at 131.86 on dollar-yen, Lisa.
Kriti Gupta, thank you so much. And Matt, to your point earlier, you were waiting for us to talk about the Bank of Japan, ending the year really with the major Asian stories that people have been waiting for, coming well before people had expected them. This idea, the Bank of Japan is buying a record amount of JGBs this month alone, and yet the yen is strengthening because the market does not believe that it's actually going to go through with maintaining this, because it just seems unsustainable to continue with yield curve control.
Yeah, so I wanted to ask you about this. What does it mean that they've widened the band, right? So they've let the bonds float up to 50 basis points in yield, and yet they're spending so much money to keep them there. Does that mean they're not planning on widening it again? Because then why spend the money?
Well, basically, the theory is they don't want this to be an uncontrolled move. This isn't a market, right? These are bonds that have not traded. Where is the audience for this? So to the extent that anyone independent still owns JGBs, they're going to push against what the Bank of Japan is going to do, and they're going to demand the biggest premium that they possibly can, because why not? At a certain point, especially with the inflation target coming in above the target for the Japanese, for several consecutive quarters, Kaylee, you have to wonder, is this just the prelude?
And is this just a mess Kuroda is going to ultimately leave to his successor? Because he's out the door in April.
Yeah.
So
that would be so uncool, though, right?
Well, but that's actually one reason why people think that, because it's so uncool, that's the reason why people think that perhaps he'll do it earlier. This is one of the conversations that's percolating, certainly in the fixed income space, not only with respect to what happens in Japan, but also U.S. yields and how this could really trickle back, considering that Japanese buyers consist of a huge proportion of holders of U.S. Treasuries. Justin Hogendorn joining us now, head of fixed income strategy and analytics at Hilltop Securities. And I want to start there. How underappreciated, Justin, is the Bank of Japan's potential giving up of the yield curve control and the reopening of China and pushing long-end yields higher?
Yeah, I think that's a great question. And thanks so much for having me on the show today. But I think you were just talking about copper, and I think that the fact that copper is going up is a great sign. I think the fact that the Bank of Japan is pushing rates higher, that China's opening up, we are starting to see some good signs. So that's really good. But 2022. It was a ratchet year. I mean, basically what we're looking at is just, I like how you said it ended with a whimper. I just think, stocks down 18%, bonds had their worst year on record, with the Bloomberg Ag down 9.7%, the worst year ever for bonds, and the Bloomberg Ag was in 1994, where it was down 2.9%. So yeah, I think there's a number of trends around the world that we need to pay attention to. And 2022 was horrible, but I think there's better times coming for us.
Yeah, I mean, does that mean you get in on the bottom floor here, Justin? If you've had these huge declines, it's almost like there's nowhere to go but up. Certainly in fixed income, it feels that way. Is that too dangerous a bet to place right now?
No, I actually don't think it is. I believe that we are going to go into a recession in 2023, but I believe it was here but not yet. In other words, we felt like we had a recession in 2022. We even had the first 2 quarters of the year negative growth, but it really wasn't. It just couldn't keep up with inflation. Unemployment wasn't going up. And what I think we're going to see, it's going to be a little bit more painful for the common man than what they've experienced so far in 2023. I think we are going to get that rising unemployment. I think we're going to get more negative quarters of growth. But from a financial markets perspective, I think we're going to see much better. I expect better for stocks. I expect it better for bonds and a number of others, even crypto. I think it's going to be better. But if you look at bonds, it's really, when you look at, okay, we probably had the low in municipals maybe that we would ever see. They lost 9.2% year to date in 2022. The worst year ever for munis, we're down 1.6%. But just about 4 weeks ago, municipals hit a cycle low.
Justin, you talk about pain that's going to be felt in the real economy with unemployment going higher, the common man struggling a bit more than they have. And yet you will talk about how there's going to be less pain in financial markets. So is that all predicated on the Fed reacting to that pain in the real economy? What happens if they do as they say they will and look through it?
I don't really. I think the Fed's got to talk tough, but I think the Fed's got a really soft heart. So they acted very tough, and they just demolished markets in 2022. They moved from a 0.25% upper bound in the Fed funds rate to 4.5%. That's just bound to crush markets. But ultimately, they have a benevolent heart, meaning that they don't really want to see that pain. They knew they had to create that pain or else inflation would get out of control. Paul Volcker was the best one that knew the power of crushing inflation. And the sin, or as a former colleague of mine said, stop inflation now, of allowing it to keep going. And people learned that in the 70s and 80s.
So,
however, now, sorry.
So if you think it's mostly talk and not actually going to be walk from the Federal Reserve, what does that mean for their credibility going forword?
Well, I think they've earned it this year. I think they've earned incredible amounts of credibility. So I think they're going to keep doing whatever they need to do to make sure they earn that credibility. They're going to talk tough. They're not going to bend, but I think they're going to pause here fairly soon. I think they'll probably go 1, maybe 2 more hikes. and then they're going to pause. And if we do start getting a recession with rising unemployment, I think that's when they really start to turn the ship. But I think that's also when they can say, at least temporarily, they've beat inflation. And so but in the 70s, we saw a double sort of headed monster of inflation. I think it's different today. I don't think we'll see that. My base case is for that not to happen, but the Fed's got to be aware of it, and they're going to have to be on their game.
What about risk assets? Are we going to see some bigger sort of pitfalls, particularly in junk bonds, considering that people do see some sort of deterioration in the economy, and we haven't really seen it yet in spreads?
Yeah, I think corporate defaults is more like the common man. It's not like anticipating like the financial markets. What it's doing is we've seen levels down significantly. If you look at the Bloomberg Credit Index, it's down 16.5% just on a price return year to date. So these companies, and there's a lot of prices in the high yield market in the 30s and 40s, and when par is 100, that's not a good sign. And so really, we had unnaturally low default rates in 2020 and 21 due to the government support. Okay, so all money, the government was supporting businesses in its plans. And so essentially right now we have that turning around. We've seen it in a number of sectors, even in the municipal market, such as senior living, that the defaults have come up. I think better times will come because that's an important sector, but I think it's seen really tough times. I know you're gonna have Yafa on the show later. She's gonna probably talk more about that. But ultimately, I think like in the high yield credit market, we will probably see defaults. I know a lot of people are saying 2.5% to 3.5%. I'd actually go a little above that. I'd say 3 to 4% type of default rates in the high yield market. It's going to be tough. It's going to be tough for companies.
Tough for companies,
and
but perhaps
liquidity is drying up.
Tough for companies, but perhaps not a reprisal of 2008. Justin Hogendorn, thank you so much for being with us of Hilltop Securities. We do have a final number for 2022. Matt Miller.
Yeah, we're looking at a FTSE index because the UK and I believe Ireland have closed now. It's a half day as we go into the new year. Their full year figures are out, and the FTSE's up 1.2%. So it's a sea of red when you look across global indexes and how they ended the year. Right, we're down 20% right now on the S&P. We're looking at drops of 12% on the DAX. The CAC is down 9%, but the FTSE is up year to date, which I think is really interesting.
Well, and it comes back to your point earlier about the energy exposure, because energy is the one area really in the equity world that has done well, and it is a much larger weighting in the UK benchmark. It's 13% of the FTSE 100.
This is going to be an ongoing rolling day of tallies as we try to get a sense of what has happened and the counterintuitive moves, because that is counterintuitive considering especially what they went through.
Well, but cable's off, right?
Leadership. Yeah, exactly. How much is this really a currency move? How much is this really, inflation adjusted? You talk about, if you inflation adjust some of the revenue streams, it looks pretty bad. But if you just look at it on a nominal level, you're actually getting a lot more money. So right now we are looking at how much more do we have in the day? We've got about 8.5 hours left.
We're almost there.
The end of 2022. 2 p.m. close for bond markets. Coming up, we get the latest on COVID and the reopening in China. Lauren Sauer joining us from the University of Nebraska Medical Center. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, after a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. It's being called one of the most intense missile and drone attacks in the war in Ukraine. The barrage rocked cities across the country, including the capital of Kyiv. Ukraine says it shot down 54 of the 69 cruise missiles. Still, it's likely that Ukraine will ask Western allies for more air defense systems. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It has been difficult to obtain accurate data since the COVID-0 policy was lifted. Some tense moments over the South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says the American plane had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. And he was called the King and has long been regarded as the best player soccer has ever produced. Brazilian star Pelé died Thursday after a battle with cancer. Pelé led Brazil to 3 World Cup championships. Later in his career, he moved to the U.S. to play for the New York Cosmos, fueling new interest in soccer by Americans. Pelé was 82. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
If we see China really start to stimulate again, and it really depends on the flavor of that stimulus, if it looks more like infrastructure and the kind of old economy things they used to do, that could put upward pressure on commodity prices and thus kind of reintroduce the inflation risks into 2023 from a goods and commodity perspective.
Is China's reopening a tail risk or a tailwind? Cameron Dawson weighing in on the risk aspect, New Edge Wealth Chief Investment Officer. This has been one of the big questions, not only with respect to China and the economy, but also with respect to COVID. Do we have to care about coronavirus again? Do people have to start getting tested and wear masks? Lauren Sauer, I loved speaking with you. I saw your name pop up and I thought to myself, I really want to speak to you, and I hate that I have to speak to you because why do we have the reprisal of COVID yet once again? Associate Professor at the University of Nebraska Medical Center and Special Pathogens Research Network Director. Lauren, it is great to see you, and it is also terrible to see you because people are starting to get worried about a new variant. How much are you concerned about this? How much is that tied to sort of the mass infection level that we're seeing in China?
Yeah, it's a great question, and agree. Happy to see you and sad to see you because it means we're back to seeing large numbers of COVID. So I think for me, one of the biggest concerns is less that a new variant's emerging, and more about the just volume of cases that may be coming out of China. I mean, we've seen some numbers that look like the early days of COVID when we weren't even calling it COVID, and we were watching from afar to see what would happen in China. So I think the numbers of cases are what we're worried about seeing come into Europe, come into the U.S., come into the global environment. And if we do see new variants emerge, I think it'll be important to track what they are, what the subvariants are, and make sure that we can adjust our tools.
Lauren, can China be trusted to reliably do that and to count the cases, period?
I think it's not what we're seeing right now, for sure. We're not seeing the data we would like to see out of China, especially on the deaths, on the sequencing that they're doing. So they've reduced the amount of people that they're even testing. So we're not seeing testing data, but we also know that the testing is much lower than it was just a few weeks ago. And so I think the pressure has to be on China to share every single number they have, right? So what are the case counts that they're aware of? What testing are they doing? And importantly, what variants are they seeing?
Is it only the variants that pose a risk to the rest of the world if we are worried about it spreading once again? If no new variants emerge, how much of the population is going to be relatively immune or at least not have any form of severe disease because we've already had so many infections and vaccinations as well?
Yeah, it's a great question. I think that large numbers of COVID are problematic and dangerous no matter what, because the more COVID cases you have, the more likely you are going to see those severe cases and the deaths. So no matter what, we are going to have large numbers of cases coming out of China and impacting the global health environment, the global economy, and that can be really dangerous. I think anytime you have a less immune population, you're going to see the potential for variants. So even if we're not seeing variants right now, seeing those large numbers come out could impact the likelihood that we see a new variant in the future.
Lauren, how does the U.S. situation look right now with regards to COVID infection rates, specifically New York City, around the Madison Square Garden area? Because I'm going there tonight with 20,000 of my closest friends.
Not a selfish question at all.
Yeah, I would definitely recommend wearing a mask in Madison Square Garden. I think COVID rates are still quite high, and we're seeing a lot of ILI or influenza-like illness all across the Northeast and really all across the U.S. So it is a risky time to be in close quarters with people, and we're seeing a lot of illness still. So I think there's a lot of people who are worried about an ongoing COVID surge, and it's coupled with a respiratory virus season like we have not seen in several years. So it's not the safest time to be out in public, certainly without a mask, but just in those close quarters.
Is it ever going to go away, Lauren? I mean, it's been almost 3 years, right? And now we're adding all of these other, you've got the respiratory infection, people are worried about flu and pneumonia again. I've had, I think, 6 shots since March of 2020. Are we ever going to get over this?
I don't think COVID is ever going to go away. We're not going to get to zero COVID. And I think that's also part of what we're seeing in China right now. One of the things that we're hoping to see is that we get on a cadence similar to flu, where we're getting vaccinated on a regular schedule, we're minimizing the impact of the disease on our life, and we're reducing spread wherever possible. So I think we're still in this sort of peri-emergency phase where we're just figuring out how to live with COVID. It's still certainly quite dangerous, but as we get on that, routine vaccination schedule, as we get more and more data on how and when we need to vaccinate people, and as we come back to sort of believing in the science of vaccines and all of the other tools we've built in a very short amount of time, that hopefully we will be able to live with it in a much less painful way.
Hope is not a strategy. This is the reason why I say that is because we're talking about masking. We're talking about how you should probably be careful congregating with 20,000 of your closest friends. And yet I can pretty much guarantee that Matt Miller will still be at that Fish concert and he will not be wearing a mask, and neither will anybody else in there. I'm just going to suggest that. And if you take a look at a lot of the airplanes and you look at that, very few people are masked, and those that are given glances of what's wrong with you. Do you have the flu? Or, because we all want to get back to normal. So how do you change a culture that is absolutely opposed to masking and using some of the tools that you're talking about?
Yeah, I completely agree with you. I think that it has become very divisive to even talk about, let alone use some of these important public health strategies. I think we have to go back to the roots of explaining where the science comes from, why we use masks when we use them, and maybe the culture won't change. And unfortunately, that is something we may have to deal with. But I think that it remains an option for people, and it certainly remains the recommendation, at least for me. And I think it's important to keep making that recommendation, sort of normalizing that this is a choice that is safe for people to make and is not a political statement. It is a statement where you're saying, I need to protect my health, or I want to help protect the health of others, and I'm going to choose to do that. And so the more we can normalize that, the easier it gets to make that decision. I mean, I know masks are not, they're not the place people want to be right now, and that's completely reasonable to feel that way. And many people are making that choice, but it certainly shouldn't be that the people who do make the choice to mask are judged or are looked upon as making a poor choice.
Too late.
Lauren, just real quick here to finish up, what is the chance, in your view, of our being subjected to a pandemic like the one that we just went through with another mutation of the COVID virus?
I think our chance of going through another pandemic is quite high. I'm not necessarily sure that it will be with a COVID mutation or a variant of concern, but certainly we could see a pandemic with another virus or with a mutation of this same virus in our lives. The risk associated with these new viruses coming into our population just continues to grow, and so if we don't implement the tools that we've developed during COVID, and also some of the lessons learned, making sure that there are lessons learned and not just lessons identified, we will continue to be at risk for another pandemic.
Lauren Sauer, thank you, I guess, but also not thank you. I love talking with you. I love the insight that you bring. I hope that the worst case scenario does not come to pass. I'm sure we all do. Lauren Sauer of the University of Nebraska Medical Center, thank you so much. Have a wonderful new year. It is a little frightening. I saw you recoil, Kaylee, when she was talking about the potential for another pandemic. This is the fear that some people have with the reopening of China so rapidly without people who have been fully vaccinated. Although the good news here, just to sort of try to end on a slightly upbeat note.
That's nice.
The good news is, that's so sweet, right? The good news is that we haven't necessarily seen any kind of mutation that is unfamiliar to the rest of the population.
To this point.
God, come on, guys, help me out
that's kind
here.
of what she was alluding to. The
I know.
concern is the more it spreads, the higher risk that there is that it does mutate. I also wonder as well, just aside from new infections, have we really begun to understand the effects of long COVID on a large part of the population? Because
Probably the
that
answer
also
is
has
no.
implications for the labor market longer term.
Yes.
When we talk about structurally lower labor force participation, you still have people all across this country and the world who are still dealing with the ramifications of their infections.
So what is it about masks?
Well, I mean, I just don't like wearing a mask. It nothing to do with politics. It's just, I think, a horrible way to live life. And if it were just for me, I would rather get COVID than wear a mask. The problem is I don't want to spread it. I don't want to give it to my wife. I don't want to give it to my baby. I don't want to give it to my parents. So it puts, I think, a lot of people in a difficult position. But I think the more important question is yours, Kaylee. What are the ramifications of long COVID? I don't think we know, and it's scary.
And I think that a lot of people feel the same way as you do about masks, which is one reason why perhaps we're at a greater risk of certain additional virus spreads.
Isolation I like better. Isolation's
We can all get on board with isolation. Here's isolation in 2023 from New York.
No.
This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Going into next year, everyone is bearish, right? And we're going to have this massive recession.
It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers and may roll through some of the other sectors in the economy.
Even if we see growth hold up okay, we don't fall into a recession.
We've never had a recession without the claims data going up.
We're expecting a mild recession, but we don't think that it's going to last long.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Just hours to go before 2022 goes down in history books as the year of inflation, the year of bond and stock losses that we have not seen for more than a decade. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Television, on Bloomberg Radio. John Farrow and Tom Keene both off today. I'm so lucky to be here with Kaylee Lyons and Matt Miller. I'm Lisa Abramowitz. As we begin the journey, a few more hours, Kaylee, before we could try to write a new story of 2023.
Is it going to be better, though? This is the question we keep asking. We know 2022 has been absolutely brutal, and yet the same forces we have been dealing with all year, hawkish central banks, war in Europe, questions around China and the trajectory of the world's second largest economy, none of that goes away 3 days from now when trading begins once again.
Although, Matt, you've raised the point. It's been horrendous for the people who are long. It's been great if you've been short, and there have been a number of people who have been short rates and who've been short certainly certain equities. I'm thinking particularly of big tech.
Or long commodities.
Or long commodities. There are trades that have worked. The key that I'm wondering is, do we give up on the reversion back to the Fed put, to this idea of, getting back to an era that we had become used to, or are we embarking on a sea change that we're not fully aware of just
yet? I think it's a really good point. That's what makes the market, right? I wish I knew the answer, but the question is, are we in a new era? I was saying earlier, Howard Marks, he wrote a piece, I think, in the FT saying, like, this is one of the 3 sea changes of his life, and he's at least 70. So a pretty seminal moment for markets. Or do we revert back to low rates and free money? I really hope so, because as you know, I want this Dodge Challenger. I want to get, did I tell you about the Hellcat that I want?
No, but you can tell us all about it in the break.
So, and right now I'm looking at 7.5% rates on a Chrysler loan. So it's not really worth it for me. And I think a lot of decisions are being driven by that, right? You're seeing home sales come down at a pretty breathtaking pace. Yeah. So, and the same is going to happen with new cars. Prices are dropping for used cars. I'm really watching it very closely.
So you're seeing the impacts of tighter monetary policy showing up in some areas already, those very rate sensitive areas. You're not seeing it in the labor market in a material way quite yet. And ultimately, isn't that what the Fed needs to see?
Well, and this is the issue, right? This has been one of the big questions. You've had an incredibly tight labor market. The initial jobless claims, the last ones to end 2022, didn't really show a material loosening in terms of people getting laid off, at least not those who can file for jobless claims. That said, there is a question about the structure of this labor market, right? And whether it just is just a fewer people who are able to work, whether it's long COVID, whether it's fewer immigrants insurance, whether it's the fact that people are retiring early. This all raises a question about what the reopening of China has to do with this and the global tightening cycle that has already taken place, Kaylee. How much can you say the U.S. is basically over, go to the rest of the world, versus the U.S. still can structurally be the leader?
Well, we're talking about structural changes here, right? If we're talking about structurally lower labor force participation, if we're talking about, therefore, structurally higher inflation due to a multitude of factors, how can we still put faith in a reversion to the previous norm if we are just talking about a different global economy than previously existed?
Yeah, and right now we're looking at a year ending with a whimper. We're seeing a bit of losses. As we end 2022, we're also seeing yields climb just a touch higher after a pretty amazing rise across the board, particularly on two-year yields, which have had a notably horrendous year. The weakness ongoing at session lows, 0.6% decline, 38.47 on the S&P, given expectations among the biggest bulls for above 5,000 to end 2022. So what will happen with the consensus being for next year to end the year around 4,000? We shall see. We're seeing a bit of dollar weakness, 106.77, 10-year yields climbing just a bit, 385, considering that it started the year at 150, and a bit of softness in crude, $78.10, down about 0.4%. Will next year be the year of the bond? Eric Knudsen joining us now, multi-asset class CIO at Neuberger Berman. Eric, I want to start there because that seems to be one of the consensuses out there, that this will be a great year, particularly in government debt. Do you agree?
We do. And 2023 could continue to be pretty challenging for stocks, but we do think that we are at a bit of a sea change. I've been doing this almost as long as Howard Marks, and I would agree that the next period of time is going to be quite different from the last 10 to 15 years we've seen. And one of the key elements there is that rates have to be, in our view, structurally higher, associated with higher structural inflation. And the Fed's determination, and frankly, the capital markets need to have a real positive real yield across the government bond curve. The Fed is forecasting that rates at the end of this year are going to be 5-ish%. Growth is going to be 0.5%. Inflation is going to be 3.2%. That's a real yield of almost 2%. We haven't seen a real yield like that consistently for over 15 years. We think you should pay attention to the Fed, and this is a dramatic change from the environment we've seen over the last 10 to 15 years.
Do we see a pivot, Eric, in 2023?
That's not our expectation. The Fed, we believe the Fed and other central banks are going to need to maintain tight financial conditions through 2023. You see it with the Bank of Japan beginning their normalization process even earlier than people expected, and that then encourages the rest of global financial conditions to tighten. And now what appears to be an even more rapid and perhaps chaotic and disorderly, reopening by China, which could lead to more rapid growth, more robust growth from China sooner rather than later. That just adds to the need for global central banks to keep financial conditions.
Yeah, I thought about actually buying my Hellcat by shorting JGBs, but I can't get a borrow, and now with the yen strengthening, that would kill me.
Is there anything else you want to vent about?
No. I just think it's an interesting trade that now I understand really when I look at the yen right now, 131, why it's called the Widowmaker. In terms of in terms of what else to expect for 2023, where do you see earnings? Because this is something that a lot of people have flagged to us as maybe the most important part, certainly in the equity space, right? We're still expecting $210, $220 a share. Does that need to come in?
Absolutely. Well, so there's a huge difference in opinion between strategists and macroeconomists who are expecting a recession and who are projecting earnings anywhere from 180 to 210 or so dollars per share. And that assumes a recession and that, or even radically slowing growth, even if we avoid recession, that's normally accompanied by earnings declines of 10 to 30%. Bottom-up consensus Wall Street forecasts are still expecting earnings in 2023 at about $230 a share, up 4-ish%. Our view is that earnings have to come down from that $230 target percent. Whether they get to 180, we're not quite that bearish. We think that there are corporate management teams have various levers, especially in a more inflationary environment, to support earnings. But we think they end the year below the current $220 per share that we expect for 2022. And that's the last leg down. That's the last source of pressure on equities.
Is that more on the demand side that earnings pressure is going to come, or on the input cost side and supply?
some of both. The margins have to come under pressure. They're still almost at secular highs. That has to normalize to a certain degree. Corporate management teams, particularly in the United States, have gotten very good at managing margins, but they have to come down somewhat. So it's going to be a mix of both top-line pressure as well as pressure on margins.
When do we start to go back to a new normal, right? I mean, at what point can we reset and understand whether we just can expect low returns for the next decade in equity indices, or perhaps a reversion back to the Fed getting to low rates and some sort of pre-pandemic norm?
Well, we don't believe we're going back to the new normal of the last 10 to 15 years with low inflation, low rates, financial repression, et cetera. We think we're going to a more normalized rate environment with structurally higher inflation, in part because of a fundamental change in the relative power of labor versus capital, which you guys were just talking about, in part because of deglobalization, in part because of decarbonization, in part because of changing demographics and the changing role and relationship of China with major trade partners and with their domestic policy. So we don't think we go back to the new normal anytime soon. We're really going back to a more old normal, more typical environment. Doesn't mean there aren't going to be interesting opportunities. We see great opportunities in short duration fixed income. 2-year treasuries at 4.3% yield. They're battling with S&P 500 earnings yield. You haven't seen a comparison like that since 2007. Short duration treasuries, short duration investment grade credit, mortgage-backed securities, structured product we think will be very interesting this year. Within the U.S., we like value stocks, quality stocks, high dividend yielding stocks, money now as opposed to money in the future, that now you've actually got competition from the risk-free rate for your capital.
Eric Knudsen doesn't necessarily paint a particularly wonderful picture for returns for equities, but certainly the short term of the Treasury curve. Eric Knudsen of Neuberger Berman, thank you so much for being with us. Have a wonderful new year. It's hard for me to say, have a wonderful year after people come out and they're saying it's going to be really bleak. Matt, just, hide under a cover, hide under in cash, and that seems to be a belief. Cash pays something suddenly.
Yeah, it's also not so bad if you can get a decent return,
exactly.
Right?
It's actually probably the new, it's the old normal, right?
I remember hearing my parents talk about the Volcker era, and they weren't involved in financial markets, so they weren't exactly talking about the Fed chair, but they were saying there was a time when we had 17% mortgages, but we also got 12% on treasuries, And I always thought, man, I would love to own some of those. Now maybe you have a chance.
Well, yes, okay, but you don't unwind everything that's happened in between the old normal and the new old normal. And how do we get there, right? I mean, if you start to talk about, you had to pay 13% on a mortgage. Well, if you go back to that, Kaylee, what does that do to home values? What does that do to the availability of credit to people who are buying for the first time?
It wouldn't be good. That would be pretty bad, I think, is the general answer to that question.
Right, which is the reason why you've seen such a slowdown. But I just wonder whether you see sort of, big pops or whether it's just sort of a slow deflation like we've seen this year.
Yeah, it's a really good point. I was just looking at the 2-year Treasury yield, which he was talking about, still at 4.4%. That's below where the Fed says it's going to be.
Right.
I mean, shouldn't those come more in line?
Well, people think that the Fed's going to cut rates, which is exactly your point, Matt, that the Fed's going to cave. And whether they do, of course, remains to be seen. We'll get a view on how much people continue to spend despite some of the inflationary headwinds. We'll speak with Dana Telsey coming up, founder and chief executive officer of Telsey Advisory Group. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. In Myanmar, Bloomberg's learned that deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison after being convicted of corruption. It was a final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. And in Canada, the merger court has cleared the way for the union of two of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. The ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I'm not going to tell you there's no risk of a recession. I think there's a 40% risk of a hard landing and a 60% likelihood of a soft landing. It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers, and it may roll through some of the other sectors of the economy. But altogether, the economy is holding up.
It has rolled through retailers, and yet consumers do keep spending, and it raises a question of whether it's already got kind of shaken it out in terms of how much pain there is to come. That was Eddie Ardeni Research President, with some optimism yesterday, talking about how maybe we just don't land at all. And this is something that a number of people have been talking about. I do wonder, Matt, how much we're going to end up seeing retailers kind of come back, because they've had so many years of underperformance. They've had so many years of consolidation. They're now actually not laying people off, and they now have the ability to be more flexible and nimble and start investing in some of the infrastructure that they've been needing.
Yeah, and I think, well, especially this year, we've seen some real differentiation, right? I think Tom called it bifurcation when I was watching surveillance, because some of them have been able to manage inventory well and others have not, and that has been a problem, specifically for Target.
And Kaylee, there's a question about just at what price people are willing to pay.
Yes.
And you've been talking about discounting. A lot of people have been talking about discounting. What does it take to clear out that inventory? And then how persistent is that? Is that going to be a trend, or is that just, a one-time thing to get rid of anything that's excessive?
It's the difference a year makes, right? Because last holiday season, we were talking about goods that were stuck on ships and on trucks and a supply chain that was a total mess. Therefore, there was such a limited quantity of goods, people were willing to pay up for them. Now it's entirely different. There's too much stuff that people, frankly, aren't trying to buy anymore. So they're less price tolerant. Let's get a take on this. Dana Telsey, founder, CEO, and Chief Research Officer at Telsey Advisory Group. And this is the exact dynamic that has led to an inventory glut in retailers like Target that Matt mentioned. Do we have a sense of the progress they are making in doing that discounting and working that inventory down?
Hi, how are you? Thank you for having me. I think overall, what surprised people coming out of the third quarter is that the retailers did make progress in lowering their inventory. There should be more progress made by the end of the fourth quarter. And as retailers report their preliminary holiday sales results, many of them the end of next week, the beginning of the following, watch for those inventory numbers. I think they did make progress. I think some of these markdowns and discounts that they have, even buy one, get one 30% off for some, definitely help to pave the way, but it'll still be at least through the first quarter, because don't forget, you need wholesale accounts to order, and wholesale accounts like the department stores are ordering very carefully, down around 10 to 15% from what I hear for the spring selling season, with the goal for both the brands and the retailers to get back in focus to promote less.
Promote less. So you're saying that that doesn't need to continue, even if we are looking next year at an economy that, if it doesn't fall into an outright recession, could soften, because in theory that also brings down consumers' spending power.
Keep in mind a couple things. When you think about the bifurcation of the consumer, the middle to high end still has dollars. They have dollars to spend. It's product innovation that drives demand. They'll be looking for bargains, and the benefit is going to be the trade down to the off-pricers. The lower to middle income consumer, you're going to see the Targets and the Walmarts move through inventory, and the focus on essentials will be even more for those consumers. So I think we should have not the same cadence of promotions, but the value offering will be even more dynamic than it was this year. They'll be able to get goods at more compelling prices, because you're not going to have, hopefully, higher gas prices like what you had last year.
Well, and the question also is whether how much people have shifted some of the supply chains away from China during this time, or whether the reopening of China will actually allow a lot of these retailers to buy goods at lower or more compelling pricing. Dana, how much have you seen a real rejiggering of where some of the clothing, where some of the items are being manufactured over the past 3 years?
We've seen a lot of rejiggering, and I think the ability to diversify from China has been in place for a long time. I think the change for 23 is going to be the cost of ocean freight rates, the cost of air freighting, and frankly, not even air freighting as much goods in as they had in the past. What's going to be sticky is higher labor costs. That is not going away. What is going to moderate is going to be those supply chain costs that should give retailers more flexibility. Promotions will be higher than they were in 21. They'll be higher than they were in the first half of 22, but hopefully we're not going back to 2019 levels.
It's interesting, you know, I was in Detroit a couple of months ago talking with Mark Royce, and obviously automotive is a little bit different than the retail that you're covering, but he was saying, look, we're not going to go back to the days of big discounts. We're not going to go back to the days of packed dealer lots. We're going to keep selling these products at MSRP, and he has to be confident that CEOs of other car makers are going to act the same way, right? Can retailers try and follow that same strategy, or will they undercut each other?
I think overall, when there's as much inventory glut as we've had, I think they're all being aggressive. You've seen after the holiday season what Target did with their clearance event. I think when Amazon had their second Prime Day in October, that basically opened the spigot for Target, Walmart, and Old Navy to discount aggressively. I think getting the inventories more normalized, you're not going to no promotions, but you're not going to have the burst of promotions with 70 and 80% off that we saw in some instances this year.
Dana, we were talking yesterday a little about pickleball. The rackets made in China are so much cheaper than the rackets made in the U.S. And today somebody on my Twitter feed mentioned Snap-on tools. They're also incredibly expensive, made in the U.S. compared to the Husky tools you see at Home Depot made in China. Is deglobalization really going to happen? Because the price differences are really pretty massive. And so I wonder, you know, if we go down that road, is it inflationary?
You're absolutely right. I mean, what we've seen is we've seen the ability to produce goods in China, and frankly, the quality, the speed that it takes, and the cost is lower. We've seen the focus on diversification, whether to South America, whether to Africa, whether to America, but managing price is key. Whether it's raw materials, labor costs, or shipping, I think China will always remain relevant. I think the percentage coming from China will continue to be reduced.
Dana Telsey, thank you so much for being with us. Dana Telsey of Telsey Advisory Group. Happy New Year. Have a wonderful end of the year. As we wrap up 2022, I just want to bring you a couple of things. Germany's stock market, the DAX, just closed officially for 2022, and it is down more than 12%, the biggest annual loss going back to 2018. Also, Kaylee, we are seeing a leg lower in futures ahead of the U.S. Open, with the NASDAQ now down more than 1%.
Yeah, and the steepening of losses in futures corresponds to a steepening of losses within the bond market as well. Yields just took a big leg higher on the 10-year yield. We're up more than 5 basis points now to just about 387. Obviously, liquidity is not abundant on this last trading day of the year, so we have to keep that in mind. Not even that big trades could lead to sizable moves, but basically this just caps off a year in which you didn't really want to buy bonds, you didn't really want to buy stocks, and your 60-40 portfolio performed the worst since 2008.
And you raised a question about liquidity. Suddenly we have a two-way market, Matt. I mean, that's something that's new. For a long time, it was don't fight the Fed. Now it's maybe don't fight the Fed, but what does the Fed want to do depends on the data. This is now a much more price discovery-based market after years of not having been so.
Yeah, well, that's obviously makes it more interesting for us and for market participants. You can have an edge. You can be a winner or a loser. I wonder if you're going to see a decoupling of the buy or sell everything mentality, because, if we see a sell-off in futures and bonds, that doesn't bode well for the comeback of the 60-40 portfolio, does it? Are we going to see that being more of a diversifying tool?
Well, that's the reason why some people are, that's why, again, it's two-way market, but that's why some people are saying that it's going to take the Fed actually seeing the data that suggests that inflation is coming down before they go fully into bonds. The long bond was a consensus trade a month ago, and then suddenly was less so as it rallied. People saying perhaps it doesn't offer the same kind of trade. But Torsten Slok this morning of Apollo, Kaylee, coming out and saying, look, when you see recession expectations going up like this, that actually is good for the long end, because that will ultimately be disinflationary, and ultimately people will seek out the haven trade of U.S. government debt as they have in the past.
Well, and maybe you also see a reflection of, if you do indeed see that recession materializing, the Fed's going to stop talking tough, and they are actually going to have to throw in the towel and turn the other way.
Although I do think that it's interesting, and this is something we've been seeing, that the NASDAQ has been losing more as yields go higher. How much more does that trade have to go in terms of big tech being more interest rate sensitive than the rest of the sectors? Right now, 0.7% decline in the S&P, heading for a 38.45 close for 2022, 106.55. A bit more of dollar strike suddenly reasserting itself, and 10-year yields 3.87, 3.87%. This is Bloomberg.
says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance on the last day of 2022, the last trading day, I should say, on Bloomberg Television, on Bloomberg Radio. Tom and John are off going through the countryside of the United Kingdom, looking for the perfect tot outfit for Tom. I am so lucky to have Kaylee Lyons here and Matt Miller as we take a look at a soggy day that is getting even soggier. Kriti Gupta has a check on those markets. Kriti.
Yeah, Lisa, the sell-off accelerating when you look at futures trading. The S&P 500 continues to see red on the screen, and it just gets deeper and deeper. Take a look at E-mini futures down about 0.7%. The stock market isn't alone. It's the bond market as well. Yields are now higher by about 6 basis points, 387 on the 10-year yield. And it's the dollar story, I think, that's starting to drive it a little bit. It is now following the move that you were seeing in the 10-year yield, which was not the story an hour, 2 hours ago. You saw that divergence. Now the dollar coming back a little bit, pressuring the euro, which was actually one of the top gainers this morning. We're now looking at a 106 handle on the euro, about weaker by just 0.1%. Once again, nothing to write home about, but it's that intraday dollar trade that is moving the market. I want to give some special attention to gold here because we talked about copper, we talked about oil, especially in light of the China reopening trade. Well, gold is very much a part of it. It is no longer the haven asset, especially as we go into January and the Lunar New Year. So that demand from China, watch gold and see how it kind of performs, because that could actually be the canary in the coal mine to actually see whether the China trade is indeed turning around. Well, let's bring it back to the equity market and the bond market as well, because it's the relationship between the two that's really crucial. Kaylee has been talking about the 60-40 portfolio nonstop this week, and I think it's really important to bring up because as we talk about that real yield getting juicier and juicier, for lack of a better term, the stock market loses its appeal a little bit. And you've kind of seen that this year. As the yields go higher, the stock market goes lower. Some of that is, of course, the effect on valuations and borrowing ability, and, of course, the effect on cash on some of these balance sheets. But I think it's also important to look at what it's doing underneath the hood to the sector basis, because as you see the yield once again go higher, think about what 2023 might bring for the bond market. The idea that it might create a bull case for the bond market as we start to see the Fed end that tightening cycle. But what it's going to do to the stock market as a result is actually hit some of those yielding sectors in the stock market. I'm looking at real estate, for example, consumer staples, utilities. And real estate, by the way, has really taken the brunt of the hit as we start to see the yield climb down about 27% year to date relative to an S&P 500 loss of about 19%. So you can really see some crucial underperformance there, whereas consumer staples, utilities, the dividends there have actually held up, Lisa.
Kriti Gupta, thank you so much. Let's stick with real estate. We talk a lot about individual single-family housing units and how much the sales of homes have slowed. The commercial real estate market is in its own world of hurt, since you have seen a real wholesale move away from office space, when you see also this question of where is the international investment going to come from? And parsing through all of that every day, Charlie Rose joining us right now, Managing Director and Portfolio Manager at Invesco Real Estate. So just let's start there with this question of just how much further do we have to reevaluate commercial real estate in some of the major metropolitan areas that used to attract investments from China, that used to attract investments from big companies looking for big office space?
Sure. Well, you spoke earlier on the show about the real sea change that we're seeing in the investable universe as a result of the departure from the zero interest rate environment. And so what we are seeing is that real estate investors are reevaluating their portfolios in this period of time and are really taking another look at real estate credit as a way to play the real estate industry. Real estate credit offers that deep subordination that provides protection from volatility in a potentially risky environment for valuations, as you've hit on, and also offers that immediate upside in a floating rate structure from a rising rate environment. So there is a significant amount of uncertainty in the real estate space. Some of that is very asset class specific, but real estate credit is a way that we're seeing a lot of investors try to play this current market environment.
Charlie, let's zoom out because we heard about some of the UK real estate funds that were frozen to withdrawals as a result of just how much people were trying to pull out. There is this question, especially as banks and pensions have traditionally been the investors in some of these properties, of whether money will be sticky and what the consequences will be if it is not. How much are you seeing a wholesale rethink in the investment space, in your space of real estate funds, in terms of what types of terms on withdrawals are placed?
Yeah, so withdrawals have been a hot topic. We've certainly heard you talking about it and others talking about it a great deal. I think a lot of investors are looking for liquidity and looking to understand how to play the difference between the public markets and the private markets. In our space, in the credit space, we have seen relatively limited withdrawals. In fact, actually, investors are looking to double down and increase their allocation into credit. Real estate credit in the U.S., private credit, is a $5.2 trillion asset class. So that's fully 25% larger than the muni market, about half the size of the corporate bond market. And historically, it's a segment that has been dominated by banks, insurance companies, and CMBS, and has been less accessible to the institutional or retail investors.
So, and Charlie, there's a real differentiation, as I understand it, between the fundamental business of commercial real estate and the value of commercial real estate debt, right? Because of the scarcity of the latter.
Yeah, absolutely. We have seen a real phenomenon. 2022 was 2 years in one. The first half of the year, we saw record-breaking transaction levels, both on the equity side and on the credit side. And that really dried up. And we are seeing the conventional lenders who dominate the market, banks, insurance companies, as a result of the rising rate environment, they're seeing far fewer payoffs in their existing portfolios. And so that's impairing their ability to make new loans. So that's really creating an opportunity for new entrants in the space. And it's become a true lender's market. As a real estate lender, you're benefiting from higher base rates. Spreads have gapped out, so you're getting that double impact from returns, and you can really name your terms in an attractive way: lower attachment points, lower detachment points, and better structural terms.
So what is the effect of the Federal Reserve's quantitative tightening program on your markets? Because they hold obviously a huge amount of MBS and agency securities, and I don't know how the knock-on effect is from that to commercial real estate.
Yeah, it's been very significant and it's been immediate. Certainly, real estate is a levered asset class, and we have seen in the real estate equity market, really the current dislocation is a capital markets driven dislocation. Fundamentals across the board have remained very strong. You talked about earlier on the show, how long does it take for some of the Fed action to trickle down to the real economy? We'll see in the real estate sector. But for the major asset classes where we're focused, the multifamily, single family, for rent, industrial, some of the specialty asset classes, fundamentals remain incredibly strong. Rent growth on a year-over-year basis is still in the double digits. Occupancy is close to record highs. Demand is above trend from a net absorption perspective. So what we're seeing right now is the rates environment really being where people are having difficulty.
Well, higher rates already have materialized. A lot of the softness that is intended to come with them hasn't yet. Charlie, how are you thinking about the risks of a recession?
Yeah, so other investors paying likely our gain from the credit side of the house. Risk of recession is certainly something that we're very focused on. We're global investors, and so we're looking in Europe, we're looking in North America. You talked earlier on the show about elevated recession risk in Europe. That already is creating opportunities to lend at a lower basis. With a higher spread in that market. So opportunistically seeing opportunities crop up there. And in 2023, we're looking for the same in the US as well.
What about in China? Curveball question.
Yeah, China is not an area where we've focused on the credit side historically. China is an important market for us and is one that we're constantly evaluating for the real estate credit side. Asia Pac, generally speaking, huge opportunity. Demographic trends are positive. But historically has been more dominated by local players.
Charlie, before we let you go, we're in New York City, and there's a real question of whether the urban centers that used to be havens for office space are going to come back in the form that they were 3 years ago. Are you a believer that there will be some sort of full occupancy at some point in the next 5 years?
Yeah, it's a really good question, and I sit here in downtown Los Angeles, which is even harder hit than New York City. The office segment, from a real estate investment perspective, first we should level set. It's a much smaller portion of the asset class than it has been historically. Within REITs, it's sub 6%. Within the Odyssey Core Index, it's about 23% today. We will anticipate that institutional investors will continue to pivot out of office. I think there is a lot of uncertainty about that return to office space. What we do know is that the best assets are performing very, very well. You can see that in New York City, the One Vanderbilts of the world getting record high rents and record high occupancy. But it's really a story of have and have nots in the office sector. And that's why we've been really focused on those asset classes where we have secular convictions, industrial, multi, and specialty.
Charlie Rose of Invesco Real Estate, thank you so much for being with us. A fascinating moment. And Matt, honestly, it's, to me, one of the biggest question marks because there have been so many changes. It isn't just interest rates. It also is the pandemic, as you were talking about, this question of whether office space is relevant. And then if so, what it looks like, because it's not going to be the traditional cubicles necessarily to draw in workers.
Yeah, that's a great point. I mean, you know, Business Week has done really good work on this year with a great piece on 3rd Avenue and the fact that the kind of office space that we have here is just not the kind of office space people want. I mean, Charlie made that point as well. One Vanderbilt has rents that are soaring, whereas a lot of big buildings on 3rd Avenue, even some relatively big ones, can't fill up their most important properties.
Yeah, and they're doing a study right now, I know in New York and other cities, in terms of converting into single-family housing units and what that will cost. And it actually is more expensive in some cases than just building a new building.
Than knocking it down.
To start, from start. So, I mean, there are real questions about what happens, even if you do try to change some of the zoning. Matt, I know you're going to leave us. Where are you going? What are you going to be doing on the open today?
I'm going to go on the open and we're going to focus on the last day of trading. Obviously, we've seen equity indexes start closing around the world. We have a gain of almost 1% on the FTSE for the entire year. We have the worst loss on the DAX at the end of the year since 2018, which isn't very far back.
I know.
But they lost 18% in 2018.
And I believe Dan Ives will be joining you, a great voice to end the year in terms of tech. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's being called one of the most intense missile and drone attacks of the war in Ukraine. The barrage rocked cities across the country, including the capital of Kyiv. Ukraine says it shot down 54 of the 69 cruise missiles. Still, it's likely that Ukraine will ask Western allies for more air defense systems. After a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to obtain accurate data since the COVID-0 policy was lifted. Some tense moments over South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says American plane had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. And British fashion designer and environmentalist Vivienne Westwood has died. Westwood became a star in the 1970s for her punk and urban style streetwear, staging runway shows in London, Paris, Milan, and New York. She was a lifelong rebel, honored several times by Queen Elizabeth II. Westwood was 81. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Expecting a mild recession. We don't think that you're going to get a soft landing. We think you're going to get something between a soft landing and a hard landing, but we don't think that it's going to last long. And the reason for that is because look at where we are from an employment standpoint. The labor market is extremely strong in the U.S. It's not going to be until the second half of the year that things start to slow down.
That was Kevin Nicholson, Riverfront Investment Group Global Fixed Income Chief Investment Officer, as we wrap up a tumultuous 2022. Basically, take a dartboard, throw a dart, and there is your forecast for 2023. That's what it seems like. Kaylee Lyons here. As John and Tom take the day off, a much-deserved break, we are seeing markets sag into the open here. Down 1% on the NASDAQ, Kaylee, and I'm really noticing how there's this weight to the tape, despite this feeling that you typically end the year with a little bit of a breath of optimism, especially after the worst losses in more than a decade.
Yeah, and we tried to take that breath yesterday. You actually saw a pretty decent rally for U.S. stocks, and yet we're giving a large chunk of that back today as we close out a year that has been so painful for equities. And it raises a question, Lisa, of when the calendar resets, how far away are we from things actually improving in the equity outlook? Because if you believe the strategists, which it's up to you if you want to believe them, considering how wrong most of them got this year, if you do believe them, there is more pain to come. We have not actually yet hit the bottom because we have not seen the rolling over in earnings. We have not actually seen much of the real economic pain that the Fed is in some ways trying to engineer.
Because it's the last day of the last trading day of 2022, we can talk in big sweeping terms, which makes me incredibly happy, and be all philosophical about markets. The paradigm shift that we've been talking about, right? This question of whether we're seeing a sea change, unlike what we've seen in the past couple of decades in terms of higher inflation and higher rates, raises really a question for the upcoming year of whether we get a normalization of the real economy doing better, even as equities do worse, right? Do we have to see some of the pain taken in margin compression that perhaps goes back to the real economy in terms of higher wages, in terms of continual investment in tech? And this is really sort of the perversion of using the stock market as a gauge of the economy, because it hasn't been for so long.
Yeah, that relationship is entirely broken. And usually this market is front running what is actually happening in the economy. It is looking far ahead into the future, but to your point on throwing a dart, no one actually knows ultimately what the future is going to bring. And as we talk about the idea of quote unquote normalization, it is one thing for inflation to cool. It is another thing for it to cool back to 2%. It is one thing for the Fed to stop hiking rates. It's another for the Fed to bring us back down to zero and for money to be free once again. We have to make a distinction between a cooling and an actual reversion to the previous normal, which I don't think that the market is really ultimately making that distinction right now.
Especially considering the fact that if we're not going back to free money, some of the investments that really prospered are not going to come back. And we talk about SPACs, we talk about certain tech companies, we talk about crypto assets, but we also talk about sports. And I know this sounds like a hard pivot, but if you remember 12 months ago, everyone was talking about owning a sports team and investing in, any kind of shoe of any type. I'm not talking from personal experience or from my sons.
There's bubbles of all kinds, right? But on the point of sports, as Lisa alludes to, there's been a lot of interest in sports, and sports collectibles has spiked in recent years, with investors pumping cash into new ventures like Derek Jeter's trading card business, Arena Club. Members can create online showrooms to buy, sell, and trade their card collections, and items are graded and kept at a central vault, with users receiving digital proof of their ownership for their collectibles. Earlier this month, Quick Take's chief correspondent Jason Kelly sat down with the iconic former New York Yankee player and his business partner, Brian Lee.
The trading card industry would almost seem like it was a secret society for years. Right. And now you're seeing Mickey Mantle cards being sold for what, $12 million. Yes. So I think now there's just a lot more attention to the industry. And that's why the idea of Arena Club came about.
Let's start with the news. You've got a lot going on with your company. What's happening?
I first met Brian, this was years ago, I think it's shortly after I retired, and everyone knows the success that he's had in the entrepreneurial world. And we started having a conversation about trading cards. And my parents used to have all of my baseball cards when I first came up, whether it was minor league cards, rookie year, and we had a flood at our house. So we had a lot of things that were ruined. A lot of the cards that I had collected, and a lot of times you try to build businesses, and it starts with, does it make sense? And this just made sense to me. And we're excited about Arena Club.
Yeah, we're super excited to join forces here. And the idea was to truly digitize the physical and to create these online showrooms for folks to buy, sell, and trade. We really wanted to bring to life the passion of card shows and card shops and so forth, and have people experience that online 24/7, anytime they want.
So we've seen some interesting sort of twists and turns over the last couple of years, especially with the digital aspect. How does the sort of NFT play into the business case here?
When someone sends in their cards to Arena Club to be vaulted into our system, we digitize it, we put it on blockchain, and you do get we're calling it digital proof of claim. Some people might call it an asset-backed NFT of that card. So it's a digital representation of the physical card.
And so obviously you have a little bit of a different relationship with trading cards. How did you view them sort of coming up as a kid?
Yeah, we've joked about this. I got trading cards just for the gum.
Yeah.
You know what I mean? But that's why we got cards. And I just remember sitting down, I was a big Yankee fan growing up. My grandmother, huge Yankee fan, talking about Babe Ruth cards that she had back in the day. And I just started collecting all the Yankee cards. And then, you have a dream of one day being on one. But look, you talk about having passion for trading cards. Brian's that guy.
Yeah, most kids stop collecting, right? But I just kept collecting in high school, college, law school, young adult, old adult. I'm still collecting today, so it's a lot of fun.
You know, Honest, I think, is probably one of the companies that people know you best for. You know, what do you take from those experiences that you apply here, Brian?
I think throughout my career of being an entrepreneur, I get very passionate about what I work on. And that passion bleeds into the team. It bleeds into the consumers. I think we're definitely building that foundation to build a company that will be around for generations for kids to enjoy.
Where is baseball right now? I mean, it's America's pastime, exciting season this season, but what needs to happen for baseball next?
Look, baseball in my mind is the greatest sport in the world, but look, you can't kid yourself. The younger generation, they want to see more action. You know, baseball, you can go 15, 20 minutes without seeing a ball in play. And the days of sitting down in the stands and talking to the person to your left and right, those are way gone, right? Now it's people want to be entertained. They're on their phones all the time. So you have to figure out a way to increase the action because it is entertainment. No matter how you look at it, people want to go and they want to be entertained.
I'm just a fan of the sport. It's my favorite sport. Nothing makes me happier than going to a ball game with my son and my family and rooting for my team. I think...
what team is that?
It's the Los Angeles Dodgers. Sorry, Darren.
That's all right.
He just wanted to press the point. It's fine. I'm a Braves fan, so like this is an uncomfortable table to be sitting around right now.
I can tell you everything the Dodgers need to do this summer. I mean, if Aaron Judge, if you're listening to this, hopefully you'll be a Dodger the next season.
Boy. Oh, good Lord. I feel like we're going to throw hands at this point. Anyway, guys, thank you so much for the time. It's really good to be with you.
Thanks for having us.
Quite a story, especially considering the fact that they were coming up with tokenized NFTs to represent the trading cards on blockchain. Honestly, this is something that I've noticed come up over the past couple of years, whether it's sneaker exchanges where you can trade your Air Jordans, or whether it's trading cards and creating a platform for them to have real currency value. Again, I just wonder how much this is an outcropping of free money and an era where people believed in modern monetary theory, and whether that will lose some steam. We have seen the sneaker resale market lose some steam, or whether this is going to have a real place because a lot of people bought those for more than just the gum.
Well, and it feeds back into the crypto world and the day trading world, the idea that people were armed with stimulus checks and a lot of lining in their pockets, frankly. We are living in a different world now at the end of 2022. So it's a good question. How much of that kind of behavior is eventually going to return, or was that just a moment in time when we were at the peak of free money and stimulus and we're not going back?
Some things to look forward to, considering that we are in the last trading day of 2022. Early next year, we get the beginning, maybe, not yet. The trading day has not fully opened, at least in the U.S. Taking a look going forward, you are going to get bank earnings kicking off, I believe, January 13th with J.P. Morgan. You also, in the next couple of days, in terms of the first couple of days in 2023, you will get retail sales, initial preliminary results, some early tea leaves. And for now, we have to leave you with a 2022 of tumult, of sea change, of inflation, heading into the unknown. We appreciate you watching for all of this time. Thank you. Have a wonderful new year. Coming up on Balance of Power on Bloomberg TV and radio, Kay Bailey Hutchinson, former U.S. ambassador to NATO, will be joining David Weston. Kaylee, thank you so much for being with us today.
Thank you. Happy New Year, Lisa.
Happy New Year. And we almost made it. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
From New York City, for our viewers worldwide, I'm Matt Miller in for John Farrow. The last trading day of what has been a horrendous year for those of you long. S&P futures down 2/3%, NASDAQ off, futures off 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
We begin with the big issue, turning the page on what has been a challenging year for markets.
It's been a pretty volatile time. You've had 10-year Treasury yields break 4%.
This bear market rally in recent months.
Inflation is still elevated.
The biggest factor this year has been man-made volatility.
Whether it's fixed income, equities, commodities, currencies.
We have a war, we have Federal Reserve, tightening rates, we have all types of things going on in the oil market that are beyond anybody's control.
What I certainly got wrong coming into it, was the persistence of inflation.
There's another shoe that has to drop, and that is the economy.
We should see a macroeconomic slowdown, particularly in the U.S.
We'll start to see some disappointment maybe as we move into 2023.
We don't think it's going to be necessarily a year of robustness.
Q1 will be lumpy and bumpy.
So I think expectations need to come down.
Joining us now, Invesco's Christina Hooper, as well as AllianceBernstein's Will Smith. Thank you both so much for coming to us on this, the very last trading day of 2022. And what a year it has been. Real losses across assets, not just equities. The S&P is down 20%, but you also have fixed income with its worst year on record, down almost 10% as well, depending on where you look. Christina, what happened this year? Is it really just all about the Fed fighting inflation and raising rates 450 basis points that's driven us down this far?
Absolutely. I mean, this has been a traumatic year. It hasn't just been about the Fed doing this, but it's been about the surprise factor. Keep in mind, the Fed didn't even expect to be doing this at the end of 2021. They anticipated that the median Fed funds rate at the end of 2022 in their dot plot would be about 90 basis points. So this has been an incredibly surprising set of jumbo rate hikes this year. And that massive tightening, along with other central banks in major Western economies doing the same thing, has really done a number on capital markets this year.
All right, so Will, what changes? I mean, I'm reminded of the phrase we heard so often during the days of big, huge CPI inflation. The best cure for high prices is high prices. Is the best cure for low prices going into 2023?
That's probably right, Matt. I mean, what we really need to adjust now to is an environment where the economy is going to soften pretty dramatically. And the Fed has really done a lot towards moving inflation lower. And really what we're going to keep an eye on is, as we now deal with a softening economy, have they done enough? And if we are to have a reasonably strong environment for risk assets next year, we're going to need to see signs that the Fed has accomplished their goals. And we need to see that really in the first half of this year.
What if you don't? I mean, you are the director of U.S. high yield, and we've seen a big buildup in high yield, in leveraged loans. Banks are pushing up their loan loss provisions. I heard UBS strategist Matt Mish saying that we could see default rates of 9% next year if the Fed stays on this aggressive path. What do you think?
We think defaults will be lower than certainly 9%. The market is essentially pricing in a default environment of about 3 to 4%, which we think is a reasonable base case. Now, it's important to note that 3 to 4% is significantly higher than where defaults have been over the last 18 months, which essentially defaults have been about 0 over the last 18 months. So we think 3 to 4 is a reasonable base case. We think 5 to 6 is possible if the Fed is not able to tame inflation very quickly and needs to get rates up to 5, 5.5 and keep them there, which should result in a deeper recession and worse credit losses. Now, even 5 to 6 is a pretty benign default environment when we think about a recession. And the reason why that's the case is because credit fundamentals have started this cycle from a position of strength. We haven't seen, particularly in the bond space, a lot of very aggressive issuance. The average credit quality in high yield is much better today than it usually is. And there isn't that problematic sector that causes or leads to a much higher default rate. That sector historically has been the energy space in 2019 and 2015 in particular. And over the last, call it 6 or 7 years, energy has made up almost half of the overall default rates in the high yield space. And as we know, energy is doing incredibly well right now. So you're not going to have, most likely, big defaults from the energy space. So where are they going to come from? And we don't see there being a big sector that's very problematic this cycle.
Christina, a lot of this obviously hinges on what Jerome Powell and co. do in 2023. And there isn't really a consensus in terms of whether or not they keep going. You mentioned the dot plot, right? They have 525, I think, penciled in for the median dot in 2023, and we're only at 450 so far. Or if they turn tail and pivot, a lot of people saying that's a possibility at the end of the year. What's your outlook?
My expectation is that they will pivot. Certainly they want to continue talking tough because they don't want markets to get ahead of themselves. They do, of course, keep in the backs of their heads the failure in the 1970s of getting the job done. So clearly that is going to influence how aggressive and hawkish their rhetoric is. But I think in terms of actual rate hikes, we're getting close to the end there. That will finish, the terminal rate will be around 5%, and that will be tolerable for the U.S. economy. That will enable the U.S. economy to avoid any kind of very substantial recession. I think any decline would be a modest one and be relatively brief. Again, a lot depends on what the inflation data shows us going forward, but all signs point to very significant improvement. That goods prices, that portion of inflation has improved significantly. We're seeing housing rolling over, and really what's going to be stubborn is wage growth. And I don't think we need to see the level of unemployment that the Fed anticipates. I think we could see a combination of job losses plus cuts in job openings, which are very, very high relative to historical norms.
All right, before we get too far into forecasting 2023, let's take stock of this year, as it is the last trading day in a year where we've seen loads of losses. Global stocks reeling from a record $18 trillion wipeout. Bond markets feeling the pain as well, seeing the biggest ever loss in market value. For more, let's go to Bloomberg's Abigail Doolittle. Abby?
Well, Matt, it really is pretty incredible. On a global basis, $18 trillion has been wiped right out of the system. Lots of different factors, including the COVID resurgence in China, the recession possibility here in the U.S. At the end of the day, though, I would argue that has everything to do with the global central bankers taking liquidity out of the system. So as a result, we have the MSCI World Index down about 19%, basically in a bear market, a global bear market. And then we also have bonds. Typically, you would have bonds rallying on a bid to safety. That's not the case. A global aggregate bond index, sovereign bond index, down 16% here in the U.S. As you know, bonds heading to its worst year since 1999. The S&P 500, the worst year since 2008. But take a look at the market cap loss right around the world. Now, India recently has had this hot rally that folks are paying attention to, so the losses there, the smallest. But when we move over to Japan, down 1.2 trillion, China minus 3 trillion. But it's really here in the U.S., those big losses, big tech down more than 30%. The USA losing $13.4 trillion in market cap for stocks. Now, I was mentioning that has everything to do with global central banks tightening right around the world, but especially here with the Fed, aggressive tightening, and next year appearing to be that they're still going to be on that same path. So if we take a look at the relationship between the Fed's balance sheet, which does in some ways also take into account rates, but it's more so just their balance sheet, you can see that we do have the Fed's balance sheet there in white and the S&P 500 in yellow, anticipating draining out of the balance sheet in advance. What will happen in 2023? Well, the last time that the Fed's balance sheet started to drain out, you can see lots of volatility. That will probably be another key word, volatility, for 2023, Matt.
Yeah, absolutely. That aggressive tightening as well as QT could lead to some explosions. Abigail Doolittle there from Bloomberg News. We did see some of those systems breaking in 2022. For example, the mini budget in the UK drove the pension funds LDIs, or exposed the pension funds liability-driven investments. Will Smith from AB, are you concerned about that kind of system breakage if central banks continue on this path? I mean, as I understand it, we're in a situation where the QE situation drove investors to search for yield so much that they allowed really lax covenants for borrowers.
Yeah, Matt, I mean, there's certainly a paradigm shift here. We're moving from an era of absolutely easy money and the central banks that were willing to be the big buyers of bonds. And it's unlikely that over the next few years and maybe even longer that central banks will do that. Money should not be quite as easy, and central banks will probably not be big buyers of bonds. And what that means is that liquidity is much more challenged, and that volatility is probably here to stay. I mean, one of the big reasons why the COVID situation realized such a quick rebound within fixed income is because the Fed stepped in and was willing to buy bonds. And given where inflation is, the Fed is more handcuffed this time, and they're not able to step in with emergency measures, most likely. Now, the most recent example, like you mentioned, in England, is slightly different, where I think central banks there were completely concerned that the system was about to break and implode. And so there does seem to be some sort of a put where central banks will step in, but it is fairly out of the money. You mentioned covenants. So money has, of course, flown into places like the levered loan space, into private credit, and to a smaller degree, the public market credit space. And that has resulted in worse terms for investors, certainly much lower yields. And that probably means that your recovery rate going forward is going to be weaker than has historically been the case. If you're a secured investor, there's now a lot of loopholes in these legal documents. So if you're a loan investor and you're relying on the fact that you have strong collateral, it might not be there when you need it. So we think the default rate in loans could be higher than has normally been the case, could be higher than bonds, and the recovery rates could certainly be lower than they have been historically.
Christina and Will, stick with us throughout this program. I want to quickly right now go to some breaking news, though. Abigail Doolittle, you have seen the headlines, you have seen the story on the Bloomberg House panel now releasing Donald Trump's tax returns.
Yes, indeed. Trump tax returns are giving us a first glimpse at the data that he essentially really fought to hide. And what we do know, returns show for federal income taxes paid, including $0 in 2020. The records go back 6 years of Trump's personal and business forms. And of course, this was from the House panel releasing Donald Trump, the former president's tax returns. You know, really a culmination, Matt, of course, of a years-long battle between the Democrats and the former president, who essentially exhausted all legal options. So we now do have a look at his financial records going from 2015 to 2020. Again, one highlight, including zero taxes paid in 2020. I'm sure we will be digging into this more as the hour and the day progresses, and we will be back with more, Matt.
Yeah, absolutely. I was talking to Ed Mills earlier, and he was saying that maybe when people realize how little taxes you can pay, zero is a very small number, with losses, you could see some changes in tax policy. On the other hand, there should be gridlock in Washington to come, so maybe that's a really big ask. Abigail Doolittle with the breaking news there. We're going to continue to cover this story as we get more details on Donald Trump's tax returns, the former president's tax returns released by Congress just now. Coming up, the economy paying the price for elevated inflation.
I mean, I still think it's an open question of, you know, will we have a recession? When will it be? How deep and long-lasting might it be?
That conversation, as well as more from Christina Hooper. Up next, this is Bloomberg.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and Radio.
I still think it's an open question of, you know, will we have a recession? When will it be? How deep and long-lasting might it be? So there will be some disconnect here between, say, where equity markets are and bond markets are. It'll be hard for equity markets to price in. I do think it'll become more noticeable that the rate of inflation is slowing.
Inflation obviously dominating the narrative for global economies this year, forcing the Fed and other central banks to raise rates, the Fed first with 450 basis points in 1 year, the others, in a sense, playing catch-up. Tight labor markets now keeping monetary policy on a hawkish streak and setting the stage for the recession debate. Team coverage starts now. Bloomberg's Kriti Gupta joins me alongside Abigail Doolittle here in New York. Kriti, let's start with you. What have you got?
Well, we got to look at this year in review, Matt, because this was really the year, as you pointed out, that inflation took off. But it didn't necessarily start in the developed world. It started really in the emerging markets. A lot of the exporting countries, when you talk about things like minerals, when you talk about things like oil, agriculture, that's really what started this whole thing. And you actually saw those central banks, likes of Brazil, for example, Mexico, actually start to hike rates first in an attempt to actually tackle this. Now, if you actually put this into perspective with the developed countries catching up, to your point, and also staying and kind of plateauing on that hiking path, well, you have to check out the commodity space, because as commodities come back down, these emerging markets have started to kind of see that inflation pressure drop faster than you are seeing in the developed markets. And this is really important as we talk about next year, how this really factors into the everyday person's salary, for example, food prices coming down, gas prices coming down, not just here, but around the world. And that round trip, Matt, is really going to play pretty importantly into the jobs picture and the affordability picture in 2023.
All right, so the commodities spike and retreat, very interesting indeed. Abigail, how do you see this? How did it play out in the markets you're watching?
Well, you know, it's interesting because we have a lot of eco data coming up next week, Matt, for the month of December. And what a wild year it has certainly been. And the Fed, on the one hand, has really cooled the market because ISM manufacturing is expected to come in below 50. We, of course, had the housing market coming in, a bit of a recession there, a quiet recession. But labor, it remains steady as she goes. Next week, we're looking for 200,000 jobs added in the month of December. And you can see back for this year, I mean, who would know that there was some sort of recession looming, given the fact that jobs are still well above, for all of the months except for December, if it comes in there, well above 250,000 jobs. That's a pretty healthy labor market. So that does suggest if the Fed wants to really cool the economy, they are going to have to do more. And in fact, if you see this jobless rate here at 3.7%, I mean, that does not suggest an economy in recession, Matt, to me. I don't know about you. So it suggests maybe the Fed really does still have its work cut out for it.
You know, David Rosenberg, I think I saw on Twitter yesterday saying, if this is the most widely forecast recession in history, why are analysts expecting 7% earnings growth next year?
That's a great question, Matt, because an earnings recession, that would really be a critical tell on some sort of actual recession. Now, I would say the housing market, again, it is in a quiet recession. You've had months after declines. It's not seeming to have any kind of ripple effect yet. But if we do, in fact, have the corporate profit outlook go into some sort of earnings recession, you could see a real problem. One period of time that comes into mind, 2000 to 2003, you had a very serious bear market, but you never really had a recession. You had a brief recession in 2001, but it was just a corporate recession. It did not affect two-thirds of the economy for consumers. Maybe something similar is developing here.
Well, in Kriti, yesterday we were talking with Ed Yardeni, and he said, yeah, you had a recession in housing. You know, you had a blow up in crypto. You had problems in different spaces here and there, but none of it really caused contagion across the entire market.
Yeah, and I think to your point on the earnings story, I think the contagion story is kind of brought below. But if you look at recession years in the past, the days or the years, I should say, that the recession actually starts for the everyday American, for example, those are the years that actually the stock market outperforms. So we're talking about earnings growth and potentially that kind of being, in theory, conflicting to the economic data. But at the end of the day, it's that anticipation where you see the carnage and then a complete turnaround. I think that's the hope for a lot of investors in 2023.
All right, Abigail Doolittle and Kriti Gupta, thanks very much for that. I want to get back to this breaking story now. A House panel has released 6 years of former President Donald Trump's tax returns. Terry Haynes of Pangea Policy joins us to talk a little bit about this. And Terry, you know, Abby told us one of the headlines, which is that Donald Trump paid no taxes in 2020. I believe there were a few years in his tax records before that where he paid no taxes because he had losses previously, and that seems legit, right? If you had a huge loss, you would probably want to use it to offset some of your tax liabilities. What else are we seeing in here?
Well, so far, I mean, you're seeing a lot of different things like not only the losses, but you know, some deductions that may or may not you know, stand the sunshine and the light of day.
private jet costs, all that sort of stuff. I mean, you're going to see, people are going to see a very unusual businessman and how that very unusual businessman navigated the tax code. And lots of folks will call these things in Washington, will call these things loopholes, and they're probably not loopholes at all. What they are the usual way in which those who navigate the tax code and have a lot of help to do it end up doing it. And I tend to think that at first blush, anyway, there's going to be a lot of kerfuffle about this, but not much comes from it. Politically, and I'll say this briefly. Politically, to me, it's just more evidence that that former President Trump has really jumped the shark. You've got, in a political sense, it almost certainly won't be the nominee in 2024 of the Republican Party anyway. You got a combination of kind of questionable moves by Trump politically, combined with the tax returns, and which will offend a lot of people for a lot of different reasons, even among supporters. Combined with the fact that now he's viewed as a serial loser, starting from his own 2020 reelect, going all the way through to the Georgia recount last month. So. I tend to think this is just more evidence that that President Trump's kind of in the rearview mirror here politically.
Is there going to be any fallout in terms of criminal law when it comes to his interpretation of the tax code? You mentioned, for example, deducting private jet costs, and I think your average woman or man on the street is thinking, I can't deduct, my car expenses or what I wear to work, for example, and this guy is writing everything off he can find.
Well, yeah, maybe. I don't think necessarily criminal, but there will certainly be some pressure on the Internal Revenue Service to want to justify its behavior if it in fact accepted a lot of these things without difficulty, and whether or not there was political pressure put on by the president himself or by the White House to the Treasury and the IRS to make that sort of stuff happen. But yeah, I mean, largely, I think you make the point better than I just did. Frankly, better. There'll be a lot of things where people say, well, I mean, honestly, can he do all that stuff? I don't like that he did that. I mean, regardless of the fact that it might be perfectly legal that he did it, but to me, it's another factor in the kind of the diminution of support that we've seen kind of go on over time, and that I think accelerates now.
As I say, we were talking to Ed Mills this morning from Raymond James, Terry, and he was saying you could see some push for new regulation for a rewrite of the tax code. On the other hand, with a divided Congress, the tax code isn't even in the realm of things that Washington can accomplish this year. Would you agree?
I agree with that. I agree with your statement completely. I always tell people it's never a good idea to look at the Congress as two political parties or Washington as two political parties. Look at them as four factions. Progressive Democrats, centrist Republicans, conservative Republicans. You get two or more of those factions together on something might happen. It's not going to happen with the tax code because Democrats want to push on that. What Republicans will push back with is fine. Then we want to make sure that the things that were temporary in the 2017 tax revision are now permanent. And that's about the last thing Democrats will want to do. So net, nothing will happen.
Terry, there never seems to be a real smoking gun. Are we going to find one here?
I think that's very unlikely, frankly. I'm going to make some assumptions here, but my assumption is that the president has a lot of good tax advisors, and there's a lot of people that are very used to threading these needles, and I tend to think that there's not anything here that can't be justified somehow, so that the worst possible case for the president is yet more drip negatively on these things, but nothing smoking gun-like.
Terry, really appreciate your time. Thanks so much for joining us on this breaking news. Terry Haynes talking to us about the Trump tax returns. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
This is a countdown to the open. I'm Matt Miller in for Jonathan Farrell. We are moments away from the start of trading on Wall Street, looking at futures that are reported down 0.75% on the S&P, down more than 1% on the NASDAQ. We've got some interesting bell ringers on this, the last trading day of the year at the New York Stock Exchange in Planet Fitness hats and what looks like a group of forest rangers over on the NASDAQ. There's the opening bell. Now, one stock to watch at the open today. First off, let me look at the euro dollar there. 106.75. Once again, every single day it's 106. You know, we don't need to include it if it doesn't change ever. The U.S. 10-year yield at 3.87. That's more interesting, actually rising a little bit to some relatively high levels there after starting the year at 150, and NYMEX crude at 78.42. Now, one stock to watch at the open, as I was saying, is Southwest. Again today, Transportation Secretary Pete Buttigieg ramping up the pressure following 13,000 canceled flights.
The U.S. Department of Transportation has your back. I'm disappointed that Southwest has not done more to proactively communicate with passengers. I'm assigning U.S. DOT resources to follow through on every complaint that comes in to make sure that you get compensated, and we will penalize Southwest as we would any airline.
I would have done that landscape instead of vertical. In any case, there's Pete Buttigieg, the Transportation Secretary. Southwest expecting a normal day of operations today, vowing to pay back thousands of customers over the coming days. The Chief Commercial Officer, Ryan Green, telling travelers, quote, if you had to make alternative arrangements like hotels, meals, rental cars, gas for rental cars, those will qualify for reimbursements. Bloomberg's Abigail Doolittle joins us now for more. Abigail?
Well, Matt, I am guessing folks at Southwest, including CEO Bob Jordan, they're probably wishing that this last week is a week that had not happened for them. I'm also thinking that some of them are wishing that they had invested in the technology that could have avoided all of the problems that they've had in terms of those more than 13,000 canceled flights. But now they are planning on paying back, probably some of this coming from pressure from the White House's Department of Transportation there, Pete Buttigieg, as we were just listening to, and maybe I would agree with you on that horizontal shot, but they are paying passengers for flight costs, meals, hotels, car rental. We all know what it's like in terms of T&E expenses at any workplace. Can you imagine what this will be like? But it sounds like it will happen. It could take weeks, though, again, for those 13,000, more than 13,000 Southwest flights that were canceled, far more than other airlines, having much more to do with, again, the technology and other issues as opposed to just the weather. But today, if you're flying Southwest, good news is there's only canceled They're only planning on canceling 142 flights. So as this story has built, Matt, they've really responded because this is a tremendous bounce back from relative to just yesterday, 2,600 flights, and in the days ahead, far more. Not surprisingly, some of the union representatives are really saying that it's not just the weather and the the technology. It also has to do with management, but that is, of course, rhetoric. More to come, but at least things are getting back on track and folks are getting back home.
All right, yeah, absolutely. Hopefully people are getting back home and starting to fill out those forms in order to get their reimbursement. Abigail Doolittle talking us through LOVE. That's the ticker, LUV, for Southwest. Now, big tech recording bigger declines. The NASDAQ logging its worst year since 2008, with some of the biggest names leading the way down. The FANG stocks and Microsoft, as well as Tesla, shedding trillions of dollars in market cap this year. Bloomberg's Ed Ludlow joining us now from London with more. So what a horrible year for big tech. And I guess the question that a lot of investors have, Ed, is do you get in now? Is it possible that they can't go any lower, or does this continue into 2023?
Well, you know, we hit a fresh low for the year on the 27th, which was just 2 sessions ago. We're down a full percentage point at the cash open on the NASDAQ 100. If we close lower this Friday, amid thin volumes, admittedly, it would be the 4th straight week of declines on the NASDAQ 100, its worst run of weekly declines since May, and what is the worst year for the NASDAQ 100 since 2008. I find it really interesting as well how all-encompassing this is. And you look at specific names, the semiconductor names like NVIDIA, mega cap tech stock, Apple, also having a pretty rough month of December. Interesting as well that this is the NASDAQ 100's worst year relative to the S&P 500 for 20 years. A big part of that story is energy, but I want to focus in on Apple because Apple, in the month of December 2022, this last month of the year, is its worst month of performance going back 4 years to May of 2019. There's been a lot going on with production disruption in China, in Zhengzhou, where Foxconn assembles the Pro models for the iPhone 14. But now we're also pivoting to concerns about consumer demand. I talked about this being all-encompassing, right? The story of the year is the Fed and higher rates and how higher rates discount the present value of future profits. Then you think about yields and where yields have gone. They make those tech investments less attractive, On your screen, you see the shed in market cap of some of those mega caps. Among them, Tesla, one of the worst performers on the NASDAQ 100 year to date. But so you and I used to talk about how those names in particular would be a little bit more recession-proof, right, Matt? They would have strong balance sheets, entrenched market positions. Going into the first half of 2023, whether we get an earnings recession or a real economic recession, there's a lot of concern that actually there's a bit more pain to come when it comes to equities, particularly mega-cap tech.
All right, Ed Ludlow, the perfect person with whom to talk about the terrible tech returns of 2022. We'll be coming back to you in just a bit to get your outlook for 2023, as well as you host the Bloomberg Technology Program. Let's get right now back to our investor guest, Christina Hooper, Global Market Strategist at Invesco, and Will Smith, Head of U.S. High Yield at AB. Thanks very much for sticking with us through the breaking news and the market open. Christina, let me ask you about big tech. I mean, after such an awful year, Tesla, for example, down 70%. Have we hit a bottom?
Well, I don't think we've hit a bottom yet, right? We haven't seen the downward earnings revisions that we all expect. But the reality is that a lot of damage has already been done by the rise of rates this year. And that has put an enormous amount of downward pressure on tech names. So from my perspective, this is an attractive opportunity, dare I say a blue light special, for a lot of the tech names for investors with a long enough time horizon. That doesn't mean piling in right now, but it does mean, I would argue, starting to dollar cost average in over the next few months, probably the next 6 months. At some point during that period, we're likely to hit our lows for technology.
Will Smith, speaking of blue light specials, I mean, that's really your wheelhouse in U.S. high yield at AB. How does 2023 look for you in your sector?
We think returns for credit for 2023 could be very strong. In high yield particularly, we think all-in returns could be 10+%. Now, that's not going to be a straight line in our view. We think the first half, as we move from this environment of being concerned about inflation to an environment where we're concerned about growth and growth being weak, leading to higher defaults. I think that probably means that spreads widen at some point, particularly in the first half. But that's a very good buying opportunity for investors. If we think about what the all-in level of yields are now, they're very compelling versus history. For instance, you can buy a 3-month T-bill today at the same level of yield that you could buy a single B-rated high-yield corporate bond in 2021. So investors are getting paid a whole lot more today when we think about all-in returns and capital. And high yield at almost a 9% yield, the levered loan space at a 9% yield, investment grade bonds at 5+% type yields. Those are very compelling opportunities for investors. And I think to echo Christina's point, if you're a long-term investor, you're going to be pretty happy with those returns. But it's not going to be without volatility in the near term.
It's a good point. Looking at the 2-year right now, 4.4%. That is not bad for risk-free over 2 years. Christina, if you're willing to go out a little bit further on the risk spectrum and not too far, as Will says, you're getting 5%, 6%, 7% returns. Does fixed income look like a great place for an investor to be in 2023?
I do believe it does. I think we want to be selective. I think we want to emphasize investment-grade credit as we head into 2023, recognizing we're likely to see some hiccups early in the year. But I think this is a time to also be looking at munis, also be moving into high yield. This is a very, very attractive environment, in my opinion, for investors, especially if they have a long enough time horizon. But don't neglect equities. I mean, one of the biggest mistakes, if not the biggest mistake made in the global financial crisis, was investors abandoning equities, locking in losses, and not participating in a recovery. So I think it's critical to be well diversified, both across asset classes and within major asset classes.
By the way, Christina, we've heard a number of investors tell us this morning on Bloomberg Television, look at Europe. Look outside the U.S. You know, don't recoil from the rest of the world after a crisis year. Definitely want to be diversified. What do you think about that?
I completely agree, Matt. This is a time to be looking outside the U.S. and ensuring adequate exposure, especially to areas like Europe, emerging markets, in particular China. While there are certainly risks to the scenario unfolding right now, I think there's an incredible amount of potential as the post-COVID reopening unfolds in China. There are a number of different markets where valuations are very attractive, especially China, and there's just an enormous amount of growth potential in China for 2023. So I definitely believe this is something investors should be thinking about and moving into. I notice also, Matt, my vision isn't what it used to be, but it looks like you're wearing a tie with bulls on it. Dare I say you're optimistic about 2023 as well?
They're zebras, but I understand. I also have an eyesight problem as I get older. Christina, thank you so much for joining us. Christina Hooper there from Invesco and Will Smith from AB. I wish you both a very happy new year. Hope you have a great weekend to start it off. Let's get to someone who probably isn't going to have the best 2023. FTX founder Sam Bankman-Fried. He met with senior White House officials at least 4 times this year before his crypto firm ultimately collapsed. Bankman-Fried's political ties coming under increasing scrutiny as he faces criminal charges. And we now find out that the Bahamas is holding what they say is $3.5 billion worth of FTX assets. Bloomberg's Kriti Gupta joins us with more on this developing story. Kriti?
Yeah, Matt, let's start with that later point. $3.5 billion that they are now holding on until the Supreme Court of that country says they can actually return the money to some of the creditors and some of the customers of FTX. This is something that the CEO, John Ray III, had actually warned about, that some of the international customers may actually feel a little bit more pain when it comes to getting the funds returned than some of the U.S. customers. This $3.5 billion could actually help with that. But at the core of this story is, of course, SBF's meeting with the Biden aides. You mentioned it, at least 4 meetings with senior White House aides that include Steve Ricchetti and Bruce Reed. Both are senior Biden aides. But of course, this is not the first time he has been in Washington. Him and his brother have both testified in front of Congress, met with SEC regulators, talked about philanthropy, and of course, some of the CFTC regulators as well. So this is just another kind of feather in his cap, as he's really kind of made the point that he is one of the ethical credible actors in the crypto space, really vouching for more regulation. Of course, he was also one of the largest political contributors to this election cycle, actually as following, by the way, George Soros, Michael Bloomberg, who of course is the owner and founder of Bloomberg LP as well. That makes Sam Bankman-Fried the third largest political contributor this election cycle. So really tied quite closely with Washington, Matt.
All right, Critty, thanks very much. We're going to obviously continue to get more out of this story throughout the next year. It's also going to be a tough year for Tesla.
If you look at some of the worst performers this year, it's your Amazon, it's your Teslas, it was the darlings of the last decade. And so what I see is this regime shift.
Or is it? When we come back, Wedbush's Dan Ives joins us to lay out what Elon Musk needs to do to get Tesla back on track. That conversation next. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Peter Drucker has this quote, and I love it. He says, the heroes of the boom are the villains of the bust. And if you look at some of the worst performers this year, it's your Amazon, it's your Teslas, it was the darlings of the last decade. And so what I see is this regime shift. And that's where I get excited about the types. We're going to redefine what makes a good business model.
Tesla staging a little bit of a comeback in the final days of 2022, but Elon Musk was definitely a villain this year. The stock, right now, seeing its best day, or yesterday, the best day in 5 months. It was a brutal year. The shares were down 65% year to date. Bloomberg's Ed Ludlow is back with us in London. And Ed Ludlow, the Peter Drucker quote, I think is perfect for Elon, although you could use it for a number of other of the big tech companies because they did so well previously, they've done so bad this year.
Yeah, I mean, we're in the last trading session of the year, but reading the reporting on the Bloomberg terminal, a lot of the sell side notes, what investors are saying, there is now this kind of worry about the global economy, right? Particularly the price points of EVs, not just from Tesla, but other newcomers. We're up a percentage point on Tesla, rising for a third straight day. That's Tesla's longest run of gain since the end of October, believe it or not. But it doesn't change anything because the stock is still on track for its worst month on record, its worst quarter on record, its worst year on record. As you point out, Tesla is down 65% year to date. Interesting going into the new year where Tesla's expected to deliver record deliveries for a quarter. Around 420,000 is what analysts are looking for from Tesla for its global delivery numbers.
In the quarter.
In the quarter, right. And you know, there's been lots of reporting about how Tesla has scaled back production in Shanghai. You know, that Reuters report that between January 3rd and January 19th, there would be a pullback in production, generally speaking, and then from the 19th onwards, they would pause production altogether as part of annual maintenance. That all said, there are concerns about demand going into 2023. Morgan Stanley had that note this week with Adam Jonas, right? They see the inversion where 2023 supply overtakes demand. You look at the worst performers as well in the NASDAQ 100 this year. Tesla, of course, a big name from a weighting perspective when we started the year on the S&P 500 and NASDAQ 100, but Rivian and Lucid are the worst performers, full stop, on the NASDAQ 100 this year. And again, I see all these concerns about the macro environment and the price points at which these startups are selling their cars.
Rivian's the truck I want, though. That R1S looks tasty. Ed Ludlow, thanks very much. Coming to us from London. He'll be back in San Francisco soon, hosting Bloomberg Tech. Right now, I want to get over to Wedbush's Dan Ives, keeping his outperform rating on Tesla, writing, quote, "We remain long-term bullish on Tesla, although Musk must start to change direction here. Otherwise, this situation could get even uglier." I'm pleased to say Dan is with us here on set. Dan, thanks so much for coming into the studio and joining us. It's funny, when Ed said 400,000 and change for the quarter, I remember when that was their target for the year, right? So I don't think we should lose sight of the fact that this is a company that has a market cap still bigger than GM, Ford, and Toyota all put together.
Look, it's one of the most transformational, if not the most transformational companies of the last 20, 30 years. But look, they're held to a higher standard from a multiple perspective. They get treated, and I believe they should, as a disruptive technology, not an auto player. And that's why what you've seen here, I think 70% of it is actually non-fundamental. It's Musk, Twitter driven. And that's why any sort of course correction in 2023 is what investors are really craving for.
Yeah, you know, the Peter Drucker quote I thought was good. The heroes of the boom are the villains of the bust. I've always thought of it, though, in opposite terms, in that you want to pick the worst performers to look at, you know, some real upside for the future. Do you see it that way with Tesla?
Look, the hearts and lungs of Tesla is Musk. Musk is Tesla. Tesla, you know, is Elon Musk. And I think right now, you know, clearly they're going to have some softening like you're seeing across the board in EVs going 2023. But ultimately, he gets a CEO in of Twitter. He actually stops selling stock and actually does it. And it's not boy that cried wolf. And they set what I view as sort of cautious expectations. This is a stock that could rip higher. And I think that's ultimately it, is that Musk has gone from a superhero on Wall Street to a villain. And this is really a moment of truth for him to sort of navigate through the storm.
But he's been a villain before. Abigail was pointing out to me the other day that, or reminding me the other day that, remember, there was a time when he, I guess, pretended he was going to take over Tesla for $428. The SEC, he got in deep trouble with them, and he kept egging them on. Nonetheless, he came back, and people seem to forgive him for that. Is this time worse? I mean, has he really gone off the rails here?
Look, I think for someone that's viewed as a modern-day Albert Einstein, Thomas Edison, it's more of a Howard Hughes type moment, right? And I think the question now is, does he start to focus back more on Tesla away from Twitter? Because that's really been it. It's a brand issue. It's been a black eye for Musk, a black eye for Tesla. But it goes back to investors. They want, this is a name they want to own as a transformational company. They just can't keep having Musk, because every time he tweets something, the controversy, it's created ultimately a black cloud for Tesla. And that's why I think this is different, because ultimately when you're at the perch, when you're at $1 trillion market cap, it's a lot different than being at 50 billion.
Yeah, his tweets are more, I think, Edison than Einstein. What stock, and because you're such a well-known tech bull, you cover the whole universe, which of these high flyers that has come down so much do you like best? I mean, when you look across, Apple, for example, came down to the lowest level that it's been since, I think, the summer of 2021.
Yeah, I mean, if there's one name, I mean, our top pick, it's Apple, because I believe it's not a demand story, it's really supply issues in China. On some of the parts, I still think there's a stock that could be a $200 stock. And ultimately, it's fundamentals continue to be rock solid, or what I believe. But I think right now, technicals and other, in tech, the New York City cab driver right now is bearish on tech going in 2023. Apple, in my opinion, is the best way to play. And then cloud, Microsoft, what I view as Redmond, that's still a rock of Gibraltar name, despite what the stock's telling you.
By the way, how have you gotten through this year? I mean, it must have been tough for you watching all of these big names come down. You have outperform ratings on many of them. I know you took Tesla off your best ideas list, but it was still an outperform. How do you persevere in this kind of bear market?
Well, I think institutional investors that have known us since the late 90s, it's really in times like this that you handhold. As you're going through turbulence, we did it in 01, did it in 08, 09, we're doing it again this year. And I think it's trying to find the sort of the golden names that I view, and I think it's really walking through stress testing and handholding, because ultimately, when stocks are going up and to the right, everyone could be a hero. This is ultimately what separates fork in the road, and that's what we love doing, is navigating investors through this turbulence.
So stress testing, I'm sure you're doing it in your head, mentally stress testing all of the stocks you cover every day. What are some of the headwinds? What are some of the black swans that, or I guess gray, in that year, thinking about them, that you worry about?
Ultimately, look, this is a Fed-driven Powell 10-year yield, as you talk about so often. That really ultimately, once the Fed takes the foot off the pedal, then you actually could see tech stocks and risk assets rip higher. I think going 2023 in January, it's okay, clear the deck on numbers. That's, I think, what a lot of buy side are waiting for. Then you actually know these are hittable numbers. But I think the biggest black swan is Fed and, of course, China. That's the wild card in terms of zero COVID issues, supply chain. And I think ultimately that, in my opinion, is it under-owned, as I've seen tech going back to 2009. And I just view it, some of these names, it's more generational in terms of the opportunities, given the risk rewards that we see.
By the way, I know you're a diehard Penn State fan, but you follow, obviously, college football across the spectrum. What are you expecting for the playoffs tomorrow? You got Michigan up against TCU and The Ohio State University playing Georgia.
Yeah, I think Michigan roll. It's a great TCU team, but I do think Michigan rolls with McCarthy and the team going through that game. And I believe, even though it's anti-consensus, I believe Ohio State and the Buckeyes win. And I think that's going to be a tough game, but I think Jan 9th, we will have a rematch of the game, Michigan-Ohio State, Jan 9th, SoFi Field. I think it's going to be great for Big Ten. I think Penn State also by a touchdown versus a tough Utah team in Pasadena.
All right. It gives me goosebumps to think about an Ohio State-Michigan rematch. It's exciting, but also terrifying for me as a fan from the great state of Ohio. Dan, thank you so much for coming in. It's been a pleasure having you here, and every time you come on this program. Good friend of the show, Dan Ives from Wedbush. This was the countdown to the Open on the final trading day of 2022. I wish you all a very happy new year. John Farrell will be back to kick off 2023 on Tuesday. This is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City to our audience worldwide, welcome to the last day of trade of 2022. We are cross-platform. We're simulcasting radio, TV, one Caroline Hyde, one Paul Sweeney. We're having a blast. This
We are?
Final day of trade, even though it has not been a blast along these markets.
No, today's trading, we're giving back some of the gains we had yesterday. So got the S&P off about 0.8%. It just feels like, this is a day, I don't think people want to go into the weekend with any, exposure here. That's just kind of how it feels to a relatively soft tape with soft volume as well.
Yeah, we seem to be trying to tie things up, perhaps trying to stiff up a lip, as the British might put it, because, boy, have the British had a tough year too. Let's talk about all of this with one Abigail Doolittle, who can really button up what has been an extraordinary year, whether you're in stocks, bonds, dare I even say a sprinkling of crypto.
Yeah, I mean, it's actually hard to know where to start because the sell-off has been so significant. The S&P 500 down about 20%, or a bear market, that NASDAQ 100 down even more, down 30%. But it extends right across the board. I mean, big tech, some of those indexes down more than 40%, the New York Stock FANG index, so all those mega cap names, the stocks. And then you also have bonds down because you're supposed to be able to put yourself into bonds when stocks are down as some kind of haven. Yeah, exactly. 60-40 this year, not really doing all that much. You know what's so interesting, though? Yesterday I was doing a little bit of a sort on the S&P 500. So naturally, we do tend to go toward where it's negative and where we have these big declines. But 175 stocks in the S&P 500 are higher, and we have a couple doubles on big names. Any guesses on the sector?
Energy.
Absolutely.
Yeah.
Occidental.
Have I missed that trade? Have I missed that trade?
A double. I mean, a double in 2022. There was another one. I forget which name it was exactly, but it was another big energy name. But we also have the defense contractors like Northrop Grumman and Lockheed Martin up about 40%. We have some of the staples like Kellogg and General Mills. So it's not all bad, but because we do have stocks down about 20%, bonds down about 15%, bonds the worst year since 1999. And it's not just treasuries, it's also credit. You have high yield bonds down about 16%, the worst going back to the history of HYG. And then LQD BBD, corporate credit down even more, down at 20%. So really nowhere to hide except for energy and some of those stock-picking names, basically energy, utilities, and some consumer staples.
You think about technology. It's been such a leading group for equity markets and equity investors for a decade plus. I'm not sure that's going to be the case going forward unless rates really do come down meaningfully.
I would agree with you, Paul, and it's a big lesson because we're just learning the power. I think we've known about it the whole time, but I think that we now cannot take it for granted, Fed liquidity, because for more than 10 years, Fed liquidity, that helped out these stocks that never seemed to go down. And of course, they did have good fundamentals and amazing growth, a lot of them. But even as growth started to slow, growth was starting on Alphabet and some of these other names from massive, massive growth to sort of more reasonable double digit a couple years ago, and they were still trading in a big way. Yeah. But this year, you have Amazon down 50%, you have Meta down 60%, Tesla down 65%, NVIDIA, the chip maker, what about in 2020? We had the supply chain issues for the chips, and now we have NVIDIA down 50% on the year. So I would agree. As the liquidity comes out, folks are really having to look at these companies more closely, and especially the valuation.
Yep, good stuff. Tech has been such a leader. It's going to be really interesting to see how they perform over the next couple of years. Abigail Doolittle covering all the market stuff for us here in our Bloomberg and Hour After Broker studio. All right, let's forget about 2022. That's my theme for the last few weeks. Let's look forward to 2023. Let's talk to some professionals who do this stuff for a living, see what we can look forward to. Joe Gilbert, Integrity Asset Management. He's a portfolio manager there. Joe, it says you're based in Moreland Hills. I'm just going to take a guess and say that's Cleveland.
Correct, Paul. Good morning. Thanks for having me on. Yeah, I'm on the east side of Cleveland.
All right, good stuff. Hey, Joe, I'd love to get your thoughts. What are you telling your clients right here? What's in your year ahead outlook letter to your clients?
Paul, so similar to you, we're just kind of throwing away the playbook for 2022 and looking forward to 2023. And so what we're telling clients is that it pays to be more constructive for 2023. I think as Abigail laid out, equity markets down 20% in the bear market territory, even some fixed income sectors and down 20% bear market territory that will end this year. So we think looking forward, the setup for next year for 2023 will be a lot greater. And we just basically see inflation will come down. The Fed will stop raising rates. Earnings estimates will go down and earnings multiples will go up. And we think that will lead to a strong equity performance next year.
What's been interesting is the only places to hide, Joe, have been oil, energy, commodities actually having a really stellar year, but also the dollar. And I'm interested as to whether that dollar trade, whether that sort of headwind for earnings as well, if you're a global related company, is that going to dial back in any sorts as we see perhaps the Fed take its foot off the gas and maybe other central banks keep on pushing like the ECB?
I think that's a great point, Caroline. I think that as we look, the dollar has actually weakened since September. I think we kind of hit the peak in September. And so this last quarter, I think we're kind of getting a preview of how we think the market is going to play out next year. Investors are starting to position that the Fed is towards the end of its rate hiking cycle. I think this year really has been about the Fed, and you sprinkle in a little bit of a Ukraine war and China zero COVID policy. So I think that we get to a point that investors are looking forward that the Fed will no longer be such a headwind for the market. And then the dollar is kind of showing you that, and that's why you've seen a lot of weakness here in the last quarter. So,
I'm an equity guy, but I look at the fixed income returns this year. Again, the Bloomberg Aggregate Total Return Index off 12.3% or something like that. And people in the fixed income biz will say that's a historic loss, historic performance, underperformance. So being the simple guy that I am, I just say I'm going to jump in both feet and buy some bonds here. What do you think about that strategy?
It's hard to disagree with that. I think that there's, similar as I said, the setup looks good for both fixed income and for equities for next year. As an equity guy, I'm a little more biased because I think that a lot of the bad news for equities has definitely been priced in as far as, and granted, there will be different sectors that outperform at different points in time next year. Unlike fixed income, I think fixed income obviously will basically, as soon as the Fed, intimates that they're going to be done or they're pausing, I think you're going to have a huge rally in fixed income, but they're going to bring equities along with them.
As an equity guy then, can you go as broad brush as industry groups you like, or are you having to be, look, as stock pickers kind of a market at the moment, given as we head into 2023?
I think that really that there are some winners and losers. The way we see it is, we've had the rolling corrections, and we think we're kind of going to see the rolling recession that will play through next year. And so I think within that, the way we're looking at it is kind of a first in, first out, Caroline. So it's more of the way we think about it is the companies and the sectors that have underperformed dramatically, the earlier cycle companies, those are where we're actually really looking for opportunities in. So that looks like more of consumer discretionary names, which are trading still pretty cheaply, pretty close to price to book. We're actually contrarianly and looking at home builders here because we think that again, it's a short cycle, it's early cycle, and so if we're right, and the Fed does start raising rates, and actually eventually we think they will probably cut toward the end of next year. Those are sectors that will do well as industrials that have very limited inventory.
Hey, Joe, a viewer/listener just kind of messaged me and said, hey, how can stocks perform this year if we've still got some pretty significant earnings risk out there? How do you kind of factor that in?
Well, I think that the way we think about it is stocks went down 20% this year or more, depending on where you were. And they went down because, stocks discount the forward outlook. So they discounted earnings coming down. And so we think that a lot of that has been priced in. This year was really about repricing risk and repricing expectations. So I think that's where we really are. I think, and most of the time, stocks generally rally as close to the last estimate cut, and so we don't know exactly when that will be, but we presume that it'll be early 2023, and that will basically be kind of the clearing event for equities to outperform.
Joe, talk to us about what you're going to be taking your cues from. Is it fundamental data? Are you going to be looking at the big broad brush data dumps that we get, the jobs market, whether it's inflation reads, that's what's going to be dictating you? Are you going to be looking more on the individual names, the earnings releases? What's going to be sort of your fuel, your catalyst to be getting in and out the market?
Well, we're fundamental investors, so firstly, we're going to always look at what company managements are telling us, and so we use that as a guidepost this year as far as companies that have been less constructive, or most management teams are bullish about their prospects, but on the margin they've gotten a little less constructive. So we're going to look towards that, but obviously on a macro sense, we have to have inflation continue to come down. So those are the CPI and the PCE reports. Next week is actually going to be pretty big because we have a payroll number that we think will show average hourly earnings declining again, and probably less added to payroll. Unfortunately, what we think that really is going to be the key is that will probably make next year not as negative on an economic standpoint, is that payrolls are probably not going to go negative just because there's a lot of job hoarding as far as company managements have been, once been twice shy. They don't want to release workers. They're going to probably just try to find a way to keep their payrolls not in a traditional recession where they will reduce them. They're going to probably try to keep them flat. So I think that we're going to really have to take cues from the inflation data points that come in, hourly earnings and service inflation.
All right, Joe, great stuff. Really appreciate you taking the time here on New Year's Eve. Joe Gilbert, Integrity Asset Management. He's a portfolio there. They're in Moreland Hills, Ohio. I just Google mapped it. It's just kind of like in that eastern part, as Joe was saying, of Cleveland, right near the lake. So a pretty cool part of the country. Appreciate checking in with Joe Gilbert. Right now, let's get world and national news. Ritika Gupta, she is in London. Ritika.
I am indeed in London, Paul. Thanks for that. A House panel has released 6 years of Donald Trump's tax returns. That ends a years-long battle between Democrats and the former president, who fight to keep his financial records private. The Trump returns show that he and his businesses lost millions between 2015 and 2020. That let him minimize his tax bill. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Meanwhile, Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. After a week-long meltdown, Southwest Airlines is returning to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg. Caroline.
Ruchika, thank you. Let's have a check-in. Let's for a moment lick our wounds a little bit, because I was doing some of the numbers, and it is an extraordinary year. You pointed it out how bad it's been for bonds. Global bonds worst year since 1990 in some measures. Paul, global stocks worse since 2008. We've got some great boards for you. What interested me, Bitcoin has obviously had a terrible year, down 64%, but in fact, it's only its worst year since 2018.
Exactly. And, you know, you think of what all the things that's happened in the crypto space when a major exchange fails so spectacularly, and what likely many observers are saying includes fraud, you would think that the number one asset would reflect that. Bitcoin, yeah, it was trading at 20,000. Now it's trading at 16,000, but it's not zero.
Yeah, it has held on in, and I think many a crypto bull they'll take that for the amount of news that has hit them this year. I want to focus in on, let's be glass half full a little bit as well, because we're excited for the end. We're going to be celebrating this end of 2022, no matter what it served up for you cross asset. But congratulations out there if you've been long commodities. The Bloomberg Commodity Index having a pretty stellar year, up 14% for 2022. Of course, it had a killer 2021. As we know, some of the news around why it did well was not a positive one for many people. But energy names, of course, really the outperformer. The dollar as well, King Dollar. I wonder if this is the end of it for 2022.
Yeah, I keep asking folks, smart folks that know this stuff, what's the bear case for the dollar? And, you know, maybe rates coming down.
Yeah, keep a close eye on the Fed. We keep a close eye on Donald Trump next for you as well. This is Bloomberg. Welcome back. This is Bloomberg Markets Live. We are across radio and TV today on this last day of trading of 2022. Paul Sweeney, Caroline Hyde. And what an extraordinary year has been, not just if you've been a financial news follower, but just more broadly a geopolitical news follower. From the early days of February, I think of the amount that we're going to be digesting, the relationships, the reorganization of how the way the world converses, whether it's between Russia, China, whether it's between Russia, the rest of the world, whether it's between, well, certain players within the US itself, of course, as we did have we saw the midterms come out relatively, unscathed to a certain extent. We're expecting perhaps not much to get done in the year ahead in terms of US politics.
No, and there's still a lot going on in Washington, even today. Talk about a data dump on a day before a major holiday. The taxes for former President Donald Trump have been released. We want to get the latest with Laura Davison. It just happened, just crossed the tape recently. Laura Davison from Bloomberg News joins us here. Laura, I know it's early moments of everybody sifting through the released tax reforms from former President Donald Trump. Any takeaways at this point?
Yeah, really. I mean, one, he has an incredibly complex financial picture, more than 1,000 pages worth of documents that were released about an hour ago. Detailing both his personal returns as well as his businesses. The businesses themselves were losing money for a lot of these years from 2015 to 2020. Part of those were actual losses, but some of those are all these tax breaks, depreciation deductions that are very favorable to real estate. So he was really able to minimize any tax bill that he might have to pay, including in one year in 2020 when he paid no personal income taxes.
And of course, we've heard him say time and time again that that's a smart thing to do, to use the tax codes as they stand to your advantage. What about the structure of the tax codes? What will next year bring, do you think, in any way?
Yeah, so this is the point that Democrats are really raising about this, saying, look, this shows that the tax code is broken. The fact that there are legal tax breaks for people who are very wealthy to be able to basically have a separate tax code from those that, normal wage earners might pay is a problem. Unfortunately for Democrats, as they're about to lose their House majority going into next year, Democrats will retain control of the Senate, Republicans will control the House, which really just spells out gridlock for any sort of tax legislation. It's highly unlikely that the two parties will come together on any legislation that would result in raising taxes, particularly if this legislation were the result of some of the findings from Trump's tax returns.
So, Laura, these tax returns being released that'll provide some data on the former president's personal income, the income of his businesses. Will it give observers, analysts, any sense of his net worth and maybe the change in his net worth?
Not really. The problem with tax returns is they're really just a snapshot in time of earnings for a particular year. Because of Trump's net worth is so tied into real estate and other deals, that is all not really reflected on these tax returns in terms of valuations and things like that. That data just isn't there. So in terms of whether Trump is as rich as he says he is, whether he gained or lost a bunch of his net worth while he was in office, we can't say from these documents.
Laura, of course, you're busy coming on with us rather than having to pour through the thousands of pages. But just talk to us as a reporter, what you're going to be doing, where are you going to be looking, what do you hope to glean from all of this?
Yeah, so the real key question here is, so how much did Trump benefit from his own tax law? He, with the help of Republicans in Congress, passed a big tax cut in 2017. These documents give us a perfect example to look at, a couple years before that law change, after that law change. How were taxpayers like Trump able to benefit from these law? What deductions were he able to claim, and which things was he not able to claim? One of the key things was this 20% pass-through deduction that was a key centerpiece of the bill, helped LLCs, partnerships, pass-throughs write off a bunch of their income. Trump actually wasn't able to claim that one because he actually lost money on his businesses those years. But going forward, if he were to make money, he would be able to take that deduction.
Laura, great to have some time with you. Thank you so much. We'll let you get back to the reams of documents, a data dump indeed, as we have the last day of trade here in New York. We thank Laura Davison over there in Washington for all things Trump taxes. Meanwhile, let's talk more broadly a little bit about geopolitics in and of itself, because we also had a key meeting happening overnight. Vladimir Putin, Chinese President Xi Jinping, sort of talking about deepening their ties. Remember from February when we first thought that this relationship was really cementing itself ahead of the Winter Olympics. And then of course, Russia-Ukraine unfolded. Let's get up to speed with where this relationship is at the moment. Madison Mills is with us, just here by phone. And what did we learn from this meeting? It seemed to be virtual, but there seemed to be a lot of, mutual respect shown.
Definitely, Caroline. There was a lot of commentary from Putin and Xi Jinping, both saying that relations are at their, quote, best in history. This was their first video conference this morning since the two met in person back in September, really underscoring Moscow's dependence on Beijing, Putin calling Xi a dear friend during part of the meeting. But we didn't necessarily hear that same level of commentary from Beijing. We have to remember here that China has refused to publicly condemn the invasion or even call it a war. Instead, their messaging has really been that, the U.S. has provoked Russia by pushing to expand NATO. So China not necessarily giving as much support to Russia, rather, as Putin might like. And again, just continuing to distance himself from Putin, Xi, that is, as this war continues to go on, which potentially Beijing didn't anticipate 10 months ago when this all began. I also just want to point out the scale that this war has gotten to as of yesterday. It was the largest bombardment in the history of this war so far. We have attacks, missile attacks, more than 120 of them. Power is out, 90% of it in Kyiv, attacks from Kyiv to Lviv, really showing Russia just not letting up on their strategy of literally trying to freeze out Ukrainians as we head into the winter months.
Madison, is there any sense or any expectation of China stepping up its support of Russia in any meaningful way, or was this meeting maybe a little bit more just for a show of solidarity?
I think we have to just listen to what we do know from Xi Jinping, which is that, you know, they haven't said what Putin wants them to say, right? We haven't heard, you know, a deep condemnation of Putin, which is what the U.S. would want. We also haven't heard deep support of Putin from Beijing, which is, of course, what Putin would want. So I think they're just trying to get their economy reopened, to get, you know, COVID under control, and not necessarily freeze out Putin, a strong ally of China's in a time when they really need it.
I mean, a strong ally of China's in terms of also the oil flow that has happened. I mean, imports, exports have been crushed to Russia because of the geopolitical tensions, but they have managed to be increasing their exports of oil to countries such as China. Let's focus a little bit more on Russia and Ukraine right now, because that has been what in many ways has upended the commodity markets, the gas markets, what's really put so much strain on European economies in particular. Attacks at the moment, Russia versus Ukraine, where do we stand?
Yeah, so again, we had that largest bombardment in history yesterday, more than 120 missile attacks. But one thing I really want to zero in on, and we talked about this on the Sound On show last night, Russia's attacks are very, very specific here. They're not winning on the battlefield, so they're really focusing on the air in their attacks. But where we're seeing these attacks is really what's interesting to me. We're seeing them at museums, historic streets, cultural centers, areas where Ukrainian citizens go to, you know, maintain and learn and celebrate their culture. I think that tells us a lot about Putin's motivations here. We know that Putin is hoping to kind of get Ukraine to recognize Russia's annexation of 4 areas in Ukraine, none of which, by the way, the Russians do completely control. And Russia is specifically targeting those historical sites in those annexed areas. So I think that just tells us a lot about where Putin's head is at in terms of motivation. I also want to point out where the Russian citizens are standing in this. A lot of the Russians who were, you know, against the war have already kind of left the country. We saw that exodus happening earlier on. Again, we've been at this war for 10 months, over 300 days now. I'm, as we head into 2023, going to be really watching how Russians who are still there respond.
Madison Mills, thank you for keeping us up to date with all the ramifications, geopolitics on global economies as well. Let's have a quick look at where oil is trading at the moment. We're up 0.9% on the WTI crude contract. $79 is where we trade. The Brent crude contract also up more than a percentage point, $84. But actually oil has crept up only by about 5% all told on the year, Paul. It has been a very volatile year, most clearly in natural gas too.
It has been, but you know, the energy stocks have just surged across the board, across upstream, downstream. Really strong year for energy equities.
That's for sure. From New York, stick with us. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Welcome back. Bloomberg Markets live on TV and radio. Paul Sweeney, Caroline Hyde, and the last day of trading, pretty muted, lackluster. We're seeing, of course, volumes very thin, off by about 31% on the S&P, but the S&P itself is also off 0.7%. We're seeing the Nasdaq under pressure as well, Paul.
Yeah, kind of ending the year on a little bit of a whimper, which is probably pretty appropriate for how the trading has gone here this year. Let's get some details of what's happening on this last day of trading in 2022. We do that with Bloomberg Markets. Abigail Doolittle joins us here in our studio.
Well, you know, it's really interesting because we've been talking all week about this Santa Claus rally, and right now it's literally unch for the last 5 trading days of 2022. It's going to be interesting to see what the first 2 days, of course, of 2023 bring. Now, typically, when you have a Santa Claus rally that does happen, it means that the next year is going to be higher. When it doesn't happen, it's going to be lower. But of course, we had one last year, and that really didn't work out. So right now, we have the S&P 500 down 0.7%, the Nasdaq down a little bit more, down 1%. This is yields are higher, volumes are low, and of course, the big news on the year is the down year, the bear market for the S&P 500, essentially down 19.8% thereabouts. The Nasdaq 100 down even more, and yields climbing, so nowhere to hide. Bonds lower too.
How are people positioned? I mean, you're our volatility, our options expert as well. How have people been looking towards positioning themselves into the new year?
Well, you know, it's really interesting, Caroline, in terms of the VIX, something that's been baffling to folks all year long is that it's so low. Right now, in fact, it's at a, has a 21 handle. It's almost at 22. But the number one explanation for that is that institutional money, they're not as long as they would be, so they don't have to hedge. Now, is that true? It's hard to know, but it's an interesting explanation. The VIX hanging right onto the bottom of its range. If it should shoot back higher, probably toward 35 or so, which would suggest the new year could start with a sell-off. On the other hand, maybe that range breaks and maybe the bulls step in for stocks.
The S&P 500 Energy Sector Index up 58% this year. Wow.
It's incredible. It's incredible, especially given the fact that it was up 50% the year before. And you know what? Yeah. Okay. So we have the energy sector over 2 years, a double. You know, I don't know that it's considered to be a sleepy sector, because it is actually technically a growth sector. But who knew that that could happen? And I think that's a lot having to do with, mega cap tech really falling apart, down more than 40%. So folks wanting somewhere to go. What really stands out to me about the commodity complex in 2022, it's higher. The Bloomberg Commodity Index is higher. Oil is up about 15%. I believe natural gas is higher. On the other hand, wheat is up a little bit too. On the other hand, you have some of the metals lower, including copper. So a real divergent message there. And the reason that it stands out, because of course we have fears around a demand recession. We also have the Bloomberg Dollar Index higher. So it's not intuitive that you would have commodities higher. Those are risk assets. So you have this divergence between risk assets of stocks and commodities. What's 2023 going to bring?
Fascinating, the correlations. Also fascinating, of course, the push and the pulls of the global economy that does all this to whether or not we see commodities get a bid, particularly amid the China reopening. We thank Abigail Doolittle, and we dig in a little bit more into the commodity space. Now on Josh Young, Chief Investment Officer of Beeson Interests. Of course, you're focused on oil, on gas, on public equities in particular. Josh, just talk to us about, in particular, the China reopening story. It's sort of got everyone scratching their heads, and in the immediate focus, it feels that everyone's a little bit nervous. We're worried about the spread of COVID and how they're going to manage the short term. But in the longer term, does this mean that commodities could outperform once again?
Yeah, I mean, I think if you define longer term in terms of more than the next 2 or 3 months, it looks great. It looks like China is setting a target for a really high return in terms of flights, and we're starting to see congestion, essentially traffic on the streets in big cities, start to rebound in cities as they're on the tail end of their COVID wave. So yeah, I think it looks great from a short to medium term perspective. And as China turns back on, they also start to turn back on oil demand in other East and Southeast Asian countries. And so there could be a step up in terms of multiple millions of barrels a day of demand relative to where we've been over the last few months.
Josh, you're based in Houston, as I recall. You know, you've got the energy stocks up almost 60% year to date. How good is life in Houston right now?
So it's interesting. Employment's actually not up that much in the oil and gas space. Capital expenditures are not up that much in the oil and gas space. And the small cap stocks have lagged materially, unlike in past recoveries. So what it's setting up for is, even though those stocks are up a lot from their lows, it's setting up for a multi-year bull market where we could see maybe XLE and sort of the other like large and majors don't have as much upside here after their significant outperformance, but the small caps and oil services stocks, I mean, there's real potential there. And there's also a real potential for the revitalization of Texas and Houston. I mean, we're doing great, but it's not the same as it was in the sort of 2010 to 2014 timeframe where Houston was booming.
And a lot of that, of course, has to do with federal policy making, has to do with a pivot in terms of this economy, trying to focus in on climate change there as well. How much are we likely to see the smaller caps that you say in particular maybe start to turn on again? Maybe we start to see oil output increasing a little bit more in the United States, because that has been this interesting tension between the oil producers in the United States and indeed the US government.
Yeah, I think we need much higher oil prices to get oil production growth to be anywhere close to where people were expecting. So coming into this year, we expected oil production to grow by a few 100,000 barrels a day. And the consensus was, I think it was 1.2 million barrels a day. That consensus has come down a lot, and we've gotten production a lot closer to our expectation. And so what I think is actually going to drive the small cap re-rate is not going to be substantial production growth. It's going to be buyouts, where we're seeing large caps buy private companies at, let's say, 3 to 4 times EBITDA, and many of the small caps are trading as low as 2 times EBITDA. So there's real potential for a re-rate through acquisitions. And then also, just when you trade that cheap, you have the potential to pay off debt, buy back stock, pay a dividend, and sort of force a re-rate, which is not something you've seen from small cap oil and gas companies in the last decade.
Josh, how do you guys in the energy business think about the big picture of, I'm in the fossil fuel business, the world seems to be going green, it's probably going to take a lot longer than people thought. You know, how do you manage your business? When you talk to these companies, how do they think about the 5 to 10 year time frame?
So that's a great question. And one of the really interesting things is that institutional allocators are actually still divesting from the oil and gas space. So even though it's done really well over the last couple of years, I've noted Goldman and others have talked about this as well. There's still actually funds leaving the space from an institutional allocation perspective. So it's very hard to see capital formation, new companies and new projects funded, and oil production growth when you actually see divestment, and a lot of that divestment appears to be ideological, not economic. So what I think is going to happen is, over the next year or two, Goldman's estimate is the next year, we'll see maybe it takes 2 more years, money will start to flow back into the space from institutional allocators who, again, are still pulling capital. Private equity funds are still divesting. Insurance companies are still pulling their insurance coverage. When that flips and you start to see capital come back in, I think that's going to be the starting point for the recovery of production. And the really interesting thing is it takes many years to restore the oil services supply base, the ability to supply services, to then be able to go drill enough wells to get enough supply to get into an oversupplied situation. So I think we're set up very nicely for a multi-year oil bull market. And it really comes back to this divestment like you're talking about from the space, partly economically because the space did badly over the last 10 years, and partly ideologically where, it's real hard for investment committees at endowments and foundations and family offices to allocate, even though it's profitable and even though other sectors are doing poorly, there's just this big ideological obstacle to investing.
Some have, of course, sort of thought that turning towards natural gas as a supply of energy in the US is more friendly toward the environment. Natural gas has just been the most extraordinary commodity to follow this year for reasons we well know, and a lot of it to do with Europe and across the Atlantic. But to hit a high in excess of $9, to be back down to now $4.38, how do you see that part of your world looking for 2023?
Yeah, so I think natural gas is oversupplied actually right now in North America, and we will see sort of more normal temperatures. So it's been a relatively warm winter so far, other than this recent winter storm. And so weather's been uncooperating and supply has been higher than expectations. My view has been that natural gas would stay in this sort of $4 to $7 price range. And I think there might be a little bit of downside to that in 2023, but over time, supply and demand should balance out. And by 2025, there are a number of different LNG export facilities that should finish construction and come on. And at that point, I think we're set up for a meaningful move higher. But again, in 2023, it could be pretty rough on the natural gas side.
Josh, if I wanted to go down to Corpus Christi or Galveston and build a refinery, could I do that? Could I get regulatory approval? Could I raise capital? Is that even possible in this day and age?
Yeah, that's a good question. Honestly, I don't think that refineries are undersupplied. And I think that's been one of the big stories in 2022 where there have been a couple of points where the crack spread, so the refiner margin has been really high. And there's been this story about an insufficient supply of refining capacity. There may be an insufficient supply in a few years. The reality was that that was mostly driven by China lockdowns and millions of barrels a day of Chinese refining capacity, particularly the teapot, the smaller independent informal refiners going offline. And so as those are back online, there's actually plentiful refining capacity, and we see that with refining margins getting closer to normal levels. So yeah, it's really hard to build them, but frankly, we don't really need them.
Talking a lot about US supply-demand dynamics in oil and natural gas, just talk to us about OPEC Plus or what you're expecting for the next year in terms of the geopolitical risks around oil.
Yeah, I think OPEC Plus has been sort of an undertold story, partly because there have been a couple of different price wars in the last 10 years. It does appear that many of the OPEC Plus countries are hitting their peak production capacity and have actually had to produce materially less than their production quotas. And so there are a few countries that still have some excess production capacity versus their quotas, but overall, it does appear that there is limited spare capacity. And so as China demand comes back on, and as Russian barrels may be restricted from the market, we could be in a situation where there's a call on OPEC oil, and where OPEC is actually not able to deliver. So this is a really sort of contentious call, but it should be less contentious, I think, because even senior executives from Aramco and various OPEC countries, they've talked about limited spare capacity. So, I think this is potentially a 2023 story, potentially a 2024 story, but I think there's going to be a point where the world wants more oil from OPEC and where OPEC is just not able to deliver.
All right, Josh, great stuff. You know what you're talking about. Josh Young, Bison Interest CIO, giving us the latest on the global energy space. I'm looking at WTI crude oil right here as we end the year, $78.80. Remember earlier, we were up at $120 a barrel, so big pullback in crude. Supply and demand, you have to have a call there when you're thinking about global energy right now. Let's go to Ritika Gupta. We'll get world and national news. Ritika.
Thanks, Paul. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to obtain accurate data since the COVID-0 policy was lifted. And in Myanmar, Bloomberg's learned that deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison after being convicted of corruption. It was the final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Caroline.
Ritika, thank you. Let's have a check-in now on what's happening across the rest of your markets. We've been delving into the world of the outperformance, the energy, the commodity space that really has been your winner of choice on the year. Everywhere else, no let up really in terms of some of the pain trade. The S&P 500 trading down 0.7% on the day, and we see that add to about a 20% sell-off on the year. And really, in terms of Europe as well, Paul, we've seen Europe, relatively speaking, off about 12% on the year, but still
Yes.
a pain trade.
Yeah, it's a pain trade, but they have less tech exposure, so that was kind of the story there for Europe.
Miners, more of the key and the oil companies, of course, for those sorts of benchmarks. From New York, this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back. Bloomberg Markets Live. We are across radio and television today. Paul Sweeney, Caroline Hyde, digesting what has been a pretty seismic 2022, no matter which way you look at it. I think we've got to decide what our words of the year were. I think transitory, unfortunately, will have to be one of them. Supply chains, that was the word of 2021, and it certainly still seemed to be the one of 2022. The hopes that they were easing, and then maybe some concerns around China's reopening once again, Paul.
Yeah, exactly. I should have stayed awake, I think, more in my operations management, supply chain classes in business school, because that's the go-to story for the last couple of years, and hopefully things are getting better. Lisa Anderson, she's a manufacturing and SIOP expert and president of LMA Consulting. So, Lisa, we've all become, I guess, quasi-experts in global supply chains. Give us a sense of kind of where we are today.
Well, we have improved in terms of our ability to supply product to customers. However, we still are in a scenario where supply chains are on the move. Continual disruptions continue to persist. It just keeps moving.
Okay, where's it moving to? Talk to us about the ramifications, for example, of COVID in China and whether that longer term unplugs, but shorter term confuses for supply chains.
Oh, it definitely is going to impact supply chains because China is a manufacturing powerhouse. And with the zero COVID policies, they've been shutting manufacturing down. It certainly affected the iPhones as an example. But, you know, the bubble continues to move. You know, the supply chain is a system of systems. And so as it gets to the next point in the supply chain, you know, it was at the ports, and then it went to rail, and now we have it's at the warehouses because we're completely full throughout the U.S. and are still looking for more space. Yet we don't necessarily have the products we need. To your point about the zero COVID policies and you know, some of the products like the iPhone.
Hey, Lisa, you know, when I was in business school, we did learn about a thing called just-in-time inventory, and presumably that's more profitable for manufacturers and the whole supply chain. Has that been called into question? Because now I'm hearing a new term, which is just-in-case inventory. Tell us how that may evolve.
Well, you're absolutely right. Just in time, everyone took quite literally for many years and just had inventory arriving as they needed it. However, the true concept of just in time does account for, you know, the lead times on your products and the risks associated with it. So if you took it with the true definition, just in time makes a whole lot of sense. However, people have definitely gone to just in case, and now they have more inventory than they need, and of course, of the wrong products, because consumers change their minds and products change. So we're going to have to do something different in the future.
It's interesting that some of that inventory buildup is in some ways a relief from the inflation pressures that many of the consumers felt. But more long term, the supply chain changes, the bringing closer to home, is that inherently inflationary? Are you the people you're consulting with, the companies you're helping, having to pay more to be able to get the comfort they need?
They absolutely are. Inflation has not stopped. It doesn't look like it's going to stop anytime soon, as there's a lot going on in the supply chain. And they're still yet having problems finding critical materials. And there's plenty of shortages throughout. So it looks like we're heading for a period of inflationary yet recessionary times at the same time, simultaneously.
Onshore more of this stuff, like whether it's making a semiconductor chip or any other product. Give us a sense of, is there a follow-up on that whole thought within kind of the C-suite?
Absolutely. The vast majority of companies are looking at reshoring, nearshoring, friendly shoring. In essence, supply chains are on the move. And if they're not looking at that, they're looking at new partners. They have figured out they cannot be resilient with the current state of affairs. And so they are reshaping the supply chains of the future. Even the logistics arena is reshaping. The West Coast ports struggle to support the volumes. And so folks have been moving to the East Coast ports, and they're not necessarily moving back.
What about technology in all of this? How much of that is going to be a fix from an R&D perspective, from an investment perspective?
Well, actually, technology is quite critical for many reasons. We need to automate. We don't have the people that we need to support the products that we need to have on the shelves. Just take the baby aspirin as an example. So we need to, be producing closer to our consumers. That also can relate to, utilizing technology so that we can make that more feasible, and we can do it at a profit as well. So there's many. We could talk about technology for hours.
Let's talk about labor, Lisa. When we talk to railroad companies, certainly the trucking companies, dock workers, people in the warehouses, the whole supply chain, they all talk about a lack of labor supply and maybe trained labor supply for some of them. Man, I'm not sure what the solution to that problem is. I mean, the truckers have been having that since forever.
Absolutely right. And there are not a lot of truckers that are looking to get into the, into that industry. So we are, the same is true for manufacturers. For my clients in the last few years, they have been limited in their growth by the number of people they've been able to hire. Now, the more proactive ones have been looking at outsourcing products to, in the region. They've been doing all sorts of innovative programs in order to increase their outputs, but it's been a complete struggle, and it's basically limited their growth. So we're going to have to, be thinking about people differently than we did in the past, and we're going to need to utilize technology and automate.
And automation was thought to be perhaps a bit of a fix, not the total panacea, but a bit of a fix down by the ports of LA, for example. But everyone was blaming someone else within the food chain, whether it be the dock workers blaming some of the truckers then blaming some of the trains. Like, where are we seeing, from a federal level, some more clear thinking and actually fixing of these problems rather than pointing fingers?
Well, that's a great question. I would say that there is still, unfortunately, quite a bit of confusion about the supply chain. And so, I think that the good news is that we have realized that the supply chain is critical. It used to be like, what do those people in supply chain even do? Now everybody knows that supply chain has some relevance, even if they don't know what it's all about. So I think we've gained insight, but we still have a long way to go.
Lisa, it's always great catching up with you. LMA Consulting, Lisa Anderson there. I think supply chain is still going to be a watchword for 2023. Meanwhile, should we check in on these markets, Paul?
Let's do it. We're approaching the European close there, so.
Yeah, we're seeing, it's pretty ugly over there on the day.
Yes.
And it has been on the year. The CAC currently off by almost a percentage point. We're seeing the DAX off by a percentage point at the moment. Look, volume's very muted. FTSE 100 off by 0.8% at the moment. And we see yesterday, perhaps technology was helping lift hearts and minds in terms of an industry group, but today, most of them under pressure.
Key question for you. You were just over in London. How are the pub scene? How's the pub scene over there? Because that's just such a fun time.
I love a pub. Don't get me wrong. It's painful for them. COVID really accentuated a lot of the pains that already a lot of these companies had, a lot of the franchises that they had, and the way in which that you try and lure people in, basically with food, and then the labor costs that have been really painful. A lot of these local pubs that have become so much part of a community having to be shut because they cannot make the economics work. But when you're in a pub, it still has the wonderful vibe. I think many pointed out, actually, that the World Cup didn't do them a favor.
Did not?
Well, because the World Cup came at the same time as Christmas. Everyone's in a pub around Christmas, anyway. More than anyone, having lived in London for a while, and the half days that people like to take. And it sort of ended up just making everyone join, beefing up an already busy period. It would have been wonderful if the World Cup had happened, like, maybe in, what should we say, October, November?
Right, exactly. Like a lot of retail establishments around the world, you had COVID, which curtailed demand, and now you have inflation, and you have the labor shortages, all of which I would think for, the pub scene in England would be an issue. But, boy, that's fun.
You like an ale? You like a flat beer?
I do. I kind of like to go local there, whatever's local there. So that's usually what I ask the bartender. Whatever you like back there, I'll take.
A warm.
I'm not going to be the ugly American that says, give me a Budweiser. I'm not that person. I'm not that person.
I have to say I'm a cider person all the way through in the UK.
Really?
A good Aspel's, a good Somerset, a good Cornish kind of a flavour is the way that I got to go in some of these pubs. Meanwhile, my husband is horrendous and just orders a gin and tonic. Who marries a guy who orders a gin and tonic?
Exactly,
Me, that's
a pub.
From New York, this is Bloomberg.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Ready, go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
New York City to our audience worldwide, we welcome you to the last day of trading 2022, a simulcast on radio and TV of Paul Sweeney and Caroline Hyde. And a shout out to our viewer, Anthony Santos Stefano, Cabrera Capital. Thank you, friend. As he points out that I'm an idiot. And I appreciate that, because people need to hold me to account. As a Brit, I didn't realize that the British do the sensible thing on the last day of the year, and they take half a day. And so the FTSE is already shut, closed down 0.8%. And the Germans, having lived in Berlin for a short, hot second, also do the sensible thing. And they closed earlier as well. So they're down, closed more than a percentage point. But the rest of the good, you know, Southern Europeans still at it.
But
the French, the Italians, the Spanish.
But it ties into our pub discussion.
Yes.
The British shut down early and they go to pub. I understand that. Okay.
They do that, and they're going to get ready for their festivities over the week.
Good for them.
But at the moment, as we see across the board, the Stoxx 600 are just under pressure. Every single industry group has been in the red today. Banks, the best performers, but they'd been off by 0.6%. The telecoms really feeling the pain, as well as technology. Elsewhere, we're pretty much under pressure here in the US as well. It's a damp day for a damp year.
It is, and it's kind of a fine fitting coda to what has been a really tough year for the 60-40 portfolio, equities, fixed income. There's really no place to hide other than the energy patch and some of the broader commodity spaces. Then the rumor has it that Lisa Bromwitz has that barrel of crude oil in her apartment uptown. So she's had a good year, but everybody else is kind of tough.
Remain's still on a load of gold coins, and I'm not sure that's fared him too well over the course. Meanwhile, if you've been sitting on digital gold, I mean, Godspeed. Meanwhile, I mean, let's have a quick look at what's happening across the rest of the markets for you, because we've got one Ethan Devitt with us. We're pleased to welcome Moneta Chief Investment Officer, and we want to sort of discuss, Ethan, what an extraordinary year 2022 has been, but set us up into the next year as we put that behind us. 2023, are we going to see any of these asset classes? Let's start with equities, manage to push through some of these lows.
I think we will. It's going to be very segmented in terms of equities. That tech contagion that we mentioned earlier, that we're seeing, not helped by all of the Bitcoin debacle, the FTX investigation, that's all going to contaminate Bitcoin and anything adjacent to digital assets. So I'm not optimistic about the outlook for tech at the moment. Of course, those innovation trends are still continuing. Nothing is changing there, but that's going to be a very long-term play. We are going to see some recovery in equities simply because everyone's been talking about Tara versus Tina. Is there an alternative, or are there reasonable alternatives? At the end of the day, for a high growth portfolio, you still need to be exposed to equities. So I'll see some pickup in those value names, healthcare, industrials, and just in general, just a very broad base of old economy stocks we'll see recovering. I look at consumer staples. The consumer is still spending on staples. Very much there's an overhang, whether it's revenge tourism or picking up on what they couldn't do during the COVID years. I do expect the holiday season to have shown some very strong retail sales. Of course, when we look, though, at January, February, that's going to be dismal. There will have been a lot of borrowing from this first quarter in the fourth quarter, and we're going to see that coming through in earnings. But if we've learned anything from 2022 is that people are getting very good at telegraphing bad news. They get it out of the system early, and then they can only surprise on the upside. We've seen the Fed telegraphing its intentions, but clearly companies are telegraphing that too.
Ethan, talk to us about earnings risk. That is certainly a risk that a lot of people are calling out as it relates to the 2023 outlook. How do you think about that? How do you quantify it? And how much is it kind of in your calculus?
Well, if we get back to that telegraphing point I made earlier, what we saw very much in 2022 was actually earnings surprise on the upside because they'd been worked down so much in terms of expectations. So when a company gets the bad news out of the way, the expectations are low. When you're on the floor, it's easy to surprise on the upside. And we still saw 75 to 80% of companies beat expectations. So the key is where expectations get set. So I actually am not that pessimistic about earnings surprises on the negative side coming into 2023, simply because companies know how to play this game now. There certainly will be a threat to margins, though.
Yes, and a lot of the price pressures, maybe we see soothing somewhat on the producer side of the equation, the big data that we've been getting showing that inflation is moving in the right direction, but the labor side still seems to be very costly. We've got a very tight labor market. What sort of a picture is that going to be painting for you, and indeed what it means for, well, not just the Federal Reserve, but global central banks?
I do see the labor market as being a bit of a lagging indicator. We're seeing it working through already. Bonuses not having been great in 22. We saw some massive layoffs at the end of 22, certainly among some very select sectors, primarily tech. I think some of the froth is going to come out of the labor market. It'll still be tight, though. The participation rate remains low, and that's going to provide a strong underpinning to inflation. As far as what the Fed is doing, though, we can see all of these transmission mechanisms of its tighter monetary policy already working their way through. We've seen it in consumer prices, commodity prices. We've definitely seen it when it comes to the housing market. That, of course, is a strong component of people's purse that they would spend money on. So I think the Fed will be assured that much of the inflation that is dampening, is moderating into 2023. Perhaps the only issue is employment. But of course, the irony is a strong employment means a strong consumer, and that's ultimately a stronger economy. So we don't want to see the economy tanking either. We already have all too many recessionary risks on the horizon.
Ethan, talk to us about energy. We've been talking about commodities a lot today, and energy's been such a great story for 2022. One of the few areas where equity investors can make real money this year. Is that trade kind of played out, or do you think there's more room to go there?
There will be a little bit of room to go. We're still seeing quite a bit of rhetoric around the energy complex, this energy terrorism. We're seeing some statements coming out of Russia. It does seem, though, however, that Europe is getting its supply in shape, at least for this winter for sure, and equally for next winter. We're hearing about stocks increasing and just finding alternative sources. So we have this energy trilemma: energy security, energy pricing, energy sustainability, that all policymakers are juggling right now. It has seemed that the sustainability piece has been on the back burner this year as we've been focused on pricing and security. But however, the sustainability piece is going to continue to come to the fore. So I'm very optimistic about renewable energy sources. Regardless, if the world is going to continue to grow, our economies will need energy to grow. We'll need to get it from everywhere we can. That means wind, solar, and other sources. So I'm quite optimistic for that area. It may just have not received the fanfare that it did in 2022 because of security concerns.
And even, of course, those security concerns, primarily in Europe. Go global for us for a moment. We know that the DAX ended up the year down 12%, and we actually saw that it's closed early for lunch. The FTSE 100 closed and actually managed to eke out a very small 0.9% annual gain in dollar terms. It was down, but overall we did manage to see the FTSE 100 keep its head above water. What about the rest of Europe more broadly? Are you positive, negative in terms of an equity perspective?
Because, again, getting back to expectations have been so low when it comes to Europe, primarily because of this overhang. We've looked at inflation in Europe as not been demand-driven, but actually been supply-driven, primarily by energy. So suggesting that the US consumer, because of its demand-driven inflation, is in a much better state than the European consumer. The FTSE is interesting, you mentioned that, because it really has bucked the trend. Much of that is due to the old economy nature of the FTSE, as well as the weaker sterling, which has benefited for some time before it started to recover towards the end of the year. So across Europe, overall, most stock pickers I speak to are seeing pockets of interesting opportunities. These multinational companies which have benefited from a weak euro, again, they have not seen massive pressure in terms of the pricing and margins. And I actually am looking at good upside for Europe. Also for US investors, primarily because if the dollar starts to weaken now, that's when those non-US exposures will start to come to the fore.
Ethan, do I buy bonds here? They had such a brutal year in 2022. They can't go any lower, can they?
Well, I mean, they certainly can't have that jump lower that we've seen, that kind of step change. Bonds do look very interesting today. Getting back to that, there are reasonable alternatives acronym. They've been interesting for some time. Cash is no longer trash. We've heard many commentators say that. We've also seen investment grade, high grade investment grade bonds looking very interesting from a yield perspective. The question is how much you can get, how much you can of your portfolio you can leave in bonds today, and how much extra pain you're likely to take, because clearly the Fed is not done yet. The ECB, the Bank of England, Bank of Japan, nobody is done yet. So there will be a little bit of it'll get worse before it gets better in terms of bonds. But in terms of the yields and their own, when we see yields at 4 or 5% after inflation, that actually looks very, very meaningful. The inflation number, of course, is eroding what those yields look like in real terms. But as inflation ticks down, which we expect it will, those bond yields are really interesting today. But again, edging in, inching in, to be very cautious, because clearly we don't see that, as I said, this tightening is done yet.
Ethan, you started off the conversation by sort of saying how crypto had perhaps some correlation effects on dragging down technology, but go more broadly cross-asset for us, because you do look at alternatives. If you're looking at a 60-40 that hasn't worked for 2022, are there any areas that you're liking outside the world of bonds and equities?
For sure. Those clients who have alternatives and diversification in their portfolios have done better. There's been some ballast there. There's been something to take cash away from to rebalance into these weak equity and bond markets. If you just have 60-40 and everything's been falling, there's nothing actually to rebalance with. What we like is private credit. Again, certainly as the banks come under pressure, maybe credit ratings start to look more severe when it comes to the companies, the corporate side. We will see the need for this lender of last resort and private credit to continue to tick up. Those private credit managers we speak to are seeing very strong opportunity sets, if anything less crowding today. So that suggests there'll be some nice kind of cash flows that will come from that. And private equity too, venture capital, I'm optimistic across the board there.
Ethan, you've run 38 marathons. I have no idea why anyone would run 26.2 miles, but there are people that do that. What's the next one you're going to run?
Next one's actually Boston. I actually got a spot in Boston in April, so I'm excited about that. I've done it before, but I was a lot younger then.
What's the best?
So I'm looking forward to that.
What's the best marathon you've run around the world, or what's
I'm
the
still
most
going to say
enjoyable?
New York City, the first and the best. It is just so diverse in terms of the boroughs. That the support from the street is electric. The ending in Central Park is just really iconic. And it was my first. It wasn't my best time, but it was the first psychological journey I made on that 26.2 miles.
That's awesome. Thank you so much. That's good stuff. Ethan Devitt Moneta, Chief Investment Officer and serious marathon runner. Go figure. 38 marathons she's run. She joins us from Chicago via Zoom. Right now, let's get the world and national news from London with Ritika Gupta.
Thanks, Paul. A House panel has released 6 years of Donald Trump's tax returns. That ends a years-long battle between Democrats and the former president, who fight to keep his financial records private. The Trump returns show that he and his businesses lost millions between 2015 and 2020. That let him minimize his tax bill. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Meanwhile, Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. And over here in the UK, a new poll shows the size of the challenge facing Prime Minister Rishi Sunak and his Conservative Party. The survey conducted by People Polling shows that Labour has a 26-point lead over the Conservatives. The next election is expected to be held in 2024. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Caroline.
We thank you, Ritika. Working late over there in London when everyone else, I'm sure, has hot-footed at home, having the market shut. But let's have a look at what's been a pretty ugly year in general. We want to go through some of those painful boards that you can put to one side after you put down your pens and computer terminals later today. S&P 500 currently off by 0.8% on the day. Stock 600 lagging further. Every industry group in the red at the moment, led lower by technology over in Europe. But the all-country world index is off by 0.6%. It too has had a pretty torrid year, losing about a fifth of its value over the course of the trading year. 10-year yield, we're just seeing actually, maybe that's what's dragging equities lower a bit. We're seeing, of course, the bond market once again sell off.
Yeah, absolutely. You mentioned emerging markets. We talked to Damien Sassower from Bloomberg Intelligence all the time on Bloomberg Radio and Bloomberg Television, and has really been a tough space really for many years. I really want to check in with Damien next week and get a sense of what the reopening of China means for some of the emerging markets. It's such a big part of that MSCI index, and it just felt almost uninvestable for many people over the last year or two. And now with the reopening, maybe just some opportunities there. So it'll be interesting to
particularly in some of the tech names, given that Tencent finally getting some of its gains that it was wanting to be pushing through allowed maybe people starting to think, okay, this Chinese government's not only reopening the economy, perhaps some of the clampdown from a regulatory perspective is easing off on some of the big tech names. Keep an eye globally for you in this simulcast across radio and TV. Happy last trading day.
What's happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and Radio.
Welcome back. Across radio, television, it is Bloomberg Markets Live. It is the last trading day of the year. It is one Paul Sweeney, one Caroline Hyde together. We're going to be discussing, well, what has been a pretty poor day and indeed year for your equity markets, for your bond markets. But what's interesting is we've had a couple of guests on today, perhaps saying maybe consumer discretionary is a place you could be looking for. We kicked off the conversation in the 10 o'clock hour with that exact sort of a take. The strength of the consumer in the US has been remarkably resilient, considering all of the headwinds this year, Paul.
It has been, and you think about it, the consumer here who is, fully employed effectively. Wages are in fact going up, not at the rate of inflation, but generally the consumer has been hanging in there. And we want to get a sense of kind of, as we get through this holiday shopping season, how the retailers are doing. Claire Tassin, she's a retail and e-commerce analyst at Morning Consult. She joins us from Chicago, a little bit balmy Chicago relative to last week via Zoom. Claire, talk to us about just kind of what we're seeing 30,000 foot level from this consumer. We've kind of getting in the back, the tail end of this holiday shopping season. How's the consumer and doing out there?
Well, I heard the word resilient as we were starting this conversation, and that's really been the word of the year for the U.S. consumer. I continue to be surprised at every month when we get the retail sales report that people are continuing to spend despite ongoing high inflation. And yet we are seeing consumers really lean into debt. We know that credit utilization is up as people continue to spend while absorbing higher prices. So there's good news in the resilience, but the debt does have me worried.
What's interesting is when you talk to the bank CEOs, particularly those with large retail parts, the Brian Moynihan's of Bank of America or Jamie Dimon over at JP Morgan, not many of them seeing much stress within the credit levels of their consumer at the moment, not worrying signs. But talk to us about, well, maybe the deferred payments. Talk to us about buy now, pay later, because every time I purchase something, I seem to be offered to split it up over the course of 4 different payments. How is that perhaps just putting off some pain inevitably?
Absolutely. So consumers have been really attracted to buy now, pay later, especially this year. We saw at Morning Consult in our data a massive uptick in utilization, specifically from Gen Z and millennial shoppers. But it has a lot of appeal over credit cards for consumers in that it feels like it's much more controlled. Like you said, it's a defined payment period. It's a defined monthly payment. The initial fees, if you miss a payment, usually aren't too painful, although they can get you. So unlike credit cards, it does feel like it's something that consumers can keep a tighter control over while extending their cash flow and kind of making the budget align a little bit.
Claire, there's some big retail trends going on out there that I want to get your opinion on. The first one is a little concerning to me. Buy now and pay later. What is it and what impact is it having on the retail space?
So for buy now, pay later, if you're one of the few people who has not seen this when you're checking out online, it's an alternative credit option. It's effectively a short-term loan that has very little scrutiny around it. So you can just say, sure, I would love to spread this payment out over a couple months. Instead of paying for it all at once, you can spread it over a few paychecks. And consumers have really taken to this. So the providers here that might be familiar are Affirm, Afterpay, Klarna are some of the big ones. A lot of people tend to believe that this is really used for major purchases like a new sofa or a mattress. However, in our data, we see that people are really using these loans for day-to-day purchases. One of the most popular categories is apparel for use for buy now, pay later loans. So,
I've tried it out. I have to say, I bought a pair of boots, got them in 4 installments. Yeah.
Is this like the old layaway plan? Right? It feels like it's an old layaway plan.
Everything is a state of revolution, not evolution.
Yes.
Yes, it is a modern context for that where you can spread that payment out. So for retailers, consumers having more options to pay is certainly a good thing. Although I will warn that the Consumer Financial Protection Bureau is increasing their scrutiny on this market because we do see people